Hi guys. So first of all, I'm happy to announce that from our institutes, rest of CA and CMA, we are going to release all CA Inter 8 subjects marathon for the coming May 2023 exams. So please watch this introduction without any failure because I am going to give you certain inputs before you proceed watching this marathon. Okay. Now, just a minute. Now, for all the 8 subjects we are going to upload, and I'm also going to give you the faculty details and resources that you need to use parallelly while you're watching this marathon. Now, first of all, relating to group 1, paper 1, paper 2, paper 3 and paper 4, and group 2, paper 5, paper 6, paper 7 and paper 8. Okay. By the way, I am doing this video, this introduction part, I am recording it on, March 1st week, 2023. Okay, so paper 1 is accounting, paper 2 is law, costing and taxation and advanced accounts, and of course audit, which is handled by myself, and EAS and SM and FM and economics. Okay, so these are the subjects that we are having. Kindly watch this introduction. We wanted to provide you all 8 subjects marathon under one roof. Okay, so completely in English. The marathons are going to be completely in English. Okay, this whatever you're watching, this introduction will be there in every subject related marathon which we have uploaded. Now, so accounts, the subject is being handled by our expert faculty, Satyaraju sir. So where we are going to upload for approximately 18 to 20 hours of marathon in 2 parts. Okay, one part will be of 11.5 to 12 hours and 8 hours. So by when I will be uploading these videos? By when you will be getting all these marathons? Already if you observe, paper 6 audit marathon is already uploaded. Like if you open our YouTube channel, okay, if you open our YouTube channel, see Harsha. So if you come to the playlist, so here already audit revision May 2023 is already uploaded, part 1 and part 2. Now what else is pending? Remaining subjects are pending. Now here we will create a playlist, okay, separate playlist exclusively May 2023 CA Inter revision or CA Inter marathon, something like this. We will create a playlist which you will find from 8th March onwards. Okay, so I will create a playlist here, and inside that you will find all the subjects marathon which we gradually upload in the coming 10-15 days. Okay, so anyhow, by the time you started watching those subjects, this introduction will be outdated for you. Okay, now throughout this marathon we are using certain materials. Okay, we will use certain materials as basis for teaching in these marathons. Now one more important clarification that I want to cover is for paper 2 company law. Especially in paper 2 we have other laws and company law. In company law we have got certain amendments. Paper 4 taxation we have huge number of amendments, and remaining all other subjects there were no amendments absolutely. Even in audit there were no amendments. Only in company law and taxation there were many amendments. And you know what? In the marathon that we are going to upload, in the beginning itself, now my introduction you're watching, right? Immediately after my introduction, amendment video will be there. Whatever amendment is that amendment video will be there, especially in case you are watching the law marathon. Getting it? So look, this is an introduction to the marathon video. You continue watching, it will be a marathon of the respective subject. Suppose you are watching right now law marathon. So after my introduction, immediately law amendments video will be there. And after watching that amendments, then watch the actual marathon. Getting it? Now I'll guide you. Please listen to this carefully without skipping this introduction part. And by the way, you will find timestamps in the below video description. You will find timestamps like what chapter at what time we are discussing. When amendments are being discussed, all the timestamps were given clearly, including the introduction is 00 timestamp, nothing but. Okay. Now, suppose if you look at law. So this is an amendment material which is applicable for May 23, which is prepared by our faculty team member D.V. Subramaniam sir. So he prepared this material. So we have clearly given, what is the amendment? Amendment number 1. There is an increase in limits for small company. Amendment number 2. Rectification of name. There is a reduction in time limit. Amendment number 3. So another amendment. Amendment number 4, some returns related. Amendment number 5, this is a newly inserted provision. Okay. And in amendment number 6, some registration of charges. Amendment number 7, amendment number 8. Like this, we have created an amendments material. Now this is for law. This is for law. Now, if you look at, so this is a general introduction which I am giving. Now, where you can download this material, you know, just a minute. Now, if you open Google Play Store, Sreshta CA CMA, there is an application. In Google Play Store, there is an app called Sreshta CA and CMA. You just download that application. Once you download and log in, you will find an application like this. You see bottom, store, charts, profile. Now there is a home option, right? Home. Okay. Or even you can go to store. Better go to store. Follow the procedure, whatever I tell you, so that you can download the materials, amendment materials, marathon related, whatever materials we have used. Suppose you go here. There is something called here, both the group subscription model. There is something called both the group subscription model. What I ask you is, this procedure I'm explaining you right now is regarding how to download the material which we use in the marathon. Now go to the content. Okay, if you come bottom, here bottom at last, there is a file called May 23, November 23 study materials. And inside that there is something called group 1 study material. Inside that if you see, paper 3 costing, paper 4 if you observe, paper 4A if you observe, main material if you observe. See, main material we have, for income tax we have 2 modules, paper 4A, one module 1, paper 4A, module 2, and amendments material. For paper 4A, amendments material for May 23 was given for you. Just download that. Here it will not open because it is screen shared, right? So it will not open. You can download here. Same way, you can come to the company law, paper 2, and you open paper 2A company law. The first file is then a paper 2A company law. Ignore that. That accidental again will delete. Okay. Paper 2A module 1 we have. Paper 2A module 2 also we have. Paper 2A amendments for May 23. Whatever the file I have showed you right now. Getting it? So you will find all the resources here. All the resources inside this. Same way, group 2 study material. Suppose you see paper 6. We have given you all the CA Inter main material and smart notes. This colored smart notes is what we have used throughout CA Inter audit marathon. So that's it. So what are the few instructions which you need to follow for sure in order to get maximum output, in order to get maximum benefit? What are the important instructions that you must follow while watching these marathons? The first and foremost thing, please watch the class at standard speed only. What is standard speed? Playback speed. In YouTube, you're watching this marathon, right? There is something called playback speed, watching at 1.2, 1.5, 1.8, 2 times speed. Please maintain 1x speed only. 90% of the students don't recognize the standard speed power. If you watch the lectures at standard speed, what is the impact? You will understand much more strongly. Remember, when you're listening to the class, the objective is not to listen. The objective is to understand, to analyze, to digest. Getting it? If you listen to the class at standard speed, you capture the content so in depth. If you listen to the class at higher playback speed, what happens is, you just listen to the words and you just move on to the next content. But you know what? Your brain will not process it. What is important is, whatever we are listening, the brain should process it. Only then we can emotionally connect. Only then we can feel it. Best example, you listen to any song at a higher playback speed. Just take any song. Just increase the playback speed and you try to listen. Your mind will not accept. You're listening to the word, you're listening to the tune, but at a higher rate. What is happening is, you will not connect with the song. You will listen to the song, but you will not connect. You'll not get that feel, connection. Exactly. Very simple. I know why you're watching at higher speed. The reason why you're watching at higher speed is to save your time. But you know what? If you watch at higher speed, what exactly happens is, you will not get emotional connection with the subject. You will not get that command on the subject. Your brain will not process it faster. Very simple. If at all we can finish 12 hours content in 8 hours, we would have used 8 hours technique only, right? Why we spent 12 hours? I know, sir, 12 hours content, if we watch at 1.5 times speed, we can finish in 8 hours, sir. We can save 4 hours time. Forget about your time, man. If at all our time was also precious, right? If at all we could finish a content within 8 hours by rapidly, explaining the things, why the hell we take 12 hours? As simple as such. We spent 12 hours without our knowledge. We spent 20 hours on marathon without our knowledge, based on whatever we feel to explain. Understand? And some of the students may say, we are fast learners. Even though you are a fast learner, just listen to the song at higher speed. If you are a fast learner, you will understand the tune, everything, emotion, everything. Okay, so it's not about fast learner, intelligent, brilliance, nothing. If at all something is given at a particular video, especially, see, you know why many students feel face-to-face classes effective? Because there you don't have the option to increase the speed. Why student feel face-to-face class is effective? Because he will connect to the subject very easily, because he is watching the lecture at standard speed. Same apply to online also, same apply to YouTube video also. There is no different principle for watching YouTube video. Don't apply shortcuts. Don't try to finish faster. Getting it? Give the time whatever is needed. So this is one important instruction. 2. Now some students know, while watching this marathon, whatever PDF we have used, right, for the subject, they'll be asking these doubts. Sir, should we take printout of this? No need. You're watching this marathon for revision purpose. Enough. If at all you are already our Shrestha student, subscription or regular student, you might have already placed order for books and that is already there with you. So what are the things? Like first thing I told you, we are uploading for all the 8 subjects. Okay. Our Shrestha team, which is very well renowned, like everybody knows how our Shrestha team classes are. Getting it? Believe me, you are going to enjoy the classes in a completely different level. You are going to get. And by the way, one more important clarification. Now, whatever marathon lecture we uploaded right now, right? Whatever you are going to watch, right? These were recorded for November 22 exams. These we have not recorded freshly for May 23. Please understand. These were recorded for November 22. Amendments we newly recorded, and that video also we have added. Sir, for May 23 you can record freshly. No, not required. Why? Institute itself has not given a new material. So whatever same material was there for November 22, the same material is applicable. No changes at all. Same way, the lectures were also same, which is applicable. No changes at all. Getting it? Wherever there is a change, we have uploaded amendments also as part of the marathon. And one more important clarification for paper 4 taxation. Okay, amendments videos were all put together. GST, income tax, all put together comes around close to 10 to 12 hours. So what we are doing, for taxation alone, amendments video will be separately given in addition to the marathon. So if you're watching our income tax and GST marathon, you are supposed to watch our amendments as well. Getting it? That's it. So these are the clarifications which I want to give. So I spoke about what instructions care you have to take, and I spoke about all the 8 subjects related marathon that we are going to upload, and I spoke about where you can find this, all the marathons. I know you might be watching this video, but you don't know about where you will find. Just open caramharsha, the channel where you're watching, open playlist. You will find in the playlist CA Inter May 23 revisions or something like that. You will find a playlist. So inside that you will find all the 8 subjects gradually. And I'm recording this video on 7th March 2023. And I will be uploading all the 8 subjects marathon in the next 15 days. Okay, every day, every alternative day, we will be uploading one subject. Okay, so take care. Have a nice time. Please continue watching without any failure. Bye.
Hello students, we are going to have a marathon on other laws of paper 2, corporate and other laws. As we all know, total 4 topics are there in other laws: Indian Contract Act, Negotiable Instruments Act, General Clauses Act, Interpretation of Statutes. And we are going to have marathon on all these 4 topics. So let's begin our marathon with Indian Contract Act 1872. So it is having a weightage of 12 to 14 marks. As you all know, other laws is having a weightage of 40 marks, including choice it is 48 marks. Indian Contract Act, you can expect 12 to 14 marks from this chapter. So at CA Inter level, we are not having entire Indian Contract Act, we are having only special contracts, namely indemnity, guarantee, bailment, pledge, agency. Let's begin our discussion with indemnity, very small topic. So what is meant by indemnity? So to compensate, to save someone from the loss. Yes, just look into the example. So 2 parties are there, Mr. R and Mr. S. So R is very rich person, he is having a money, and S is having a knowledge how to do business. So one day S approached R, sir, please invest money in my business. Because of my conduct, if you are going to suffer any loss, I will compensate you. So based on the promise made by S, R invested his money in S business. At the end of the day, S incurred loss. Yes, incurred loss. All the money invested by R in the S business, it was lost. Now total loss to R is the complete investment. As a promise, yes is going to compensate Mr. R. So this is nothing but indemnity. One more type of indemnity contract we are having, that is, yes, R and some third party, for example T. One day yes approached R, sir, I'm having very good knowledge about Mr. T. So I know Mr. T very well. So he is having a very good knowledge in the business. So I promise you, sir, you please invest money in T business. In T's business, you just invest money. Tomorrow, if you suffer any loss, I will compensate you. Now, Mr. Yes is making promise to R. So tomorrow, because of T's conduct, if you're going to suffer any loss, I'm going to compensate you. So based on the promise made by Yes, R invested money in T's business. And T was negligent. As a result, T lost entire investment which was made by R. Now R suffered a loss. So who is going to compensate the loss? Yes is going to compensate the loss. This is nothing but an indemnity contract. So indemnity contract between S and R. Now just look into the definition of indemnity. Indemnity means it's a contract by which one party promises to save other from loss caused to him by the conduct of promiser himself or by the conduct of any third party, any other person. So definitely any contract you take, it requires two parties. Contract requires two parties. So one party, what he is doing, sir, he is making a promise to another party. So promise with respect to what? Promise to save other from loss. Loss, which loss? Loss which caused due to the conduct of, loss caused by the conduct of promiser himself, or loss caused by the conduct of any third party. Now if you look into the first example, yes was negligent. As a result, R suffered loss. Now yes is going to compensate R. Indemnity contract, loss caused by the conduct of promiser. If you look into the second example, yes promised R that, because of T's action, because of T's conduct, if you're going to suffer any loss, we will compensate you, or I'll compensate you. Now there is an indemnity contract, and in second example, loss will be caused due to the conduct of third party. Understood? Now you can see here, two parties, promiser, promisee. Under indemnity contract, promiser is nothing but indemnifier. Who is indemnifier? The party who promises to save other from loss. And the next one, promisee under indemnity, we call him as indemnity holder or indemnified. Indemnity holder or indemnified. Simply, who is indemnity holder, ma? The party whose promise or who is promised to be saved. The person who is promised to be saved, we call him as indemnity holder. And this entire arrangement, we call it as indemnity contract. See, absolutely, this is a contingent contract. So tomorrow, promiser, Mr. Indemnifier, whether he is liable to compensate indemnity holder or not, it depends upon loss to the indemnity holder. If loss to the indemnity holder becomes certain, then indemnifier should compensate indemnity holder. So this contract of indemnity is enforceable depending upon loss to the indemnity holder. If it becomes certain, then this contract is enforceable. If it is not certain, if it is uncertain, then this contract is not enforceable. Understood, ma? And you can see every contract will have two parties. Similarly, indemnity contract is also having two parties. Every contract, parties will get certain duties and certain rights. Under indemnity contract also, yes, parties will get duties as well as rights, ma, as well as rights. So we are having two parties. One is indemnifier and the other one is indemnity holder. So duties of indemnifier is nothing but rights of indemnity holder. Is it clear? Duties of indemnifier is nothing but rights of indemnity holder. So indemnity, similar to other contracts, yes, it should satisfy all the elements of Section 10 of Indian Contract Act. That means, there should be an offer, acceptance, free consent, and both the parties, there should be, they should have capacity to enter into the contract. Next one, The agreement should be enforceable by law. Simply, they should not be void ab initio agreements. Understood. Next one, other conditions like stamping, writing, everything. Everything, all the conditions should be satisfied. And contract of indemnity can be either express contract or implied contract. Now just look into the rights of the indemnity holder. Rights of the indemnity holder. As you all know, indemnity holder can enforce his rights only when loss to him becomes certain. Until loss becomes certain, indemnity holder can't enforce this indemnity arrangement, and he won't recover a single rupee from indemnifier. For understanding this concept, let's have a small example. Let's have a discussion on let's have a one small example. As you all know, manufacturer, one who manufacture the goods, and a retailer, nothing but seller or dealer, simply dealer. So manufacturer, every time, he used to produce the goods, producer of goods, and every time he used to send goods to the dealer. So manufacturer deliver goods to the dealer, and dealers will ultimately sell the goods to the customers. So now from customer point of view, dealer is the seller, and customer, nothing but buyer. Are you all getting my point? So yes, there is a contract between seller and buyer. Yes, this is obviously a sale, which will be covered under Sale of Goods Act 1930. Okay, fine. Now listen carefully. One time, manufacturer sent a defective product to the dealer. A defective product, say for example, AC, air conditioner. Seller, without verifying, he sold the product to buyer. Installation completed. When buyer is using that AC, suddenly hot air comes out, and the room was completely burnt. Some blast happened, or some fire came out. As a result, the room of the buyer was burnt completely. So now AC cost, actually the cost of AC is 40,000, and the losses suffered by the buyer, burning of house, something, total losses to the buyer is some 4 lakhs. Now yes, buyer came to the seller and asking, sir, because of your product, today I suffered a loss of total 4,40,000. Come on, pay this amount. Come on, pay this amount. So seller, obviously what he will do, sir, this product is manufactured by some other manufacturer. You don't worry, we will put a claim to them. And then seller asked manufacturer, so and so person approached us, yes, the product was defective, as a result he suffered a loss of 4 lakhs. So now he's claiming 4,40,000. He's claiming 4,40,000. Obviously, since the product is in warranty phase, obviously whatever amount seller pay to the buyer, this amount seller is going to get that amount from manufacturer. So this is a real practical case, ma. So how practically it happens, you all know. Whatever things we are purchasing, all these goods we purchase from a dealer. A dealer will get products from manufacturer. So when a product which was sold under a warranty, so if the product becomes defective, if any defect in the product, as a result, buyer suffers any loss, buyer suffers any damages, definitely buyer will recover it from seller, and seller will recover that amount from manufacturer. So now there is an indemnity contract between whom and whom. So between manufacturer and seller. So manufacturer, promisor, indemnifier, and seller, indemnity holder. See, on receiving this claim, manufacturer told, no, don't pay 4,40,000. Just pay 2 lakhs only. I'll compensate you 2 lakhs. Buyer didn't agree. Matter went to the court. No, judge gave a judgment. Come on, seller, pay the amount to buyer. Total 4,40,000. So now whatever order judge passed. So yes, asking seller to pay 4,40,000. This is nothing but loss to the seller. This is nothing but damage to the seller. So who is a seller? Indemnity holder. So there is an indemnity contract between whom and whom? Manufacturer and seller. So yes, total loss suffered by the seller is 4,40,000 rupees. Now Mr. Manufacturer is liable to pay 4,40,000 rupees. And moreover, when this matter went to the court, seller appointed some legal advisors. Seller paid some, seller incurred some legal expenses. That amount 25,000 rupees. Now the seller is going to get this 25,000 rupees from manufacturer. You're getting my point, students? So just observe, there is an indemnity arrangement between whom and whom? Manufacturer and seller. So whatever losses, whatever damages, seller is going to suffer, all those losses and damages, Mr. Manufacturer is liable to the seller. So first thing, 4,40,000, which court ordered seller to pay the amount to the buyer. Yes, seller is bound to, seller is having a right, seller is entitled to recover that amount from the manufacturer. First thing, not only 4,40,000, but also, 25,000 rupees, for which seller incurred in meeting the legal expenses. So that amount also seller can recover from manufacturer. Suppose, both seller and buyer decided, sir, why we should go to the court, sir? So it will take more and more time, so let's have an arbitrage agreement. So we'll go to an arbitrage, middle person, a qualified professional only will go to that person. So definitely the case will be settled within a 1 or 2 weeks. Simply, compromise arrangement, we call it as compromise arrangement. Under compromise arrangement, whatever amounts, seller will pay to the buyer, all those amounts seller is going to get from manufacturer. So finally, the indemnity holder is going to get the following amounts. One is, damages suffered. Next one, cost of filing suit. And next one, sums paid under compromise. So these are the rights available to the indemnity holder. So let's have a view in the material. Let's see our material. So write about contract of indemnity. Already discussed. It's a contract by which one party promises to save the other from loss caused to him by the conduct of the promiser himself or by the conduct of any other person. And next one, contract of indemnity with examples. Just go through the examples. From examination point of view, don't expect any direct theory question from this chapter. You are going to get only practical questions. So don't leave these examples. Just read these examples one time or two times, so that when you see such type of questions in the examination paper, you can easily handle them. So surprise element in the question paper will definitely kills your confidence. So that's why I'm telling you, just go through the examples once or two times, so that when you see a practical question which is similar to the example, you can handle them carefully, you can easily handle them. Next one, parties to the contract of indemnity. As we already discussed, we are having two parties. One is indemnifier. Who is indemnifier, ma? Who promises to save. Next one, indemnified or indemnity holder. The party who is promised to be saved against the loss, we call him as indemnifier or indemnity holder. And we had different modes of contract of agency. Express contract of indemnity. Sorry, it's not agency. Indemnity. So it's an express indemnity, implied indemnity contracts we are having. Next, essentials for a valid contract. You can see here: offer, acceptance, intention to create legal obligation, consideration, capacity, competency, and then lawful objects. Agreement must not be expressly declared to be void, and the terms of agreement should be certain. It should not be vague or uncertain, and the agreement must be capable of performance, and other legal formalities. All the conditions should be satisfied. Just look into the example, ma. Yes asks R to beat T and promises to indemnify R against the consequences. R beats T and is fined 50,000 rupees. Can R claim 50,000 rupees from yes? No. Why? Contract of indemnity is applicable only for lawful terms, only lawful objects. So for unlawful objects, contract of indemnity or the benefits, you won't get it. First of all, before calling a contract as indemnity, it should be a contract. Here the object is very clear, it is unlawful. In fact, it is illegal. So beating another person, disturbing the freedom of another person, it comes under illegal activities only, or unlawful activities. So for unlawful activities, they won't come under the definition of contract. They are outside the purview of contract. It is a void agreement. So since it is not a contract, it is no more an indemnity arrangement. Understood? Next one, rights of the indemnity holder. Yes, whatever the damages suffered by the indemnity holder is going to get from indemnifier. And right to recover costs, cost of filing the suits, and right to recover other payments which were paid under compromise. But for recovering these amounts, he should comply the directions of indemnifier. He should comply the directions of indemnifier. If there is no direction from indemnifier, then he should take a reasonable care. He should exercise, he should act as a man of ordinary prudence. Then only he can get amounts from indemnifier. Understood? So if there is an express direction from indemnifier, indemnity holder should follow them accordingly. Next one, when does the liability of indemnifier commence? So tell me, my dear students, indemnifier. Who is indemnifier? Promiser. So when does the liability of indemnifier commence? So what is the starting point, commencement point? The answer is very simple: loss to the indemnity holder. If loss to the indemnity holder becomes a certain, then indemnifier liability gets commenced. Is it clear? So in my example, in my illustration, you can see here, the moment court orders seller to compensate buyer, from that minute onwards, manufacturer is liable to compensate. Whether manufacturer pays amount to the seller or whether manufacturer pays amount to the buyer, it's up to the manufacturer and seller arrangement. So whenever court orders seller, seller is having two options. Seller can directly ask manufacturer, this is the order of the court, come on, pay to buyer directly. Or seller will compensate, seller will pay buyer, later seller will get compensation from the manufacturer. You may ask me, sir, why buyer can't file case directly on the manufacturer? Manufacturer somewhere in Delhi, he is located in Delhi, and buyer is from Hyderabad. As you all know, if you look into the Companies Act, or if you look into the any company, all the disputes are subject to the jurisdiction where company registered office is situated. So if buyer is that much, buyer is having that much finance, if buyer is capable, financially capable person, then he can go to Delhi, he can file case on manufacturer. But if you observe, yes, there is a privity of contract between seller and buyer. So initially buyer will file case on the seller, and buyer will recover amount from the seller, and seller will get that amount from the manufacturer. Of course, the seller, the dealer should act according to the instructions of the manufacturer. Now the question is, when does the liability of indemnifier gets commenced? The answer is when the loss to indemnity holder becomes certain, then the liability of indemnifier gets started. So with this, the small concept of indemnity we completed. Our next topic is contract of guarantee. The contract of guarantee. Listen me carefully. So here, Mr. P is a person. He went to Canara Bank for loan, a loan of 5 lakhs. Canara Bank asked P, yes, we need security. You should provide some assets as a security, either gold or any immovable property. Provide any property as a security. P told, no sir, I'm not having any financial assets, sir, I'm not having any assets. Then okay, ask any person to furnish a guarantee, So yes, Mr. S came into the picture, and now he is making a promise. So what promise he is making? Sir, you just give him a loan of 5 lakh rupees. He will pay you principal and interest periodically. If this party makes default, if P makes default, then I will pay you. I'll pay you. Simply, I'll discharge P's liability. If P makes default, then I'm going to discharge P's liability. So this is nothing but a guarantee arrangement. See, here you are having three persons: a P, S, and Canara Bank. P is getting a loan amount, so I'll call him as a debtor. Yes, you can call him a borrower, but for the time being, listen carefully. So P is nothing but debtor, and Canara Bank is giving a loan. So Canara Bank, I call it as a creditor, and yes is giving a guarantee. Yes is nothing but guarantor or surety. So three parties we are having: debtor, creditor, surety. So what surety is doing, sir? So surety is making a promise that the third party, Mr. P, yes, to this arrangement, P is a third party. So to this arrangement, who is P? Third party. If this third party, Mr. P, makes a default, then I am going to compensate you. It's not compensate you, I'm going to discharge P's liability. This is the thin line of difference between indemnity and guarantee. I'll tell you, don't worry. After completion of this example, I'm going to tell you the exact difference between indemnity and guarantee. Many people get confused. Many people think that indemnity and guarantee both are same. No, it's not same. I'll tell you. Just listen carefully. So yes, P is getting a loan of 5 lakh rupees based on yes promise, and Canara Bank, yes, it will get principal and interest periodically. And then to Canara Bank, yes, is giving a guarantee. So my dear students, P is known as principal debtor, and Canara Bank is known as creditor. S is known as surety. So who is a creditor, ma? The person to whom guarantee was furnished, to whom guarantee is given, we call him as creditor. And who is the surety? The person who is giving guarantee. The person who is giving guarantee, we call him as surety. To whom guarantee was given, we call him as creditor. and whose debt is guaranteed, we call him as principal debtor. Finally, contract of guarantee is a contract to perform a promise or discharge the liability of a third party in the event of his default. In case of his default, this is what contract of guarantee. So in contract of guarantee definition, we are having two guarantees. One is monetary guarantee, that is discharge of liability. The other one is non-monetary guarantee. The other one is non-monetary guarantee, we call it as performance guarantee. I'll tell you, this is a monetary, this is a financial guarantee, where guarantee was given with respect to discharge of liability. Next one, similar examples, Ima. One day, P filed an application for a contract. So yes, C invited tenders from public. P filed an application for a contract. Sir, I'll do this project, sir. Please allot me this project. And to the same application, Mr. Yes is giving a guarantee. So what guarantee is giving? So in the event of P's default to complete the project, I'm going to complete the project. So today P is making a promise. What promise is making? He is going to complete the project. If P makes default in completing the project, I'll come into the picture. I will complete the project. So this is with respect to discharge of, not liability, discharge of P's promise, P's obligation, or P's performance. Simply performance. So when guarantee is given with respect to the performance, it is nothing but performance guarantee, non-monetary guarantee. Understood, my dear students? So performance guarantee. Now you can look into the definition. So the definition is contract to perform the promise or discharge the liability of a third party in the event of his default, or in case of his default. So why I'm calling third party? The reason is, to this arrangement, to this guarantee arrangement, yes and Canara Bank, or yes and C, Mr. P is an outsider. He is an outsider, so he's a third party. So here, surety is giving a guarantee with respect to third party promise, with respect to third party's liability. Understood, my dear students? And finally, tell me, how many parties are there in a contract of guarantee? We are having three parties. Just now we discussed the principal debtor, whose debt or whose promise was guaranteed, whose performance was guaranteed. Next one, creditor. Creditor is a person to whom guarantee was given. Surety. Surety is a person who is giving a guarantee. Understood? And how many contracts are there? How many parties? Three parties. How many contracts are there? So the answer is three contracts. One is a loan contract, main contract between principal debtor and creditor. The other one is guarantee arrangement, surety arrangement between surety and creditor. And the third one is implied indemnity contract between principal debtor and surety. Generally many think that there is only one contract of guarantee, only one contract in contract of guarantee, but it's not like that. Because of this promise only, my dear students, because of this promise only, these two contracts are coming into the picture. So total three contracts are there. One is main contract, loan contract. The other one is guarantee arrangement, and the third one is indemnity contract between P and S. Sir, how comes implied indemnity contract between P and S? I'm going to tell you. Just listen me carefully. Just follow me carefully. So principal debtor, creditor, surety. Now surety is making promise, yes or no? Based on this promise, yes, creditor is giving a loan of rupees 5 lakhs to the principal debtor. Tomorrow, what happens if principal debtor makes default? Answer my question. Tomorrow, what happens if principal debtor makes a default with respect to C's loan? Definitely, sir, C will come to yes and C will recover amount from yes. Correct. Now, yes is making payment of 5 lakhs to the C. Definitely, this is a loss to yes. Definitely, this is a loss to yes, because yes didn't borrowed 5 lakhs. Who borrowed 5 lakhs? Principal debtor borrowed 5 lakhs. Surety is simply an innocent person. He didn't took a single rupee. Just principal debtor default made him liable to pay 5 lakh rupees. So yes, that's the reason surety is paying 5 lakh to creditor. Now this 5 lakhs is nothing but payment of 5 lakhs is nothing but loss to the surety. Is it this clear, ma? Yes, sir. So now the answer is, now the question is, this loss of 5 lakhs, today surety is going to suffer, or surety suffer, because of whose conduct? Because of whose conduct surety is suffering with loss of 5 lakhs? Sir, because of principal debtor's conduct only. How can you say? Sir, principal debtor simply he made a default. That's the reason, surety is making payment of 5 lakhs. So surety is suffering with a loss of 5 lakhs just because of principal debtor default. Correct. Now, who is going to compensate surety? Obviously, principal debtor, sir. Obviously, principal debtor should compensate surety. Now, apply the definition of contract of indemnity here. Contract of indemnity is a contract by which one party promises to save other from loss caused to him by the conduct of promisor himself or by the conduct of any other person. So today surety is going to suffer loss, or surety is suffering with loss because of principal debtor conduct, and no need of express arrangement implied, simply by the conduct. Because of this guarantee arrangement, automatically, this third contract comes into the picture. Accordingly, principal debtor becomes indemnifier, and surety becomes indemnity holder. And how this arrangement comes into the picture, by the conduct of the parties. So we call it as implied indemnity contract. Implied indemnity contract. So total there are three arrangements between, these three parties: principal debtor, creditor, and surety. Is this clear, my dear students? So we had three parties, and all the essentials of a valid contract, this contract should satisfy. This contract, contract of guarantee should satisfy all the essentials of a valid contract. So there should be an offer, there should be acceptance, next one, consideration, free consent, everything. But two exceptions are there. Listen me carefully. Two exceptions are there. Why this guarantee is a special contract? The reason is, two points. One is capacity, competency, capacity of parties to the contract. Competent person. Generally, the parties to the contract should be competent. That means they should have attained the age of majority. They should not, they should be of sound mind. Simply, he or she should not be of unsound mind. Next one, the person should not be disqualified under any law for the time being in force. So these conditions should be satisfied. Then only, the person is having a capacity to enter into the contract. In this contract of guarantee, a principal debtor can be minor. A principal debtor can be minor. Even though he has no capacity to enter into the contract of guarantee is valid. So tomorrow, creditor will straight away come to the surety, and creditor will straight away recover amount from the surety. So contract of guarantee is still valid if principal debtor is not competent to the contract. You may get a doubt, sir, what happens if surety is a minor, sir? There is no solution, sorry, there is no alternative. If surety is a minor, then it is not a contract of guarantee, it is a void agreement. Why? Because, generally minor won't get any liability. In case of contract of guarantee, surety is having a liability. Overlap, yes or no? So surety will get a liability if principal debtor makes a default. Minor is not liable under any arrangement. Therefore, minor cannot, surety can't be a minor. A minor cannot act as a surety. So surety should be competent to the contract. Are you all getting my point, students? So principal debtor can be incompetent, but surety should be competent. The point is, principal debtor to the contract can be minor. This is one special point. And the second point, if you look this entire arrangement, tell me, my dear students, in this main contract, first contract, principal debtor is getting a loan amount, right? And creditor, he is getting a principal amount and interest amount periodically. That means, both the parties are having something in return. Principal debtor is getting something in return, creditor is getting something in return. So both the parties are having something in return. So that means there is a consideration in first arrangement. Tell me, my dear students, under second arrangement, is there any consideration? Is consideration present in the second arrangement? Let's see. So what creditor is getting from surety? Sir, he is getting a security, sir. If principal debtor makes default, surety will definitely make payment. So that means, creditor is in a advantage position only, in good position only. So yes, he is getting a double security simply. First thing, principal debtor will make payment. If principal debtor makes default, don't worry, surety will pay the amount. So benefit to the creditor. Now I'm asking you, what is the consideration to the surety? Actually nothing. But section 127, what it is telling, anything done for the benefit of principal debtor, or any promise made for the benefit of principal debtor, it's a sufficient consideration to this surety. So based on this surety promise, whatever benefit, principal debtor is getting, Whatever promise creditor is doing to principal debtor is a sufficient consideration to the surety. And the consideration can be monetary or non-monetary, and consideration need not be adequate. Are you getting my point? And my dear students, remember the point, the promise made by the surety and the benefit principal debtor getting, it should happen simultaneously, parallelly they should happen. Simply past consideration under contract of guarantee is invalid. Suppose principal debtor is getting a loan on 1st January 2023 and surety is giving a guarantee on 10th January 2023. Now, is this guarantee arrangement valid or invalid? The answer is invalid. Why invalid, sir? At the time of surety promise, nothing is, principal debtor is getting nothing. Principal debtor is getting nothing. See, loan arrangement happened on 1st January and the surety is making a promise on 10th January. Now on 10th January, what benefit Mr. Principal debtor is deriving from creditor? Sir, no benefit, sir. That's it. That's it. Contract of guarantee is invalid. Suppose on 10th January, creditor gave extra loan of 50,000 to principal debtor, 5,50,000 to principal debtor, and for the entire 5,50,000 rupees, yes, surety is giving guarantee. Now, is this guarantee valid, sir? The answer is yes. Why? Consideration need not be adequate. So, creditor is giving 50,000 rupees benefit to the principal debtor, and surety giving guarantee for entire 5.5 lakhs. This is valid. This is valid. Understood, my dear students? Next one, as you all know, this is a marathon lecture. So here I am not going to explain you in a detailed manner. I'm going to cover all important topics with relevant examples. So these two special points made this contract of guarantee as a special contract. What are those 2 points? Principal debtor need not be competent to the contract, and the consideration to the surety is anything done for the benefit of principal debtor or any promise made for the benefit of principal debtor as a sufficient consideration to the surety. Understood, ma? Everyone. Next one. Yes, contract of guarantee can be either oral or written. As of now, every contract takes place in writing only. If you had trust issues, definitely, in writing is the best option. Sir, I 100%, I rely on the party, sir. Whatever promise he is making orally, he will stick on to the promise. No need of writing. Then no need of worrying. So contract of guarantee can be oral or in writing. And next thing, the arrangement between principal debtor and creditor should be enforceable one. The arrangement between principal debtor and creditor should be enforceable one. Suppose if this main contract is not enforceable, then the supporting guarantee contract becomes null and void. So, for example, creditor supplied 5 kilos drugs to principal debtor, brown sugar, 5 lakhs worth. 5 kilos I told you, right? Okay, so creditor supplied 5 kilos brown sugar to principal debtor, and principal debtor is liable to creditor for that amount. Suppose yes is giving guarantee with respect to that payment. Sir, you just supply 5 kilograms of brown sugar. If principal debtor fails to pay, I will compensate. Sorry, it's not compensate. I will reimburse you, sir. I'll pay that amount, sir. If principal debtor make default, I will pay you, sir. Now, is this a contract of guarantee? The answer is it's not a contract of guarantee. Why? First of all, dealing in drugs is an illegal activity. So illegal activities, you can't treat them as contracts. If it is not a contract, then it is not a contract of guarantee. Understood, my dear students? Everyone. Now I'll tell you what is the difference between indemnity and guarantee. Indemnity, loss to the indemnity holder. Loss to the indemnity holder is a key point. The purpose why people enter into the indemnity contract, to save from the loss. And the purpose why guarantee arrangements will take place, for the purpose of getting loans, for the purpose of getting contracts. So under guarantee contract, the purpose is, getting a loan or getting a contract from another party. So purpose is different. Purpose is entirely different. And under indemnity, you can see two parties, indemnifier, indemnity holder. Whereas coming to the contract of guarantee, you will find three parties, principal debtor, creditor, and surety. Under indemnity, you can see only one contract between indemnity holder and indemnifier. But coming to the contract of guarantee, you can find three contracts. Main contract, loan contract. Next, surety arrangement. Next one, implied indemnity contract between principal debtor and surety. So under indemnity contract, both indemnifier and indemnity holder should be competent to the contract. Whereas coming to the contract of guarantee, principal debtor need not be competent person. So you just think on it, what is the main objective. So tomorrow, see, the creditor, the person who is getting promises from the surety, promisee. I'll write one more time. See, principal debtor, creditor, surety. So surety is making a promise, ma. So surety we call him as promiser, creditor we call him as promisee. Under indemnity arrangement, promiser will compensate promisee. Whatever loss promisee is suffering, promiser will compensate the loss. Yes or no? But here, just look into the case. Creditor is not going to suffer any loss. First of all, here loss is not a matter. Creditor granted a loan of 5 lakhs to principal debtor. If principal debtor makes payment, then creditor will get principal and interest. If principal debtor makes default, don't think that creditor is going to suffer loss. Creditor is having an arrangement. Creditor will file a suit on principal debtor. Creditor will definitely recover that amount from principal debtor, but it will take time. To avoid that situation, what creditor is expecting? Creditor is expecting a guarantee from some third party. So now yes is yes is giving a guarantee. So if tomorrow if principal debtor makes default, definitely what creditor will do? He will recover that amount from yes. And whatever amount yes paying to creditor, surety paying to the creditor, it is a loss to the surety, and loss to the surety will be compensated by principal debtor. So this comes under indemnity, and whereas this arrangement between surety and creditor comes under guarantee. So both are different, ma. Guarantee, it is with respect to third party performance, third party liability. Coming to the indemnity contract, loss to the indemnity holder. See, both are contingent. Ultimately, both are contingent. Guarantee contract is enforceable only if principal debtor makes default. Indemnity contract is enforceable only when a loss to the indemnity holder becomes certain. Understood, everyone? And then we had two types of guarantees. One is specific guarantee. The other one is continuing guarantee. Specific. Next one, continuing. The guarantee given to the identified transaction or specified transaction, we call it as specific guarantee. The guarantee given to the series of transactions, series of distinct transactions, then we call it as continuing guarantee. Generally continuing guarantee, yes, certain time period will be given, certain time period will be given. Say for example, one day P went to C shop, principal debtor went to one Charan shop, kirana stores, and yes is also present at that situation. Now yes is making a promise to C like this, allow principal debtor to make a purchase of some some grocery items, so worth how much? 4,000 rupees. If principal debtor fail to pay this amount, I will definitely pay you 4,000 rupees. So for this single transaction, for this identified transaction, so then that guarantee is treated as specific guarantee. Suppose surety is making promise like this: allow principal debtor to purchase from you for the next 3 months. Whatever purchases he is going to make from you the next 3 months, and whatever amounts he is going to make a default, definitely I will pay you that amount. I will pay the amount. Now here guarantee is given for the transactions which will happen in the next 3 months, so we call it as continuing guarantee. Simply series of transactions, you can observe series of transactions under continuing guarantee, whereas identified transaction, specified transaction under specific guarantee. Difference is very easy to understand, specific guarantee here, at the point of at the time of giving guarantee only, surety can assess his liability. Single transaction, right? Identified transaction, right? If principal debtor makes default, then surety is liable for the transaction amount. How much? 4,000 rupees. But coming to the continuing guarantee, until the time period gets expired, until the time period is lapsed, and for how much amount principal debtor made a default, for that amount surety is liable. So here surety's liability will be determined after completion of the time period. So at the time of giving guarantee, surety can't assess his liability. So these are the differences between specific guarantee and continuing guarantee. And one more main difference is revocation. Specific guarantee can't be revoked, whereas continuing guarantee can be revoked. Say for suppose 1 month completed, principal debtor position is not at all good, is not in a sound position, he's almost his financial position is not sound. So now what surety can do? Surety can go to creditor and surety can order creditor. So simply, sir, whatever guarantee I gave you for 3 months, 1 month completed, right? So now I'm revoking this guarantee. For all the transactions happened till date, I'm liable if principal debtor makes default. And for future transactions, next 2 months transactions, I'm not concerned. I'm not liable to you. So like this, revocation is possible under continuing guarantee. So very simple point. So revocation, where it is possible, specific guarantee or continuing guarantee. So revocation is possible under continuing guarantee. Revocation is not possible under specific guarantee. Understood, ma? Next concept is nature and extent of surety liability. Nature and extent of surety liability. Come on, my dear students, tell me, what is the nature of surety liability? What is nature of surety liability? Nature and extent of surety liability. So as usual, we are having three parties: principal, debtor, creditor, and surety, right? So tomorrow, uh, sorry, listen to the example. Creditor gave him a loan of 5 lakh rupee. Principal debtor will pay him 5 lakhs plus interest periodically. So for suppose 1 year, for 1 year interest is approximately 1 lakh rupee. So after 1 year, principal debtor is liable for how much amount? 6 lakh rupee. So just tell me the nature of principal debtor's liability. Is it primary or secondary? Sir, primary. Primary. He is the first party liable to creditor. Out of principal debtor and surety, tell me who is the first party liable to the creditor? Obviously principal debtor. Why? Who borrowed the amount? Principal debtor borrowed the amount. So principal debtor primarily liable to the creditor. In the event of principal debtor default, then surety is liable. Are you getting my point? So when surety will get liability? If principal debtor makes default. So that's what, secondary and conditional. Secondary and conditional. Principal debtor liability is primary and unconditional, ma. First, principal debtor is liable without any conditions, primary and unconditional. After principal debtor, who is liable? Surety. If principal debtor makes default, then surety will be liable. Surety liability begins. Are you getting my point? So that's what secondary. And why I wrote conditional, sir? Yes, it's a conditional liability only. If principal debtor makes default, then surety liable means it's a condition. It's nothing but condition. So nature of surety liability under contract of guarantee is secondary and conditional. And to what extent, sir? To what extent surety is liable? In the absence of contract to the contrary. In the absence of contract to contrary, for whatever amounts principal debtor is liable to surety. That means, principal amount 5 lakhs, interest amount 1 lakh. Principal debtor made a default. That's why, creditor sued principal debtor. So thereby, suffered legal expenses. He incurred legal expenses of say for example 10,000. Now principal debtor is liable to reimburse this amount also. Actually principal debtor is liable to pay 6 lakhs 10,000 to the creditor. So total how much expenses, linked expenses or connected expenses 10,000, total 6 lakhs 10,000. Now the surety liability is also 6 lakhs 10,000 towards creditor. So the technical word given to the situation, technical word with respect to the liability of surety is coextensive. Coextensive means what? To what extent a principal debtor is liable, for the same extent surety is also liable. For whatever amounts principal debtor are liable to the creditor, for all those amounts surety is liable to the creditor. Technically speaking, coextensive. If principal debtor is discharged, automatically surety also gets discharged. Of course, this general rule of coextensive liability is not applicable in two cases. One is, when debt becomes a time bar. Suppose, this debt, the debt which principal debtor borrowed from the creditor, imagine, 3 years completed without payment of a single rupee. 3 years completed from maturity date. During this time period, principal debtor didn't pay a single rupee in the form of interest, in the form of principal. So the debt becomes time barred. The moment the debt becomes time barred, principal debtor gets discharged. However, surety is still liable. Surety liability won't comes to an end. And second situation, if principal debtor become insolvent, a person will be disqualified under the law. So insolvent person, obviously he will come out of all his obligations. So now the principal debtor will be released. The principal debtor will be discharged. However, surety's liability still continues. So what is the general rule? I am telling you once again. The general rule is surety liability is coextensive with that of principal debtor. If principal debtor is discharged, automatically surety gets discharged. But the point is, if principal debtor is a minor, if principal debtor becomes insolvent, if the debt becomes time barred, in these situations, principal debtor will be discharged. However, surety is still liable to the creditor. So this is what nature and extent of surety's liability. Of course, I use the word in the absence of contract to contrary. Suppose surety is making a promise like this: sir, tomorrow if principal debtor makes default, I am liable to you to the extent of 5 lakhs only. I'm not liable for interest. I'm not liable for legal expenses. If he is able to restrict his liability, then surety liability will be restricted to that amount only. So in this example, surety liability is just 5 lakhs only. Suppose all these terms are not there. In the absence of contract to contrary, surety is liable for 6 lakhs 10,000 rupees to the creditor. Are you all getting my point, students? Next concept is discharge of surety. Discharge of surety. Very important concept. You can't expect a question paper without a question from discharge of surety concept. If a question comes from guarantee arrangement, definitely that question will come from discharge of surety only. Surety will be discharged in 3 situations. One is, a revocation, which is applicable only with respect to continuing guarantee. Specific guarantee can't be revoked. See, this revocation happens in 3 ways. One is notice. Surety giving express notice to the creditor. Surety is giving notice to the creditor. Sir, I am withdrawing my guarantee arrangement. So for all the transactions happened till date, transactions already happened, I'm liable to you. But future transactions, I'm not liable to you. Like that, by giving notice, he can discharge himself from the future liability. Next one, death. Yes, death of a surety automatically leads to the termination of guarantee arrangement. Here, no need of giving notice, death of the surety, automatically contract of guarantee comes to an end. Transactions happen till the date of death. Surety estate is liable to creditor. Surety estate is liable to the creditor because surety already deceased, right? You can't find surety. You can't call surety. Surety come down, pay the amount to the creditor. It's not possible. You're getting my point. So in case of death, future transactions subsequent to the death, surety estate is not liable, but transactions happen till the date of death, surety estate is liable to the creditor. And third one is novation. You all know novation means new contract in the place of old contract, right? That new contract may be with modified terms and conditions between same parties, or between different parties with same terms and conditions. Say for suppose principal debtor borrowed amount from creditor and this arrangement was guaranteed by yes. So after 1 month, yes told to the creditor, sir, I'm leaving this country, sir. You don't worry, in my place Mr. N will support this guarantee arrangement. So I'm just coming out of this arrangement, whereas N will accept the arrangement, sir. So tomorrow if principal debtor makes default, don't worry, N is going to pay that amount to you. So this is simply a novation, a new contract in the place of old contract. So under old contract, S is liable, so S is getting discharged. And the liability of N will be continued. Understood? So revocation, notice, death, novation, old surety gets discharged. The next one is creditor conduct. Because of by the act of creditor, surety is going to get discharged. So what are those cases, sir? Loss of security, variance, compounding arrangement between principal debtor and creditor without consent of surety. So if you look into these cases, loss of security. So for getting this loan amount, if principal debtor pledge any property with creditor, and creditor is negligent, as a result the security which was kept by principal debtor lost. Now to that extent principal debtor is discharged, and to the same extent surety also gets discharged. Are you getting my point? Suppose principal debtor got 5 lakhs by giving a gold, ornaments, pledge value is just 4 lakhs. Gold value is 4 lakhs. This creditor is negligent and he lost the entire gold which was pledged by principal debtor. Now the point is, to the extent of 4 lakhs, surety also gets discharged, and for balance amount only surety is liable. Next one, variance. Variance is nothing but modification in terms and conditions. As you all know, contract of guarantee requires consent from three parties. Who are the three parties? Principal, debtor, creditor, and surety. Only when these three parties give only when these three parties are having a consent, then only contract of guarantee is valid, or else it is invalid. Now the point is, at the time of guarantee, certain terms and conditions are there, but subsequently, principal, debtor, and creditor entered into an arrangement. They modified the terms and conditions without consent of surety. Now this is nothing but variance. To this variance, if creditor is not getting consent from surety, then contract of guarantee stands revoked. Surety gets discharged. Surety gets discharged. And next one, compounding arrangement. But in variance we had a exception also. If that variation is beneficial to the surety, or if that variation is not substantial, if it is not having any negative impact on the surety, then surety liability will be continued. We are having a case study on it, Anirudh versus Tomco Bank. You just refer that case study. You may get practical question on that case study. Understood. Next one, compounding arrangement between principal, debtor, and surety. What is this compounding arrangement, sir? What is this compounding arrangement? See, principal, debtor, and creditor entering into an arrangement. The result of the arrangement is, debt reduction, composition of the debt, or extension of the time, or creditor agreeing not to issue principal, debtor. Creditor simply, he is removing the legal enforceability. If any of these things happen without consent of the surety, composition of the debt, extension of the time, no legal enforceability, then surety automatically gets discharged, because surety right is getting affected. And last point is release of principal, debtor. So when principal, debtor is discharged, automatically surety gets discharged. We are having a practical case study, a practical example with respect to this point, that is, Mr. P and C entered into a contract with respect to construction of house. So Mr. P made a promise that he is going to construct the house, and C made a promise that he will supply necessary materials for construction, and this arrangement was guaranteed by surety. Yes, gave a guarantee. The creditor failed to supply the materials for construction. So this is a mutual and dependent contract where one party promise depends upon other party performance. One party performance depends upon other party performance. So here creditor omitted to supply materials for construction of the house. As a result, principal, debtor gets released. Principal, debtor gets discharged. The moment principal, debtor gets released, surety automatically gets released, or surety automatically gets discharged. Understood. And the last one is invalidation of contract. Invalidation of contract. So for suppose, when a contract of guarantee is obtained by way of misrepresentation or by way of fraud, then contract of guarantee becomes invalid. So the terms, creditor should communicate with surety in a clear manner, in a transparent manner. Any of the terms, if creditor is making a concealment of facts with a view to obtain consent from the surety, or if creditor making a misrepresentation, simply, is changing the mind of surety simply by communicating wrong terms, or by hiding the material terms, simply, concealment of facts, which comes under fraud, or giving correct information in a wrong manner, in another manner, simply, a statement which will give you, or which you can understand in two ways, simply, misrepresentation. So make you simply misleading the context. Appropriate word is misleading the context. If a consent of surety is obtained by way of misrepresentation or fraud, then contract of guarantee becomes void. It's no more a contract, it's a void arrangement. Accordingly, surety is not liable, surety gets discharged. And last one, co-sureties. Co-surety. If any one of the co-surety fail to join guarantee arrangement, suppose, what is meant by co-surety, sir? Generally, a guarantee may be given by a single party. Imagine if two or more parties are giving a guarantee to the same arrangement, whether knowingly or unknowingly, then we call them as co-sureties. So co-sureties nature of liability is joint and several. And moreover, in an agreement, there is a term that all the co-sureties should sign the guarantee arrangement, or else guarantee is invalid. Now, S1, S2 both signed the arrangement, but S3 failed to join the arrangement. Now, this contract of guarantee becomes invalid. It is no more a valid contract. Understood? So, in this way, also remaining co-sureties gets discharged. So, discharge of surety by way of revocation, by way of, by the conduct of creditor, and by invalidation of the contract. And we are finally left with a small topic, that is rights of surety. Rights of surety. So he will have rights against three parties. One is, principal debtor, the next one creditor, the other one is co-sureties. Co-sureties. So rights against principal debtor is subrogation as well as indemnity. Indemnity. As you all know, indemnity already completed. So tomorrow, if principal debtor makes default, definitely who will compensate creditor? Sorry, who will pay the amount to the creditor? Sir, surety will pay amount to the creditor. Now it's a loss to the surety. It's a loss to the surety. So surety is loss. Who will compensate, sir? Principal debtor is going to compensate. Principal debtor is going to compensate surety. So yes, there is an indemnity. That means surety can claim indemnity from principal debtor. One thing. Subrogation. Subrogation means simply changing the position. Subrogation means simply changing the position. In a loan contract, suppose P and C are there. Mr. P is a debtor and Mr. C is a creditor. Tomorrow, suppose if debtor makes default, debtor make a default, then C will get all the rights against P. C can sue P. C can arrest P. C can file an petition with in court. Court may order to arrest P if the debt is huge amount and if P is trying to escape from the situation. Are you getting my point? So as a creditor, he will have many rights on the debtor. Now suppose this was guaranteed by surety, contract of guarantee. The moment principal debtor makes default, creditor can come and creditor can take that amount from surety. So if you ask me, sir, what is the time of surety's liability, commencement of surety's liability? The answer is the moment the principal debtor makes default. That's it. No need of giving notice, no need to file any case on the principal debtor. The next minute onwards, the next second onwards, surety liability gets started. Creditor can recover that amount from surety. So now the moment surety pay the amount to the creditor, creditor will come out of the position and surety will take the creditor position. Surety will take the position of the creditor, simply changing the position. So now surety is stepping into the position of creditor. Surety will get all the rights over principal debtor. That's what subrogation means. So rights of surety against principal debtor, subrogation. Next one, indemnity. Now rights of surety against creditor. So right to claim all the securities which principal debtor pledged with creditor, or right to claim all the securities which were mortgaged by principal debtor with the creditor. Suppose if creditor loses any security, then to that extent surety gets discharged. Already we discussed this point above. Next one, right to claim set off. Right to claim set off. That means, principal debtor borrowed 5 lakhs from creditor and this 5 lakhs was guaranteed by surety. This is one arrangement. Another arrangement. One day, C went to P shop and C purchased some materials, some goods worth 1 lakh rupee from P. So this is different arrangement. P is the seller, C is the buyer. So P is having a business. In that business, C purchased goods on credit worth how much, sir? 1 lakh rupee. 1 lakh rupee. And under first arrangement, you already know P is liable to creditor. How much, 5 lakh rupee. On the due date, on the maturity date, principal debtor made default. Finally, creditor came to the surety. Sir, he made a default of 5 lakh rupees, sir. So how much amount, surety is liable to the creditor? It's not 5 lakhs, 5 lakhs minus, he can claim set off. Sir, but these are two different arrangements, no sir. This is one arrangement where surety is a party to this arrangement, and second arrangement, surety is not a party to the contract, no sir. No problem. Lawmaker is giving a power to the surety to claim set off. Any dues, creditor is having any due towards the principal debtor or towards the surety is having a right to claim set off. So after claiming set off, 5 lakhs minus 1 lakh, that means surety is liable for 4 lakhs only. Surety is liable for how much amount? 4 lakhs to the creditor, and surety will recover 4 lakhs from the principal debtor. That's what set off. Next one, co-sureties, rights against co-sureties. Suppose S1, S2, S3 co-sureties are there. S1 paid complete amount to the creditor, Now S1 will have a right to recover amounts from S2 S3 in equal ratio if nothing is specified, if anything is specified in that ratio. So one co-surety is having a right to recover other co-sureties portions from other co-sureties. If any one co-surety discharge the complete liability of principal debtor, then co-surety 1 can recover share of liability from other co-sureties. Understood? So this is what rights of surety. So just look into the material ma. We discussed the definition of contract of guarantee, and we discussed the number of contracts under contract of guarantee. So we discussed parties, who are the parties to the guarantee. So consideration, I told you, consideration to Mr. Surety is anything done or any promise made for the benefit of principal debtor is a sufficient consideration to the surety. Next one, essentials and legal rules. All these points we discussed. uh, Writing not necessary, joining of other co-sureties, misrepresentation, concealment, consideration. So now and then we discussed indemnity versus guarantee. So indemnity, the crux of indemnity is to save the other from loss, whereas the crux of guarantee is to discharge the liability or to perform the promise of third party in the event of third party default. Are you all getting my point, students? A number of parties, 2 under indemnity, 3 under guarantee. Scope, it's a narrower, whereas guarantee wider, broader. A nature of liability, indemnifier liability is primary, whereas surety liability is secondary and conditional. So time of liability, indemnifier liability begins with loss to indemnity holder becoming certain. Understood? Next one, with respect to the guarantee, if principal debtor makes default, surety liability gets started. Is it clear, ma? Purpose, indemnity purpose, reimbursement of loss. Creditor, security. Under guarantee, it's a security. Competency, I discussed. Both the parties should be competent. Whereas under contract of guarantee, principal debtor can be minor. Principal debtor can be, disqualified person. Number of contracts under indemnity, we are having one contract. Whereas under guarantee, we are having 3 contracts. Next, we discuss types of guarantee: specific, continuing, single transaction or identified transaction, specific guarantee; series of transactions, continuing guarantee; revocation is possible only under continuing guarantee. I'm requesting you all to read these examples thoroughly. So there is a probability that these examples will be asked as a question, practical question in your exams. Next one, we discussed, surety's nature of liability, secondary, and extent of liability coextensive. Commencement of surety liability: the moment principal debtor makes default, surety liability gets started. Will the surety liability be continuous? It depends. Under continuing guarantee, it will be continuous. Under specific guarantee, the moment principal debtor gets discharged, surety also gets discharged. Surety is not concerned with the subsequent transactions. Next one, we discussed rights of surety also, and then we discussed rights of surety against principal debtor. So next, right against creditor. What are the rights against co-sureties? We discussed this point also, equal ratio or in different sums, different amounts. When surety gets discharged, I already told you, revocation, conduct of the creditor, and validation of the contract of guarantee. So with this contract of guarantee, completed ma. The next topic is bailment and pledge. So beginning with contract of bailment. Just look into the example. I'm having a mobile ma. It underwent some repair. So I went to a repairer who can repair my mobile. So what I did, I delivered a mobile to Mr. R. So what I did, a delivery. So what I delivered, mobile. Sir, any reason? Yeah, there is a reason. The reason is a repair. So repair completed ma. He called me. I went to his shop. What he did, he returned mobile to me. So two options are possible actually. Once repair is completed, he called me. I visited the premises. He told me, sir, definitely within 1 or 2 weeks, definitely this mobile will undergo a repair, sir. So this problem exists in all these kind of mobiles, sir. So it's up to you. I simply told him, no, 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 no. Just sell that mobile on my behalf. Sell my mobile on my behalf. Now what Mr. Repairer is doing, is disposing of the mobile on behalf of me. So this is nothing but a bailment contract. So what is meant by bailment? It's a contract under which one party delivers goods to another. Delivers goods to another for some purpose. When the purpose is accomplished, that means, when the purpose is completed, he may return the goods or he may dispose of the goods according to the instructions of person delivering the goods. And the person who delivered the goods, we call him as bailor. And the party to whom goods are delivered, we call him as bailee. The goods of the bailment, we call it as bailed property. Bailed property. And the entire transaction, we call it as bailment. Knowingly, unknowingly, many of us have encountered this kind of contracts, mobile repair, bike repair, anything, all this comes under bailment contracts only. So bailment is a contract under which one party delivers goods to another for some purpose. After completion of purpose, the goods shall be returned or disposed of according to the instructions of bailor. So tell me, who are the parties to the contract of bailment? Bailor, the party who delivers the goods, and the bailee to whom goods are delivered. Bailment is applicable only to the movable properties because it is applicable only to the goods. What is meant by goods? Goods includes all kind of movable properties. It excludes money and actionable claims. Understood? So delivery. Under bailment contract, this delivery is of two types. One is actual delivery. The other one is constructive delivery. Of course, we are having symbolic delivery also, but from our study material point of view, we are having actual and constructive delivery. Actual delivery, physical possession of the goods getting transferred to other party. Actual delivery. Constructive delivery, no change in possession, but the delivery is said to be completed. We call it as constructive delivery. Now under actual delivery, physical possession, you will observe physical possession getting transferred. Whereas constructive delivery, there is no change in physical possession. Possession remains same, but the delivery is said to be completed. We call it as constructive delivery. Suppose, mobile repair. What I'll do, I'll hand over a mobile physically to the repairer. Actual delivery. Constructive delivery. So for suppose, I'm having a car, it underwent a repair. It is almost 10 kilometers away from the repairer shop, mechanic shop. So I told to someone, please look after my car. And I went to the mechanic. I told, so there is my car on so and so highway. Just go and repair it. Now the party, who is taking care of my car, he made an acknowledgement, sir. Just come and look at the car. So simply by way of acknowledgement, I'm telling you, by way of acknowledgement, the delivery is said to be completed. We call it as constructive delivery. So previously, before I enter into the bailment contract, car is at one location. Even after entering into the contract also, there is no change in possession of the car. Previously the car is at one location, now also car is in the same location without change in possession. If delivery is said to be completed, such kind of delivery we call it as constructive delivery. The best example is sale and lease back. It's not required right now. So sale and lease back, nothing but I will sell my product and I'll take the same product on lease basis. Of course, rental contracts, renting of mobile properties comes under bailment contract only. I went to Hyderabad. Suppose, I went to Hyderabad. I took one car on rental basis. So I agreed to pay rent for one day. After completion of one day, what I'll do? I'll return car to the owner. So it's a bailment contract, delivery of car purpose, on rental basis for one day. The moment one day gets completed, I'll return it. So this is also a bailment contract. Renting of mobile items comes under bailment contract. Are you getting my point? So if you look into the same example, I'm selling the car. It's a sale which will be covered under sale of goods side. And I'm taking same car on rental basis. Before taking same car on rental basis, the car is lying with me. And after entering into the rental agreement also, the car possession doesn't change. It still remains with me without change in possession. If delivery is said to be completed, how delivery is said to be completed? Just by acknowledgement. Sir, I'll hold this thing on behalf of you. Just by acknowledgement. By acknowledgement, if delivery is completed, we call it as constructive delivery. So sale and lease back. The same product, the product which I'm selling to you, I'm going to take same product on rental basis. So before taking on rental basis, I'm having the possession. After entering into rental agreement also, I'm having the possession. I already told you, rental contracts comes under bailment contracts. Now in this example, before entering into bailment contract, car remains with me. After entering into the bailment contract, car remains with me. But after completion of rental period, I'll return the car to you. The point is, at the time of bailment contract, delivery is completed. Is there any actual change in possession, sir? No. No. But by acknowledgement, yes, sir, I'll hold car on behalf of you and I'll take same car on rental basis. So simply by acknowledgement, delivery is completed. We call it as constructive delivery. So delivery is of two types. Next one, ma. When the purpose is next one. So goods bailment is applicable only with respect to movable property, and the purpose might be anything, ma. It should be communicated one. It should be intended one. Should be intended one. It can be either express or implied. It can be oral or in writing. So there should be some purpose. Without purpose, bailment contract won't come into the picture. Next one, even taking care of goods will also comes under a purpose. Suppose I'm a diamond dealer, I'm a diamond trader. Suddenly I got a call from one of my relative. I need to go to the relative premises. I can't carry these diamonds, so I called my neighbor. I told, so please hold these diamonds on behalf of me. Please take care of my diamonds on behalf of me. I'll return within a week. Once I get back, I'll take all these diamonds, sir. Now, if you observe, yes, the purpose is taking care of the goods. It will also comes under a valid purpose only, and this is also a valid bailment contract. And once the purpose is completed, bailey is bound to return the goods, or bailey is bound to dispose the goods according to the instructions of the bailor. Here, you just observe, bailment contract is different from sale contract. Bailment contract is different from general contract. How? Under sale contract, you can observe delivery happens to the ownership, but here delivery happens to the possession. Delivery happens to the possession, not mere custody, possession. Possession is different, custody is different. Custody means simply, you will have a physical custody. You can't use the goods. You can't control the goods. Are you getting my point? Suppose, my mobile underwent some repair. So I locked the mobile. Without any intimation about the lock. I'm just simply keeping this mobile in the hands of the repairer. Sir, he can't use this mobile, or he can't repair the mobile unless he know the lock. Or suppose I'm giving the bike for repair and I'm locking the bike, so keys with me. So now I'm simply giving the custody. I'm not giving control over the goods. Possession is something, the control over goods should be transferred. Delivery of possession means delivery of control over the goods. Here delivery won't happen with respect to the ownership. Here delivery, if delivery happens with respect to ownership, it is a sale. If delivery happens with respect to custody, it is a general contract. If delivery happens with respect to possession of the property, it comes under bailment contract. Are you getting the difference between sale and bailment, and then bailment and general contract, right? So small example, valet parking comes under bailment contract, where control over the car will be transferred to the parking lot in charge. Normal parking comes under general contract. They won't come under bailment contracts. Why? The control is still lying with the owner only. And then you can see, so keeping valuable items in the bank locker, it's a general contract. It's not a bailment contract. Why? You didn't transfer any control over goods to the banker. The delivery should happen to the possession in order to call that contract as a bailment contract. Is it clear, ma? Everyone? Next thing. So we completed, delivery, goods, purpose, and first of all, in order to call something as a bailment, it should be a contract. So agreement which is enforceable by law, it becomes a contract, right? Suppose, I'm having a brown sugar. I call my friend and I am asking him, please take care of this brown sugar for 1 week. The next week when I come back, you just return that brown sugar to me. Now, is it a bailment contract, sir? No, definitely not a bailment contract. Why not a bailment contract? It is unlawful. It's illegal. Understood? So bailment is applicable only with respect to only legal contracts. Understood, my dear students? Next one, all the essentials we already discussed, ma. Bailment, it should be a contract. Contract can be either express or implied. So bailment is also an bailment. Also, you can see express bailments, implied bailments. Example for implied bailment, finder of lost goods. The purpose is finding out the true owner until true owner was traced. So the finder of lost goods should take care of the goods. So finder of lost goods comes under the example of implied bailment contracts. Next thing, delivery. Delivery can be either actual or constructive, but delivery should happen only with respect to possession. Next, bailment is applicable only with respect to goods, and there should be some purpose. The purpose should be communicated one. And at the end of the contract, once the purpose is finished, completed, Bailey is bound to return the goods. So what type of goods are same goods or other goods? If Bailey is returning, sorry, if the second party is returning some other goods, it won't comes under bailment contract. It comes under exchange contract. Exchange contract. It's not a barter system, right? So under bailment, whatever the things bailor is giving to Bailey, Bailey is required to return the same goods either in original form or altered form. Original form or altered form. Suppose I'm giving a i13 Pro, Apple i13 Pro mobile for repair. In return, I should get Apple i13 Pro. My mobile only I should get back. I should not get i14, i15. Simply if I'm getting i14, it comes under exchange agreement. Next one, sir, I'm giving a red color cloth to the tailor for the purpose of stitching. So once purpose is completed, I should get back shirt of red color only. If I'm getting some other color, it won't come under bailment. So in my second example, this is I'm getting same product in altered form. Cloth. Next one, shirt. If you look into the first example, I'm delivering mobile. In return, I'll get the same mobile in original form only. So the return of goods should be of same goods, either in original form or altered form. Next one, types of bailments. So we are having two types of bailments based on the consideration. Based on the consideration point, bailments are classified into two types. One is gratuitous bailment, the other one is non-gratuitous bailment. Sir, a bailment without consideration, gratuitous bailment. Bailment is of two types, gratuitous, non-gratuitous. So without consideration, the consideration means something in return. Both the parties should have something in return, right? If any of the party is not getting something in return, then there is no consideration. So this gratuitous bailment again classified into two types. One is for the benefit of bailor, for the exclusive benefit of bailor. Next one, for the exclusive benefit of Bailey. Under non-gratuitous bailment, it's a mutual benefit of bailor and Bailey. Mutual benefit of bailor and Bailey. So example, so for the benefit of bailor, see, I'm having a gold ornaments, I'm having a diamonds. Suddenly I need to go to other country. So for 1 week I'm not available. For the next 1 week I'm not available. Now I called my neighbor and I asked him, so please preserve my goods, please take care of my goods. So here, in this arrangement, my neighbor is getting nothing. However, my goods will be protected for the next week. This is for the benefit of bailor. Next, for the benefit of Bailey. For the benefit of Bailey. See, I'm having a car. One day my friend called me and asked me, sir, Mr. V, please give me your car for 2 days. Yes, I gave car for 2 days, ma. Do you think will I charge money? No. Friend, no. Free of cost. I gave car to him for 2 days. Now in this arrangement, yes, there is a bailment contract between me and my friend. I delivered car to my friend, bailment. After completion of 2 days, my friend is going to return the car. But the point is, this arrangement, who is getting benefited, sir? Bailey is getting benefited. My friend is getting benefited. Bailey is getting benefited. Non-gratuitous bailment. Suppose, I'm having a car rental business. I'm having some 10 cars. Anyone can come and take car on rental basis. So one of the customer came and he paid me money for 10 days. He took car for 10 days. Now, I'm getting, bailor. I'm delivering the goods. I'm getting rent amounts and he's getting car for next 10 days. He's getting control over car for next 10 days. Both the parties are getting benefited. So it is non-gratuitous bailment. Understood? So these are the types of bailment. Next one, in a bailment contract, we are having two parties, bailor, Bailey. In every contract, parties will derive certain duties and certain rights. Similarly, in bailment contract also, parties will derive duties. So now let's discuss those duties, As you all know, duty of one person is a right to another person. Duty of another person is a right to the first person. Initially, parties will get duties. If any duty gets violated, if the party defaults with respect to any duty, it becomes right to another person. So another person will have a right over the first party. Suppose Shrestha promised you to deliver classes on timely basis, and you promised to pay fees on timely basis. Suppose you paid fees, we failed to deliver the classes. Now you can sue us. So you'll get right only when we makes default with respect to our duty. Similarly, we are providing you classes, and if you're not paying money, so we can stop you from watching the classes. So we will get right to stop you from entering into the classes only when you violates your duty with respect to payment of fees. So initially parties will get a duty. If any party violates the duty, if any party makes a default with respect to his duty, it becomes right to another party. Okay, we are having two parties in bailment contract, bailor, bailee. So let's begin our discussion with duties of bailor. Duties of bailor is nothing but rights of bailee. Yes or no? Rights of bailee. Duties of bailor equal to rights of bailee. So what are the duties? First one, disclose faults in goods bailed. Disclose faults in goods bailed. Whatever goods bailor is delivering goods to bailee, bailor is bound to disclose all the faults in the goods. Sir, violation. Simply bailor failed to disclose faults in the goods. In that case, just observe what is the type of bailment. Is it a gratuitous bailment or non-gratuitous bailment? Sir, gratuitous bailment, sir. Bailor is liable to bailee for all the losses that arising due to non-disclosure of known faults. Non-disclosure of known faults. Coming to the non-gratuitous bailment, bailor is liable to bailee for non-disclosure of both known as well as unknown faults. Unknown faults. For example, suppose I'm having a car, the brakes are not working. I know this. My friend asked me. So every time he called me and he will take a car. Suddenly, I got vexed with this person. I didn't disclose that brakes are not in good condition, and I gave car to him. Finally, he met with an accident. Total hospital bill 10,000 rupees. Now, as a bailor, I'm liable to compensate him. How much? 10,000 rupees. Why? I didn't disclose the known defects in the goods bailed. Understood? So, in case of gratuitous bailment, bailor is liable for non-disclosure of known faults in the goods. Coming to the non-gratuitous bailment, this time, I'm running car travel agency. So here I'm liable for both known as well as unknown defects. Why? The reason is, see, I'm charging some amount, I'm getting consideration. Now it's my responsibility to check whether goods are in consumable position or not, whether goods are in a good position or not. It's my responsibility. I violate, I didn't performed, I didn't fulfill my responsibilities, so you suffered loss. So for these losses I'm liable to you. So conclusion, bailor is liable for non-disclosure of known faults in case of gratuitous bailment, and bailor is liable for all the faults, for known as well as unknown faults. Bailor is liable to bailee for non-disclosure of both known as well as unknown faults. One thing, if bailee suffer any loss, then only bailor is liable to compensate bailee. Implied indemnity contract under bailment contract. So disclose faults in the goods bailed. Next one, duty to reimburse the expenses. Duty to reimburse expenses. For the purpose of bailment, whatever expenses bailee incur, bailee suffer, all those expenses bailor should compensate bailee. Suppose I'm having a mobile which underwent a repair. The screen is not working. The screen is not working properly. So I delivered this mobile to the repairer. I asked him to replace the screen. So for replacing the screen, he incurred 1,000 rupees expenditure. Now, who is responsible with respect to the 1,000 rupees? Bailor is liable to bailee. Understood? Next one, reimburse extraordinary expenses. Reimburse extraordinary expenses. See, expenses, I'm going to classify into two types: ordinary, extraordinary. Ordinary means day-to-day expenses. Extraordinary means non-recurring expenditure. See, I'm running a car travel agency. So I'm giving cars on rental basis. Now listen carefully. So I delivered car on rental basis for 10 days. Mr. Customer came to me and he took car for 10 days. With respect to car, you can see expenses are of two types: ordinary, extraordinary. Fuel expenses, air filling expenses, all this comes under ordinary expenses. Suppose suddenly car underwent some repair expenses, simply mechanic expenses. This comes under extraordinary expenses. Extraordinary expenses. So the point is, whose responsibility is to bear ordinary, whose responsibility is to bear extraordinary expenses is the question. So general rule, it is the duty of bailor to incur extraordinary expenses. Why? Because the property belongs to the bailor. Of course, bailey should act as a man of ordinary prudence. Bailey should act as a man of ordinary prudence. If bailey is negligent, because of that only bailor suffered a loss. In that case, definitely bailey should incur these extraordinary expenses. I'm telling you, in the absence of contract to contrary and everything is silent, bailey is acting as a man of ordinary prudence. He's taking a reasonable care of goods bailed. Now whose responsibility to bear extraordinary expenses? That is Mr. Bailor. So whatever the expenses incurred by bailey in getting repair of the car, in getting repair of the goods, so all these extraordinary expenses bailor should compensate bailey. And coming to the ordinary expenses like air filling, oil filling, all these bailey should take care of this. Why? Because the purpose is of bailey only. Bailey decided the purpose. When I'm giving car on rental basis for 10 days, I don't know how many kilometers he will travel. Moreover, I am charging only the amount. I'm charging the amount only for providing car on rental basis, not for fuel as well as air. So air expenses, fuel expenses, everything bailey will incur. Bailey has to incur. And repair charges bailor. Next one, my dear students. Here there is a concept with respect to ordinary expenses. Sometimes bailor should incur these ordinary expenses. So here I am classifying the bailment into three types. One is for the benefit of bailor. For the benefit of bailor. Next one, for the benefit of bailey. And next one, mutual benefit. Mutual benefit. And I'm making a classification, ordinary expenses, extraordinary expenses. Listen me carefully. So if it is for mutual benefit, ordinary expenses bailey. Extraordinary expenses in all three situations, bailor only. It is the duty of bailor to reimburse extraordinary expenses whatever incurred by the bailey. So coming to the ordinary expenses, mutual benefit, bailey has to incur air filling, oil filling, bailey has to incur these expenses. So for the benefit of bailey has to incur these expenses. But if it is for the exclusive benefit of bailor, then bailor has to compensate bailey for ordinary expenses. Example, I'm having a dog at my home, and I got a call from Institute Delhi. Now I need to attend Delhi. I need to take up some classes for the next 1 week, and it is not possible for me to carry my dog along with me. So I called my neighbor. I told, please take care of my dog. So dog, being a living thing, definitely it will eat something. So my neighbor spent daily 500 rupees on feeding charges, on feeding. So 1 week completed, 7 days, 3,500 rupees. Generally, feeding expenses comes under ordinary. So they are regular in nature. They are day-to-day expenses. Yes or no? So in this bailment, if you observe, is it for the benefit of bailey? Is it a mutual benefit, or will it come under the exclusive benefit of bailor? The answer is exclusive benefit of bailor. My neighbor didn't charge a single rupee from me. So now my dog, feeding charges, which comes under ordinary expenses, whose responsibility to bear these ordinary expenses? Bailor. Suddenly, the dog fell sick, and neighbor took this dog to the doctor, veterinary doctor. So he charged some fees and he gave medicines also. So this comes under extraordinary category. So sick expenses, extraordinary expenses. Who is required to compensate? Who is bound to compensate these extraordinary expenses? Bailor only. To understand, follow me carefully. Listen carefully. So with respect to extraordinary expenses, bailor is liable to bailey. And with respect to ordinary expenses, bailey should incur these expenses. But if it is a bailment, which is for the exclusive benefit of the bailor, in that case, bailor should incur this ordinary expenses. Understood, ma? Next one. Compensate or indemnify bailey for premature termination of gratuitous bailment. Premature termination of gratuitous bailment. The gratuitous bailment, this is a bailment contract without consideration. There is no duty on the bailor to continue the contract for this fixed period. Even before completion of the period, bailor is having an option to terminate this contract because consideration is absent. So bailor can cancel gratuitous bailment, prematurely. But because of this premature termination, if bailee suffer any loss, all those losses bailor should compensate. So it is the duty of bailor to compensate bailee for the losses arising out of premature termination of gratuitous bailment. And next one, duty to indemnify bailee for a defective title in the goods bailed. Defective title in bailed goods. In bailed goods. See, I'm having a bike. So one day my friend called me and asked my bike. I gave the bike. So which was a stolen bike. It's not my own bike, it's a stolen bike. So my friend, when he's going on a road, suddenly police stopped him, and after upon verification came to know that it's a stolen bike, and police arrested my friend. So somehow, he paid 10,000 rupees to come out of the case. No, legal expenses only. So now whatever the loss arised due to defects in the title of the goods bailed, so my friend is having a right to recover that amount from me. So it is the duty of bailor to compensate bailee for the losses arising out of defective title in the bailed goods. So these are the duties of the bailor. One more duty. Duty to take back the goods. Duty to take back goods on completion of bailment. So once the purpose is completed, when bailee is ready to return the goods, it is the duty of bailor to take back the goods. If bailor makes any delay, as a result, if bailee suffer any, if a bailee incur any expenses in preserving the goods, those expenses bailee is having a right to recover from bailor, and bailor is having a duty to pay that amount to bailee. Are you all getting my point, students? So these are the duties of the bailor. So what are the duties of bailor? Disclose faults in the goods bailed, reimburse expenses, reimburse extraordinary expenses, indemnify bailee for the losses arising out of premature termination of gratuitous bailment, indemnify bailee for losses arising out of defective title in the goods bailed, and duty to take back the goods. Similar points, these are the rights to the bailee. Non-disclosure of faults in the goods, bailee can recover the compensation from bailor. Bailee can recover expenses incurred for the purpose of bailment. Bailee can recover extraordinary expenses from bailor, and bailee can recover losses amounts due to premature termination of gratuitous bailment, and bailee can recover amount from bailor. The reason is defective title. And if bailor makes any delay in taking back the goods, as a result, if bailee incur any expenses in preserving the goods, bailee is having a right to recover that expenses for preserving the goods from bailor. In addition to these rights, bailee is having a additional rights also, that is a lien right. I'll discuss after some time. Next point, duties of bailee. Next point, duties of bailee. As you all know, duties of bailee is nothing but rights of bailor. Sir, what are the duties of bailee, sir? Take reasonable care of goods bailed. Reasonable care. So what is meant by reasonable care? It's not absolute care, but a reasonable care. As a man of ordinary prudence, if goods belong to you, as a man of ordinary prudence, how much care you will exercise on the goods, that much care you need to exercise on the bailed goods. Why? Because under bailment, who is the owner of the goods? Bailor. But who is having possession of the goods? Bailee. So bailee is having a possession of bailor goods to which he is not a owner. Bailee is not a owner. Bailee is just having a possession of the goods. So now bailee should take reasonable care with respect to the goods which are lying in his possession. If he fails to take reasonable care, any loss arising due to negligence, bailee is liable to compensate bailor. Understood? Sometimes, even though bailee exercise reasonable care, but still, bailee is liable to the bailor. Bailee is liable to the bailor. I'll tell you example. I'm having a bike. One day my friend called me, sir, Mr. V, I need bike. I told, okay, take the bike. So he was negligent, he didn't he parked the bike and he didn't lock the bike. He kept keys with the bike only. One thief came, he took away the bike. So tell me, did he exercise reasonable care? No. So he was negligent. As a result, today I suffered a loss of bike. Yes or no? So my bike cost 2 lakh rupee. Now he need to compensate me. That is my right and that is his duty. Exceptions means what? The above general rule. What is the general rule? If Bailey exercises reasonable care, then Bailey is not liable to the bailer for loss of goods. This is the general rule. I repeat, if Bailey exercises reasonable care with respect to bailed goods, then Bailey is not liable to bailer for the loss of goods. However, exception means even though he exercised reasonable care, he is still liable to the bailer. Situations are failed to meet bailer instructions, failed to meet bailer express directions or instructions. Next one, bailment period or bailment purpose completed, bailment period expired, bailment period expired. See ma, I gave an instruction, don't park bike near to your home, or don't park bike on roads. Simply told him. I'll give you one more example. See, I'm having a diamonds. One day I called my neighbor, please take care of my diamonds. Like that, I delivered diamonds to that person. And I gave an express instruction. So don't keep diamonds at your home. Keep diamonds in SBI locker. So you deposit all these diamonds in SBI locker only. Locker expenses, I will compensate you. No, I'll pay you. I'll reimburse you. But my friend, my neighbor didn't listen to my instruction and he kept all the diamonds at his home. That day night, what happened? Thieves entered into the home and thieves looted all the diamonds. I lost the diamonds. Is Bailey liable or not liable? Liable. Sir, he took reasonable care, sir. He preserved all the diamonds in a safe manner. So Bailey should be protected. No. Bailey should not be protected. Bailey is liable to the bailer. Why? Because Bailey failed to follow the instructions of the bailer. Understood? And the second point, bailment period expired. The moment bailment period completed, Bailey is bound to return the goods. Bailey should return the goods to the bailer. Suppose, Bailey is not returning the goods, Bailey is still keeping the possession of the goods. In that case, loss of goods, any damage to the goods, even though he exercised reasonable care, for the loss of goods, Bailey is liable to the bailer. Why? Because once the period is expired, now the goods will be at the risk of Bailey only. So once purpose is completed or once the express time period is completed, Bailey should return all the goods to the bailer. Are you all getting my point, students? Next duty, not to make unauthorized use of goods, unauthorized or inconsistent use of goods. When bailer is giving an instruction or when bailer is giving a directions, so how to use the goods, bailer should use the goods accordingly. Suppose I'm running a car travel agency. I told to my customer, I clearly told him, don't drive car on hilly areas. Use car only on smooth roads so that life of the car will be enhanced. But one of the customer, what he did, he is using the car, he is driving the car on hilly areas. I came to know using GPS tracker. I came to know. Now what is the conclusion? Bailey, he made some inconsistency in using the goods. He made a promise that he won't make inconsistent use of goods, but he is not performing the promise. A promise made without an intention to perform, it is nothing but fraud. If a consent is obtained by way of fraud, then it becomes voidable at the option of aggrieved party. Yes or no? So in case of inconsistent use of goods, the contract of bailment becomes voidable at the option of bailer. Bailer is having a right to terminate the contract of bailment immediately, and bailer can recover the losses, the damages from the bailee. And the next duty is not to mix bailed property with his own goods. Not to mix bailed goods with his own goods. Suppose if mixture happened, bailed goods are belonging to the bailer. Bailee is also having a own goods. So he should not mix both the goods, ma. If mixture happened, now you need to observe whether such mixture happened with the consent of bailer or not. Sir, mixture of goods happened with the consent of bailer only, sir. Then in the total mixture, bailer and bailee will have a proportionate interest. Bailer and bailee will have a proportionate interest. See, I'm having 5 diamonds. He is having 10 diamonds. I give 5 diamonds to the bailee in order to take care of those diamonds. And I give my consent. Okay, you can mix these 5 diamonds with your 10 diamonds. Total 15 diamonds are there. So in this entire 15 diamonds, I'll get a share of 1/3 and he will get a share of 2/3. Suppose, without consent of bailer, he mixed the goods. without the consent of bailor, he mixed the diamonds. Now you need to check whether goods are separable or inseparable. They're separable, sir. Diamonds are separable. Not each and every diamond will have the same price. Some diamonds will be priced high, some diamonds will be priced very very less. Yes or no? Based on the characteristics, based on the carbon content, etc etc. Some diamonds will have more value, some diamonds will have less value. So I recruited a diamonds expert. I told him the features of my diamond. So he separated my 5 diamonds. But for this, he charged me 5,000 rupees. Now, separation charges 5,000, which bailor spent. It is the duty of bailey to reimburse the same. So, mixture happened without consent of bailor, but the goods are separable, sir. Separation charges should be borne by bailey. And damages any in the process of separation, bailor should bailey should compensate bailor. In the third situation, separation, mixture happened without consent of bailor, sir, and the goods are inseparable, sir. Goods are inseparable. In that situation, treat that entire loss of bailed property, and for the entire loss, bailey is liable to compensate bailor. Understood, ma? So you need to check. You need to check whether mixture happened. If it is with the consent of bailor, with the consent, in that case, proportionate interest. Proportionate interest. Both bailor and bailey shall have a proportionate interest in the mixture. Sir, without consent of bailor, sir, without consent of bailor. In that case, you need to check whether the goods are in a separable position, separable state or inseparable. Separable. So separation charges. Who should bear separation charges? Tell me, who should bear separation charges? Bailey. In case of inseparable, for entire loss of goods, treat that entire loss of goods. The goods were lost. And for this entire loss of goods, bailor will get compensation from bailey. Bailey should compensate bailor. Understood, ma? Next duty. Bailey should return the goods upon expiry of the purpose or upon the expiry of the time period or on completion of the purpose. So the duty which already completed. So once the bailment period is completed or once the purpose is completed, bailey should return the goods. Sir, bailey didn't return the goods. Now goods are at the risk of bailey. After the period is completed, if goods are still lying with the bailey, the goods will be at the risk of bailey, even though bailey exercised reasonable care. But due to some reasons, due to act of God, if the goods are damaged, bailey is liable to the bailor. Next one, duty to return the goods. Not only the return of original goods, but also return of accretion to the goods. Accretion means addition. So before entering into the bailment period, I'm having some goods. During bailment period, there is some accretion, addition. For example, I gave cow to my neighbor. The moment I came back, when I observed, yes, the cow gave birth to calf. That calf is nothing but accretion. Now my neighbor, he is bound to return not only original cow, but also accretion to the cow, that is nothing but calf. Are you all getting my point, students? So these are the duties of the bailey. And one more additional duty, bailey can't set up adverse title with respect to property of bailment. Bailed property. Bailey can't set up adverse title. So these are the duties of bailey. So duties of bailey is equal to rights of bailor. Rights of bailor. Nothing more. But coming to the rights of bailey equal to duties of bailor plus 2 additional rights he is having. One is right of lien. The other one is right to claim compensation from the defaulted person. I'll tell you. That is right against wrongdoer. Right against wrongdoer. So rights of bailey equal to duty of bailor plus right against wrongdoer plus right of lien. The wrongdoer is a third person, He's a third person who deprives bailey or who prevents bailey from use or possession of the goods. See, I gave my bike to a mechanic for repair. Repair completed. And he called me, I'm going to the repairer to collect the bike. Meanwhile, what happened, one rowdy fellow. So he's making a strike everywhere. So he went into the mechanic premises and he damaged my bike. He simply burnt my bike. Generally, who can file case on such wrong person? Owner. But I'm not there. No, I'm in the on the way to that place. I'm on the way to that place. Now, this happened in the premises of mechanic. So mechanic will get a right to file a case on the wrongdoer. Generally, owner can file case on wrongdoer, but here the bailey, even though he is not a owner, he can still file a case on wrongdoer. Why? Because the moment, by the time bailor come to the premises, the wrongdoer may escape from the position, may escape from the premises. So simply to protect the interest of the bailor and to protect the interest of bailey, so bailey can file case against wrongdoer. He's having a right. A non-owner can also file a case against wrongdoer. Example, bailment only, bailey only. So and he's having a right to recover compensation from the wrongdoer. Whatever amount bailey is getting from the wrongdoer, bailey can apportion that amount between bailor and bailey in proportionate to their interest. We are having a case study with respect to this point, that is Morvi Mercantile Bank versus Union of India. Morvi Mercantile Bank versus Union of India. So what happened in this case? A is having a railway receipt ma. So A is getting a goods from some seller. The goods value is 10 lakhs. A went to Morvi Mercantile Bank and he pledged this railway receipt with Morvi Mercantile Bank and he got a loan of rupees 8 lakhs. Say for suppose 4 lakhs only, 4 lakhs principal amount, 4 lakhs interest 1 lakh rupee. So Morvi Mercantile Bank, what it did, on the date of delivery of the goods, yes, the goods are at the goods are in the train, and one day the train reached the destination. Morvi Mercantile Bank got a call that train arrived. So bank, it took the railway receipt and it went to the railway station. At railway station, bank came to know that the railway company was negligent in handling the goods. As a result, total 10 lakhs worth of goods were lost. 10 lakhs goods worth lost. 10 lakhs worth of goods were lost. So if you observe this arrangement, this is also comes under a bailment ma. This is a pledge, I agree, but this also comes under the bailment arrangement. So A delivered goods to some party for some purpose. After completion of the purpose, the goods shall be returned or disposed of. So in this example, if you observe, the purpose is security. The purpose is security. Are you getting my point? So for the purpose of getting a loan, yes, A transferred the certain goods to Morvi Mercantile Bank. Once this loan is repaid, definitely the bank is going to return the goods. So this is a pledge. Generally, this is also a bailment arrangement. So Morbi Mercantile Bank stands in the position of bailey, A stands in the position of bailor, and railway company, they are negligent. As a result, goods were lost. Now bailey is having a right to sue the wrongdoer, and bailey is having a right to recover entire loss amount. So bailey is having a right to recover entire 10 lakhs from railway company. So after getting this 10 lakhs, bailey, it will retain 5 lakhs, principal plus interest 5 lakhs bank will retain, and balance 5 lakhs, it will return to the owner. So that's what the judgment came in favor of Morvi Mercantile Bank. So right against wrongdoer, bailey can file case against wrongdoer. Bailey can recover total amount from wrongdoer. After recovering total amount, bailey shall apportion that amount among between bailor and bailey in proportionate to their interest. Next right, that is right of lien. So lien is nothing but retaining something to achieve something. So under bailment contract, bailor is delivering goods to the bailey for some purpose. So say for suppose, mobile repair. My mobile underwent some repair. So I delivered this mobile for repair. Repair completed. So bailey is bound to get some charges, repair charges. So bailey's consideration is nothing but repair charges. If bailor fails to pay the charges, bailey will get a right to retain those goods. So that is nothing but lien right. So lien is nothing but retaining something in order to achieve something. Until the charges were paid off, bailey can exercise this right of lien. And this this lien is of two types: general lien, particular lien. Particular lien is available only on the goods on which bailey should exercise some skill or labor, and consideration with respect to which is outstanding. General lien means lien on all goods or any goods with respect to general balance of account. So for getting a particular lien, see, in all the cases, bailey will get particular lien only. For getting particular lien, two conditions to be satisfied. Bailey should exercise some skill or labor. consideration with respect to which is outstanding. Consideration with respect to which is outstanding. If these two conditions are satisfied, Bailey can exercise particular lien only with respect to that product. Suppose I'm having a laptop, I'm having a mobile. Laptop both underwent some repair. Laptop repair charges 3,000, mobile repair charges 1,000. The moment I pay 1,000, I can take back the mobile. The moment I pay 3,000 rupees, I can take back my laptop. Understood, ma? Understood why? So when I pay 1,000 rupees, consideration with respect to mobile becomes outstanding. Outstanding consideration with respect to mobile will become zero. So when consideration outstanding becomes zero, Bailey is having a duty to return the goods. If consideration is pending, then he can exercise lien on those goods on which he exercise skill and labor. So definitely for repairing mobile, for repairing laptops, he need to exercise some skill or labor, yes or no? So this is the difference between particular and general lien. For exercising particular lien, he should have possession of the goods, he should exercise some skill or labor on the goods according to the terms of the bailment, and finally consideration is outstanding. But coming to the general lien, skill or labor is not required, and lien can be exercised on any of the goods belonging to the owner. Understood, ma? So these are the two types of lien, ma. General cases, all the baileys are entitled to the particular lien, and only 5 parties, bankers, warfingers, policy brokers, attorneys, only these parties are permitted to have a general lien. The next concept is termination of bailment. So when bailment gets terminated, when bailments get terminated, in 6 cases bailment gets terminated. When the purpose is completed, bailment will come to an end. When the time period, when a bailment is created for a certain time period, renting of cars for 1 month. So the moment 1 month completed, bailment comes to an end. Purpose completed, bailment will end. Period completed, bailment will end. Next one, subject matter, bailed property destroyed, sir. The moment subject property destroyed, bailment will also comes to an end. And next one, bailment is of two types, gratuitous, non-gratuitous. Coming to the gratuitous bailment, here the contract depends upon trust of the parties. See, I'm having a car. I'm going to another country for next 1 year. So now I called my neighbor. I gave car to my neighbor. Sir, please take care of my car. See, I'm having some 10 neighbors, but still, I selected only one and I gave car to that one person. Why? Because, I'm having trust on the party. I'm having a trust over the party. So generally gratuitous bailment, it is based on a trust. Now, my neighbor, he's a very old person, 80 years person. He got deceased, he died. Automatically bailment contract will also comes to an end. Automatically bailment contract will also comes to an end. Now, the legal heirs of the neighbor can't claim this property. Why? Because, I'm having trust over that party. I'm not having trust over the legal heirs. Are you getting my point? So in case of gratuitous bailment, coming to the death of the parties, bailment also comes to an end. For non-gratuitous bailment, consideration is the key factor, not trust. Suppose, I gave the car to neighbor charging 10,000 per month and I took 1,20,000 rupees. 8 months over, my neighbor deceased. Now the legal heirs of the neighbor, they are permitted to use the car for the balance 4 months. So bailment will not be revoked, bailment will not be terminated, bailment will be continued for the balance period if it is a non-gratuitous bailment. Understood, ma? So far we discussed 4 points: purpose over, period over, subject matter over, parties to gratuitous bailment over. Next one, ma, inconsistent use of goods. Inconsistent use of goods. So if Bailey makes any inconsistent use of goods, then bailor will get a right to terminate the contract. Accordingly, bailment comes to an end. And then we saw one more point, premature termination of gratuitous bailment. Gratuitous bailment where consideration is not at all required. So yes, bailor is having an option to terminate even it before maturity date also. Premature termination of gratuitous bailment, it is also termination of the bailment. So with this bailment topic we completed, ma. You can see. So we covered the definition. Next one, who are the parties to the bailment? And next, French word bailer, which means to deliver. We covered parties. And then we discussed essential elements, contract, delivery of goods, purpose, possession, return of goods. Then next we discussed types of bailment, gratuitous, non-gratuitous. And we discussed duties. We covered all these duties. Once again, I'm telling you, go through the examples thoroughly. I covered all these points, ma. So under bailment, we are left with one small topic, that is finder of lost goods. At your CA foundation level, you read that finder of lost goods stands in the position of bailee, right? So yes, finder of lost goods comes under the concept of bailment. Here you will find two persons, true owner and finder of lost goods. So who is a finder of lost goods? Whom we call a person, the person whom we call finder. Simply, finder is a person who is having possession of goods to which he is not a owner. Finder of lost goods is a person having possession of the goods but to which he is not a owner. Who is a true owner? He is having a ownership of the goods but he lost the goods. Okay. So by operation of law, there is a right, there is a duty. No, law is imposing certain rights and certain duties over the finder. So what are those rights? What are those duties? Duties you read at CA foundation level. Duty to find out the true owner. Until he finds the true owner, the finder should preserve the goods in a secured manner. Now coming to the rights, once a finder of lost goods praise true owner, so he is having a right to recover all the expenses he incurred in the process of finding the true owner and preserving the goods. Suppose if true owner is not paying the amount, then finder can exercise lien right over the goods. Finder can exercise lien right over the goods. And coming to the reward, suppose true owner announced a reward. So whoever find out the goods, return the goods, they are eligible for so and so reward. In that case, finder, when he returns the goods, true owner is liable to pay reward. If true owner fails to pay reward, then finder of lost goods can file a case for getting this reward. Sima, for expenses portion, the finder of lost goods will get only lien right. But coming to the reward, finder will get both lien as well as sure right. As we already discussed, lien right is allowed only when you have possession of the goods. Only when you have possession, then only you can exercise lien right. Once possession is lost, you can't exercise lien right forever. So with respect to reward amount, you can exercise either lien or you can sue the other party. Why? Because for reward, there is an express contract between true owner and finder. But coming to the expenses, there is no express contract. However, law is giving certain benefits to the finder until you get compensated, until you get payment with respect to the expenses portion in preserving the goods, in finding out the true owner. Until you get these expenses amount, you can exercise lien right on this. So no sure right for expenses. But coming to the reward, both lien as well as sure right will be given. Next one, right of sale. So in case true owner is refusing to pay the amount, or if true owner is not found, or expenses incurred for preserving the goods, it amounts to two-third of the value of goods or more than two-third of value of the goods, or the found goods are perishable in nature. In all these circumstances, the finder, even though he is a non-owner, I repeat, even though he is a non-owner, he can sell the goods, and the amount which is left over, after meeting all these expenses, the balance amount, for the balance amount, finder will act as a trustee. Once true owner comes into the picture, finder is bound to return all these amounts to the true owner. Understood, ma? Just go through the content carefully. So with this bailment topic, we completed, and we are having a pledge. See, pledge is similar to the bailment, ma. Pledge is similar to the bailment. Under bailment, the purpose might be anything, ma. But coming to the pledge, here you can see two parties, borrower and money lender. So what borrower is doing, sir, for getting a loan, is depositing some valuable items with the lender. Say for suppose, gold ornaments. Deposit of gold ornaments. Why? Security. Why, ma? Security. So for getting a loan amount, a borrower is bound to deposit certain security with the lender. For depositing this security, yes, for getting the loan, he deposited gold ornaments with the lender. The moment borrower repay the loan amount, the lender will return the goods to the borrower. That means bailment essential conditions are satisfied here. There is a contract between borrower and lender, delivery of movable properties, and then purpose, and then once purpose is completed, return of goods or dispose of goods, everything is satisfied. But the point is, bailment purpose is anything. Whereas pledge, the purpose is only one thing, that is security. Security. So define pledge, simply pledge is defined under section 172 as bailment of the goods as security for payment of debt or performance of a promise. So this is a financial pledge, this is performance pledge. These 2 points are already discussed under guarantee. Guarantee, two types: financial guarantee, performance guarantee. Here also pledge is also of 2 types: financial pledge and then performance pledge. See, I'll finish this contract, sir. If I fail to finish this contract, I'm depositing some valuable items with you, right? If I'm able to complete this project, you return that items to me. If I fail to complete this project, you just forfeit the security deposit, or you simply forfeit that items, you retain those items, sir. So performance pledge. Understood? Now coming to the parties of the pledge, here you can find 2 parties, bailor, nothing but panar. Bailor under pledge is nothing but panar or pledger. And bailey under pledge, we call him as pani or pledgee. Understood? Now here coming to the pledge, the most important topic is rights, duties. Rights of the pani, rights of the panar, and then duties of the pani, duties of the panar. So these are the essential, these are the important points in case of pledge. So duties of panar, simply is the duty of the panar to pay the debt, not only debt but also interest. Okay, pay deficit. So deficit, suppose borrower pledged gold ornaments worth 5 lakhs with a lender, and lender gave a loan of 4 lakh rupees. 4 lakh rupee. 1 year completed, borrower made a default. The tenure is 1 year, borrower made a default. Now lender, what is doing, sir? He want to sell the goods. The selling price, suppose selling price is 8 lakhs. Principal plus interest put together 5 lakhs. Principal plus interest put together 5 lakhs. Now selling price is more than outstanding amount. So balance amount 3 lakhs. The lender is bound to return to the borrower. Suppose if selling price, value of the gold came down, selling price is just 4 lakhs, outstanding amount is 5 lakhs. 4 lakhs minus 5 lakhs, there is a deficit of 1 lakh. Now borrower is liable for this 1 lakh to the lender, provided the sale happened with the consent of the borrower. Simply not with the consent of borrower, simply after intimating the borrower, simply after intimating the panar, pani can sell the goods. Reason only one point: who is the owner under the pledge? Panar is the owner, but who is having possession of the goods? Pani is having possession of the goods. So if Pani want to sell the goods, then he should give a notice to the panar. Because of these reasons, you are not making a payment. I'm going to sell the goods. Like that, he need to give notice. If he sell the goods after giving notice, then Pani is eligible to get deficit amount from the panar. Panar is liable for the deficit amount. Without giving notice, if Pani sell the goods, Pani can't recover deficit amount. Panar is not liable to pay deficit amount. Next, bailor, extraordinary expenses, bailor responsibility, same panar responsibility. Disclose faults in the goods, indemnify the pani due to defect in the title of the goods. Everything similar to the duties of the bailor. Next one, rights of the pledgee, already discussed. Rights of lien, right of lien. Until the principal amount, interest amount, and any expenses incurred for the purpose of preserving the goods, all these amounts, with respect to these amounts, even a single rupee is pending, Pani can exercise lien right. Pani can exercise lien right if a single rupee is pending with respect to the pledged goods. So amounts include not only principal but also interest as well as expenses. Now yes, extraordinary expenses. Pana duty to bear extraordinary expenses. Pani will get right to recover extraordinary expenses from Panar, and right to sell the goods. When if Panar fails to pay the amount or fails to perform the promise after giving a reasonable notice, Pani is permitted to sell the goods. In case of surplus, Pani is bound to return the surplus amount. In case of deficit, Panar is Panar is liable to compensate Pani and right to sue the panar. If panar fails to pay the debt or fails to perform the promise, then pani will get a right to sue the panar. The rights of a panar, similar to the duties of panima. The duties of pani, similar to the duties of bailey. So take reasonable care of goods, unauthorized use of goods. Next one, return the goods, not only original goods but also accretion, not to mix own goods, not to make inconsistent use of goods. Next, duty to return accretion to the goods. Understood? Everything similar to the duties of bailey. And last topic, what can be the pledge by non-owner? So generally ma pledge can be done by only owners, but following cases, in these five cases, a pledge can be done by non-owner, still they are valid. Mercantile agent is a person who do acts on behalf of his principal. So agent is permitted to pledge the goods, but Pani should act in good faith. Pani should not have any notice with respect to contract of agency. In all these situations, the common point is Pani should act in good faith. So yes, pledged by a person having possession under voidable contract. Suppose I'm a lecturer, I'm having a student. Definitely you can observe that there would be an undue influence. Why? A teacher will be in a superior position, dominant role, and student will be in definitely under inferior position. So using this dominance, yes, using this position, teacher took property of the student at a very cheaper prices. Suppose student is having a bike, bike, it's worth 10 lakhs. A teacher went to the student and told, yes, come on, give me that bike for just 1 lakh rupee. Sir, the value is 10 lakhs, sir. Give it me for just 1 lakh, or else I'm going to fail you in the upcoming examination. Simply, I exercised undue influence. Or simply, by way of fraud or, misrepresentation. However, I got the possession of the goods. This is voidable at the option of aggrieved party. And that party is thinking whether to cancel or continue. Meanwhile, I pledge the goods with Pani. Is this pledge valid, sir? Valid, provided this pledge should happen before cancellation of the contract, by the aggrieved party, and Pani should act in a good faith. Next one, pledge where Panar has only a limited interest. Panar is having only a limited interest. Example, finder of lost goods. Finder of lost goods. So finder, true owner. The true owner lost a watch on the road, and it is in a damaged position. Many vehicles went on the watch. The watch is completely damaged. The value of watch is 10 lakhs. And repair charges. This finder he incurred repair charges 5 lakhs. Total 15 lakhs. Watch before repair, the value is 10 lakhs, and he incurred repair charges 5 lakhs. Now the value of watch is 15 lakhs. Here, F is not a owner. Finder is not a owner. Yes or no? Finder is just having a possession. He's not having ownership. Suddenly, this F is facing some financial difficulties. So F took this watch to Pani, and he pledged this watch for 6 lakhs. How much? 6 lakhs. See, first of all, he is not a owner, and he pledged this item for 6 lakhs. So this person is having an interest in the watch. How much interest is having? 5 lakhs. Why? Once true owner is traced, finder is having a right to recover expenses. How much? 5 lakhs. So finder is having a limited interest in the property. So to the extent of that limited interest, that means to the extent of 5 lakhs, this pledge is valid. That means tomorrow true owner, by paying 5 lakhs to Pani, Pani should return the goods to the true owner. Understood? So pledge is valid only to the extent of limited interest. Next one, co-owner. When a property is owned by more than one person, then co-owner concept comes into the picture. So to a single property, two owners are there. One person is having a possession. Now without consent of another party, this person can pledge the goods. However, Pani should act in a good faith. Pani should not have any notice with respect to the co-ownership. In that case, pledge is valid. Next one, pledged by a seller after sale, pledged by buyer before completion of sale, but they're having possession. That pledge is also valid. After sale, seller is having possession. If you pledge the goods with some other person, and if some other person is acting in a good faith, then the pledge is valid. My dear students, if pledge is valid, then only Pani can exercise all the rights, right of lien, right to show Panar, and then right to sell, right to recover extraordinary expenses. All these rights he will get only if the pledge is valid, or else he won't get these rights. Understood, ma? So with this contract of bailment and contract of pledge, we completed. So just go through the differences. Primary difference between bailment and pledge, purpose. Purpose under pledge is security. Purpose under bailment is any purpose. Understood? Pledge, obviously consideration should be present. Bailment, consideration, not at all a criteria. Gratuitous bailment, non-gratuitous bailment we are having, right? So with this gratuitous and with this bailment and pledge topic completed. The next topic is contract of agency. In this competitive world, definitely a business person, in order to grow, so he will try to expand his operations. In terms of geographical area wise, he will try to put up a more and more branches. Now the problem is, being a natural person, he can't present in all these locations at a time. So he need to appoint few persons. He need to appoint some persons who can do act for him, and who can represent him in dealing with third parties like customers, creditors. Now the person so employed or the person so appointed is none other than agent. So finally, who is an agent? Agent is a person employed by principal to do any act, or agent is a person employed by principal to represent principal in dealing with third parties. So the primary test whether contract of agency present or not, just person employed to do any act for another or to represent another in dealing with third persons. Now the person who is doing an act or who is representing a principal, we call him as agent. But the conclusive evidence, now whether agency present or not, the true test of agency is the employed person, the appointed person, is he capable to create a contract between the employer and the third party? If the answer is yes, then there exists contract of agency between employed person and employer. See, not every employed person is treated as agent. Now if you take employment agreements, employer employee, see, employee will do act of employer, but there is no agency relationship. So true agency relationship will prevail only if that appointed person, if this person is capable of creating contractual relations between principal and third party and bind the principal by his own acts. To this question, if answer is yes, then there exists contract of agency. The highlight of contract of agency, for the act of agent, agent is not liable to third parties. Agent is not liable to third parties. Principal is liable to third parties. Who is liable, ma? Principal is liable to third parties. The act of agent, principal is liable. Now coming to the principal and agent, so between these two persons, agent can be any person. Even a minor can act as an agent. Why? Minor is not having any liability. Minor is not liable under any arrangement. Agent is also not having any liability. Therefore minor can act as an agent. Sir, can minor act as a principal? No. Why? Principal is liable to third parties, minor is not having any liability, so you can't appoint, you can't have minor as a principal. Is it clear, ma? And for creation of contract of agency, consideration is not essential category, not essential requirement. Is it clear? So next one, so what are the rules forming the basis of agency? So what a person does by another, he does by himself. Thus the acts of agent or the acts of the principal. Sima, as a natural person, you can do a number of activities. You can do these activities with the help of another person, that is nothing but agent. But the problem is, some services, some things which are personal in nature, some activities which are personal nature, like writing exams, attending for a test, marriage, drawing, painting, personal skills are required, personal nature activities. For these kind of activities, agency is not at all applicable. And you need to remember this rule. There is, q facit per alium facit per se. He who acts through an agent is himself acting. And let's look into the features of the agency. Okay, so who may employ an agent? Who may employ an agent? That means, he's asking you the characters of principal, or features of the principal. So simply, who can be a principal? The correct answer is any person competent to contract can act as a principal. That means he should have attained age of majority, he should be of sound mind, and he is not a person disqualified under any law for the time being in force. Now coming to the agent, who can be an agent? Any person, between principal and third party, any person can act as an agent. Even a disqualified person can also act an agent. But the main problem is between principal and agent. If you want to make agent liable to principal, if you want to make agent personally liable to the principal, this agent should be competent to the contract. Suppose principal is giving instructions to the agent, and it is the duty of agent to comply those instructions. If agent is not complying with the instructions, as a result, if principal is suffering with any loss, the result, principal suffering with loss, Now it is the duty of agent to compensate principal. However, if principal appoints minor as an agent, such agent is not liable to third party, such agent is not even liable to principal. Are you getting my point? So between principal and agent, if agent is competent person, then principal can make agent liable to him. Are you all getting my point? If agent is not competent person, then principal can't make him liable. Understood? Next, is there any consideration involved for creation of agency? I already told you, consideration is not required. Clear. What can be the liability of the agent? See, for the act of agent, agent is not liable, principal is liable. If you want to make agent personally liable to principal, then agent should be a competent person. Understood? So that's what we discussed. Next one. Next one. Types of or different modes of creation of agency. Modes of creation of agency. So in total, we are having some 6 types. One is, agency by express agreement. Agency by express agreement. One of my client received a summons from income tax department, my income tax notice, asking him to attend a department either in personal capacity or representative capacity. My client know how to do business, but he don't know about income tax provisions. So he immediately called me and he gave me the notice. I gone through the notice. It is very easy to me. So he asked me to attend income tax department officials, to handle income tax department officials. So definitely I can. But the problem is, see, I'm the agent of my client. Sorry, I'm the person representing my client. How can I communicate this matter with the income tax department? Simply attending income tax department, telling to the people, sir, I'm so and so chartered accountant, I'm representing my client. They will ask me a paper proof, documentary proof. So now what I'll do, I'll get a power of attorney, simply, authority delegation letter from my client stating that, I so and so hereby appointing Mr. V, chartered accountant, as my representative when dealing with income tax department matters related to income tax. Like that, he will prepare a letter, he will sign it, and he will give that letter to me. Now here, I'm the person representing my client in dealing with income tax department officers, income tax officers. So now I'm the representative, simply agent, and my client is my principal. Act of agent, agent is not liable. Who is liable? Principal is liable. Suppose, I made a valid argument. Income tax officers, dismissed the case. They told that no need to pay single rupee. Now, who will be happy? My principal will be happy. Simply my client will be happy. Suppose, I made argument negligently. No, I didn't give correct, I didn't highlighted correct points. I didn't quoted correct provisions. I made wrong argument. And, income tax officers, yes, they levied penalty on my client. Now, who is liable to pay that penalty? Income tax to income tax officers, my client. Understood, ma? Act of agent. Agent is not responsible to the third party. Only principal is responsible to the third party. So now in my example, how agency was created, sir. It was created using a letter of power of attorney document. So simply express agency. Next one, implied agency. Implied agency. Sometimes, contract of agency arises through the conduct of the parties, through the behavior of the parties. Is it clear? So in such cases, agency, we call it as implied agency. Example, I'm having a servant at my home. So regularly he is going to the shop, he is buying the things, and within 5 to 10 minutes, I'm going to the same shop and I'm paying the amount. Now what shop owners will think? Okay, whatever purchases Mr. Servant is doing, so Mr. V is liable. So by the conduct of the parties or by the behavior of the parties, yes, there arises contract of agency. Simply implied agency. Next one, by estoppel. Estoppel. You all know the meaning of estoppel. Once a person make a statement, subsequently he can't deny the validity of the statement. So once if you make a statement, you are bound by the statement, you can't deny the statement. That's what estoppel. So under estoppel, there is no actual principal agency relationship, but there is a representation. What that representation indicates? That representation is indicating that certain person is an agent to certain person. Now, subsequently, the principal can't deny the fact. Suppose, P present at one function and A came to a person, for example, yes, and A is making a representation like this. Hi, sir, I'm Mr. A, I'm agent to P. At that time, P remains silent. P heard that, P is listening to the conversation between A and S, but P didn't raise any objection. So simply P is allowing A to make a representation stating that A is the agent of P. Now subsequently acts of A, definitely P is liable to third party Mr. Yes. So estoppel, representation that certain person is agent which third party believes it to be true. So under agency by estoppel also, for the act of agent, principal is liable. Of course, that agent is personally liable to the principal. Next one, necessity. Necessity. See, I'm having certain goods, perishable goods. I want to send them to my friend. He's a resident of Chennai. So I'm sending these goods from Hyderabad. Almost, it may take 2 days to complete this transaction, to complete the delivery. So I appointed one person, simply, goods transport agency. I appointed one person, who can transport my goods to the, my friend. One day completed, he observed that, goods are completely ready to get destroyed. Some of the goods already destroyed and remaining goods ready to deteriorate. He tried calling me, but because of business meetings, I couldn't attend the call. So simply communication was impossible between me and that person. And what he did, as a man of ordinary prudence, he sold all the perishable goods in the nearby market at the best rate. At the best rate. Tell me, my dear students, what authority I gave to that person? Simply transport goods from one location to another location. So he's having authority only to transport. He's not having authority to sell the goods. But what he did, he sold the goods. Now for that sale, is he my agent or not? Is he my agent with respect to that sale? Actually, no. But emergency situation. How can you tell, sir? The goods are ready to destroy. It creates loss to the owner of the goods. And he tried to communicate with me, but communication was impossible. I'm not attending to any calls. And then he, as a man of ordinary prudent, that means, if goods belong to him, at what price can he sell them in the ready market? So at the best rate only, he sold all the goods. So when all these conditions are satisfied, then agency by necessity comes into the picture. Even though he is not my actual agent, but law presumes that he is my agent, and act of the agent equal to act of the principal. Accordingly, I'm bound by the sale made by the transporter. That's what necessity. Next one, agency by operation of law. Operation of law. Yeah, this thing you all know. If you take a partnership firm, partnership type of organization, act of one partner, all other partners are liable. For the act of one partner, all other partners are liable. Now here, each partner is acting as an agent to all other partners. They never entered into the agreement of agency. But Indian Partnership Act is stating the point that each and every partner is an agent to all other partners. Act of one partner, all other partners are liable. So that's what, operation of law. Law treats a person as agent. So here law is treating a partner of the firm as an agent. And finally, the last one under implied agreement is ratification. Ratification. What is meant by ratification? Approving an act which was done previously without the authority. Approving an act which was done previously without authority. So approval of the act of a person. Suppose I'm the principal, I'm engaged in finance business, and I'm having agent. Okay, so he's having power to collect dues from the debtors. He's having only power to collect dues from the debtor. He had no power to lend the money. One day, in my absence, he lent money to one of the debtor. So when I came back, I came to know that agent performed an act without authority. He did an act. He committed one act. Is that act within the authority or outside the authority? Outside the authority. Now I'm having two options, either to approve it or to reject it. If I approve the transaction, it leads to the ratification. Now act of agent becomes act of principal. If I reject the transaction, if I reject the transaction, for that activity, I'm not his principal, he's not my agent, I'm not bound by the transaction. With respect to that transaction, that person is personally liable. That means tomorrow, if debtor becomes insolvent, now loss arising out of insolvency, so who should bear that loss, sir? My agent. If I approve the transaction, loss arising out of insolvency, I'm going to bear that loss. So when this act was done, in past, so 2 days back, he lent money without my authority. Today I came to know. So I'm having two options, either to approve or reject. If I'm giving approval, then it is nothing but ratification. So with respect to that act, he becomes my agent and I'm the principal. Now, money lent by the agent is nothing but money lent by the principal. So rights, rewards, risk and rewards. Risk means insolvency loss, rewards means every month interest amount. So with respect to that interest amount, I'm eligible to enjoy. I'm eligible to enjoy with those rewards. Are you all getting my point? But with respect to ratification, we are having some rules. Under necessity also we discussed certain rules like communication impossible, real necessity to act as an agent. He acted as a man of ordinary prudence. So we discussed the rules for agency by necessity and agency by ratification. Also we are having certain rules, ma. So ratification can be done either in express manner or implied manner. By the conduct of parties also ratification will take place. Next one, the person who is making ratification must have full knowledge of material facts. So he should have full knowledge of material facts with respect to the contract. If his knowledge is concealed, if the facts of the contract, if agent is concealing any material facts and principal without knowing those facts, if he ratify, such ratification is not valid, it is void. Next one, ratification is possible for whole transaction, part of the transaction which is beneficial to the principal and part of the transaction which is not beneficial to the principal. So he can't split the transactions into parts and he can't accept beneficial portion and he can't reject a loss portion. He's having only two options, either to approve whole transaction or reject a whole transaction. And because of ratification there should be no damage, there should be no injury to the third party. If there is any loss or damage to the third party because of ratification, then that ratification is not permitted. And ratification must be done within reasonable time. Reasonable time depends upon the facts of the case, time to time and facts of the case. Next one, ratification is applicable only for lawful acts. With respect to unlawful acts, ratification is not allowed. And the next topic is authority. Now, what is meant by authority? It is the thing to what extent a agent can bind his principal. Authority means to what extent an agent can bind his principal. That means agent will do a number of acts. Do you think principal is liable for a number of acts? Sir, suppose if answer is yes, that means agent is having that much authority. Understood? So here I categorize this authority into two types. One is under normal circumstances. Second one is emergency circumstances. Emergency circumstances is similar to agency by necessity, ma. Under agency by necessity we discussed, right? So communication should be impossible and there should be a real necessity to act as an agent. This agent should act as a man of ordinary prudence. He should have possession of the goods belonging to the principal. And all these conditions are satisfied, then any lawful act done by the agent, principal is liable, whether it is within the authority or outside the authority. Just now I told you an example of sale of non-durable goods, perishable goods. Now coming to the normal circumstances, agent can do any lawful activity, any lawful acts for conduct of principal business. Suppose one day principal called agent and told, see, one of the debtor is residing in Hyderabad. One of the debtor, he is living in Hyderabad. So go to the debtor and collect the money. Now go to debtor and collect the money indicates that tomorrow if debtor is not paying the money, then agent is having all powers to file a suit against the debtor, to appoint a lawyer in order to defend the case, and to incur all lawful expenses in recovering amount from the debtor. So all these things will come under the authority of the agent. Understood? So as long as agent acts within the authority, principal is liable by the acts of agent. If agent exceeds the authority, then principal is not bound by the transactions made by the agent. Understood, ma? Everyone. Next thing. So what do you mean by express authority and implied authority? Just now we discussed different forms of implied authority. We discussed these points also, estoppel. So there should be a representation. It can be either express or implied. No, pretended agent, agent is acting, and the person is allowing him to represent, is not making any objection. Understood? And that representation indicate that agent has an authority to do certain act, and principal must have induced the third person by such representation, and third person must have believed the representation and made the contract on behalf of such on the belief of such representation. If all these conditions are satisfied, then agency by estoppel comes into the picture. So called agent acts, principal is liable. And necessity also we discussed. Next one, conditions for agency by necessity. So there should be a real necessity, communication should be impossible, acts must be bona fide, genuine, and the purpose is protecting the interest of the principal, and he should act as a man of ordinary prudence. So you need to remember all these points, ma. Next one, rights of a person as a acts done for him without his authority. Simply ratification. So pretended agent means who, sir? So he is not my actual agent, but he is telling that he is my agent. Suppose Mr. Ravi is there. There is no relation between me and Ravi, but Ravi, wherever he is going, he is telling that, hi sir, I'm Ravi, I'm agent to Mr. D.V. Subramaniam. Like that, he is making a statement. Now he is not my real agent, but he himself pretends to be an agent, so pretended agent. So act of pretended agent, principal is not liable. However, the principal is having two options, either to approve it or reject it. If he is making approval, if he is giving approval, then it is nothing but ratification. Next one, ratification simply means subsequent acceptance and adoption of an act by the principal, originally done by the agent without the authority. So we discussed the essentials of a valid ratification, express or implied, knowledge requisite for valid ratification. Next, whole transaction should be ratified, no damage to the third party, and ratification should be done within reasonable time. Communication, ratification should be communicated, and only lawful acts can be ratified. Okay, and that ratification should be within the power of the principal. As you all know, in company law we are having a topic called doctrine of ultra vires beyond the powers of the company. So powers of the company means beyond the objects specified in the memorandum of association. So if an agent, simply director, acting beyond the powers of the company, even a whole body of members can't approve it. So ratification is applicable only with respect to lawful acts. Ultra vires acts are void ab initio acts. So void ab initio acts can't be ratified, and moreover this is beyond the powers of the company. Understood? And who can ratify? Only principal can ratify. So principal should have a contractual capacity both at the time of entering into the transaction by agent and at the time of ratification also. So both the time periods, both the times, the principal should have a contractual capacity, and principal should be in existence at the time of ratification as well as when the transaction was entered into. Next, we discussed the extent of agent's authority in normal circumstances. So he is permitted to do all lawful things for completing the business of the principal, right? And what can be the two principles of agent's authority? We discussed normal circumstances and emergency circumstances. Emergency circumstances similar to agency by necessity. Understood? See, I'm highlighting the words. Already completed these points, ma. Most reasonable and practicable course. And then he should have possession of the goods belonging to the principal and which are subject to the contract. All these points we already completed. And when agent cannot delegate, so this is the concept of sub-agent. So let's take up a concept of sub-agent and substituted agent. Sub-agent. Sima, principal appoints agent. If agent appoints another person as his agent, then he is known as subagent. See, Mr. A appoints B to do A's act. And with respect to same A's act, if B is having one more person as his agent, so C was appointed to do A's act. Now C is subagent to A. If you ask me the relation between B and C, the relationship is principal and agent. Principal and agent. So B is the principal, C is the agent. If you ask me the relation between A and B, A is the principal, B is the agent, principal and agent. But if you ask me the relationship between A and C, it is principal and subagent. So who is subagent? Agent's agent is nothing but subagent. Understood? Sir, appointment of subagent, valid or invalid? Generally invalid. Why? See, today A is having trust over B. That's why A appointed B as his agent. If A had same level of trust and confidence on C, definitely A would have appointed C as his agent, right? So delegatus non-protest delegate. That means a delegatee cannot further delegate. Trust matters. So A appointed B because he's having a trust. Only B should do acts on behalf of A. If B is having one more agent, that is nothing but subagent. So appointment of subagent is invalid. Then what is the effect of appointment of subagent? Consequences. So general rule, appointment of subagent is invalid. Now, principal is there, agent is there, subagent is there. Subagent is dealing with third party. So with respect to third party, is Mr. Principal liable to third party? The answer is no. Principal is not liable for the acts done by this subagent. Why? Principal already told to third party, sir, either me or my agent, if you deal with either me or my agent, I'm liable to you. Like that, there is a clear cut communication with third party. Now third party is dealing with not with principal, not with agent, but he is dealing with subagent. Yes or no? He is dealing with subagent. So act of subagent, principal is not liable to third party. Then who is liable to third party, sir? Agent is personally liable to third party. Agent is personally liable to the third party for the act of subagent. As you all know, the real relationship between agent and subagent is principal agent. For the act of agent, principal is liable. Yes or no? For the act of subagent, original agent is personally liable to third party as well as original liable to the principal. So principal is not liable to the third party. So if you look into the diagram, subagent is personally liable to agent, agent is personally liable to third party, agent is personally liable to principal, but principal is not liable to third party. Of course, subagent is not personally liable to principal. Why? Privity of contract. There is no privity to contract between principal and subagent. Are you all getting my point, students? Everyone. But we had exceptions. Exception means what? General rule, agent can't have a subagent. But when nature of trade permits agent to have a subagent, or when principal approves the agent's act, principal is telling, okay, you can have one more agent, you can have agent for my activity. So simply with the approval of principal, if agent appoints another person as agent, then that appointment of subagent is valid. So then what is the consequences in case of properly appointed? This is a general rule consequence. I'm writing here. This is a general rule consequence. Under exceptions, that means properly appointed. If subagent is properly appointed, then what would be the effect? Just look into the diagram. Principal, agent, subagent, third party. Now subagent dealing with third party, principal is personally liable to third party. Principal is personally liable to third party for the acts of subagent, and agent is personally liable to third party. Agent is personally liable to not third party. Agent is personally liable to principal. Here agent is not liable to third party, and moreover subagent is personally liable to agent. Subagent is not liable to principal. The reason, there is no privity to contract. So there is no contract between principal and subagent. So just look at the diagram. For the act of subagent, principal is directly liable to the third party. Therefore, agent is not liable. So agent is personally liable to principal for the act of subagent, and subagent is personally liable to the agent for his own acts. So this is the consequence when subagent is properly appointed. Hope everyone understood. So check the differences between general rule and exceptions consequences. General rule, act of subagent, original agent is liable to third party. Exceptions, for the act of subagent, principal is personally liable to the third party. Understood? In case of fraud, in case of willful wrong, definitely act of a subagent, principal can take action against subagent because the principal property is getting affected. In case of fraud, willful wrong, principal can take action against subagent even though there is no contract between them. Understood? So this is the effect of subagent, ma. Effect of subagent. So delegatus non potest delegare. You need to remember this kind of Latin principles. When you quote these kind of principles, you'll definitely get best marks. And we had exceptions. Legal relationship. This is the important point in this subagent concept. Principal is bound to the third parties for the acts of subagent when if subagent is properly appointed. Exceptions case, principal is bound to the third parties, agent is responsible to principal, subagent is responsible to agent, and subagent is not responsible to principal except in case of fraud or willful wrong. If subagent is appointed without authority, in that case, principal is not bound to the third parties. Agent is responsible to the principal. Subagent is responsible to the original agent, and subagent is not responsible to the principal. Understood? So many students, they face some kind of confusion when they read this paragraph. Ratification, rule of ratification is telling that a represented person can ratify the act of an agent who is committing an act without authority. A represented person. If this subagent dealing with third party, if subagent represents the name of principal, sir, I'm so and so dealing on behalf of principal, like that, if he make a statement and if he enter into contract with third party, then principal will have a power to ratify the act of subagent. However, if subagent represents the name of agent and if he enter into contract with third party, then principal has no power to ratify the act of subagent. The reason is very simple. Who got represented? In this example, principal got represented, principal can ratify. In this case, agent got represented, so principal will not have any power to ratify the act of subagent. So now whatever you heard, just read the paragraph, you'll get to know. And the next topic is substituted agent. Very small concept. Substituted agent is a person appointed by the agent but works for principal. Is like a co-agent. So substituted agent, he was employed by A. See, agent appoints substituted agent. However, the substituted agent works for principal. The thin line of difference between substituted agent and original agent, substituted agent and subagent is substituted agent is a person appointed by original agent and he works for principal. Whereas subagent is a person employed by original agent and subagent works for agent. Act of subagent, agent is liable. Act of substituted agent, principal is liable. So in case of substituted agent, agent won't get any personal liability. No personal liability. If and only if agent exercise reasonable diligence while naming a person as substituted agent. If you exercise, if you act as a man of ordinary prudence in naming a person as substituted agent, then this original agent is not liable with respect to acts of substituted agent. Suppose if agent, acts negligently and appointed some wrong person as substituted agent. Now, act of substituted agent, original agent is liable. Understood? So in naming a person as a substituted agent, a lot of reasonable care, lot of reasonable diligence he should exercise. So that's what substituted agent concept. Substituted agents are not subagents, they are just agents of the principal. So you had differences between substituted agent and sub-agent. Just go through it. You'll get to know. Next one. Next concept. Duties of the agent. Duties of the agent. Very small topic. Duty to execute mandate. Mandate is nothing but, instruction, directions from the principal. So whatever principal is giving whatever the instructions given by the principal, it is the duty of agent to follow those instructions. If agent fails to execute principal directions, principal instructions, then whatever loss principal is going to suffer or principal is suffering, so those losses should be compensated by the agent. Of course, these duties of an agent are applicable only if agent is a competent person. Suppose if agent is a minor, if agent is an insolvent, then all these duties are not applicable to the agent. Understood? Next one, conduct business in accordance with the directions given by the principal. So that's what mandate. But in the absence of those directions, you need to follow the trade customs, the practices, that trade practices prevalent in that country or prevalent in that society, you need to implement those practices. First thing, if you had an express instruction, follow them. If there are no express instructions, then follow the trade customs. And while doing the job for principal, you should exercise reasonable care and skill. So if business belongs to you, how much care you will exercise? Suppose you are selling goods to the customer on credit basis. Now if business belongs to you, what steps you will take? Whether customer is competent person or not, financially competent or not. So can he repay the amount or not, or will he make any default? Like that, you'll make inquiry. Now you are dealing on behalf of the principal. You're doing this business on behalf of the principal. Same care, same skill you should exercise. And you should always keep in touch with principal. Always you should be in touch with principal. So any material matter, you should communicate with principal, and from time to time you should get it's your duty to get instructions from the principal. Next one, duty to avoid conflict of interest. So duty to avoid conflict of interest, while dealing with the principal. So when you're doing business on behalf of principal, so any personal interest you should avoid. Suppose principal asked you to bring some goods, and you are having those goods, now you are trying to supply those goods to the principal at a higher rates. So these kind of things you should not do. Why? See, in the eyes of law, principal, agent, both are not separate persons, they are a single persons. They are simply one person in the eyes of law. In normal person, in a layman terms, principal is a separate person, agent is another person. But in terms of, in the eyes of law, principal and agent both are one and the same. Now one can't deal with himself, right? I can't sell my goods to myself. I can't buy my own goods, right? So here also, principal and agent should not do the activities which leads to conflict of interest with the principal. And duty not to make secret profits. Secret means simply undisclosed. So agent going to the shop, he's buying things at just 100 rupees and coming back and telling to the principal, sir, total bill is 120. Actual cost 100, but he's telling 120. That means he is making a secret undisclosed profit of 20. So like this are not permitted. Tomorrow if principal comes to know about that conflict of interest and maintaining secret profits, then principal will be given an option to cancel, to terminate the agency. Understood? And duty to remit the sums. See, on behalf of principal, you are doing the business. So whatever amounts you collect in this business, you need to remit all those sums to the principal, all those amounts to the principal. And duty to maintain the accounts. Simply accounts means not trading profit and loss account, balance sheet. It's not balance sheet, trading and profit and loss account. So all the transactions which you are recording in the books and the supporting vouchers, simply the transaction should be explained. So supporting vouchers, supporting invoices, everything you need to maintain. So whenever principal asks the information, you need to furnish that information. And duty not to delegate, that means you should not have a sub-agent. If you appoint sub-agent, then acts of sub-agent, principal is not liable to third parties, agent is personally liable to the third parties. Next one, duty not to use any confidential information received in the course of agency against principal. In the agency, definitely whatever the information known to the principal, definitely that information will also be given to the agent. So principal will communicate some important matters with agent. So as an agent, you are getting this information. If you are not an agent, you can't get this information. Now, whatever confidential data you are getting from your principal, you should maintain confidentiality with respect to that matter. You should not leak the matter. You should not disclose the matter to the public. So these are the general duties of the agents, ma. Sorry, these are the general duties of the agent. So wherever agent fails to execute the duty, wherever agent makes a default with respect to any duty, then what would be the consequence? Whatever loss principal is suffering with, all those losses, agent is liable. Understood? Once again, I'm telling you, in the last two chapters I told you, now also I'm telling you, see, don't focus on the theory content. Theory content, just try to, understand the theory content. But try to practice examples, practical questions as many times you can. In examination, we are not getting directly theory questions. They are framing a situation, they are giving an illustration and asking you to provide a suitable answer. So now, just reading a provision 2 or 3 times is not sufficient. You need to implement the provision in the respective areas. You'll get that knowledge only when you read the examples, when you solve practical questions. Clear? Next one, rights of the agent. So what are the rights available to the agent? First one, right to retain out of sums received on the principal account. So just now we discussed whatever amounts agent is collecting on behalf of principal, he should remit all those amounts to the principal. But while doing this agency, whatever expenses he spent, and whatever money he paid in advance to the principal, and whatever remuneration he is entitled to, so all these three amounts he can deduct from the principal sum amount, and balance amount, agent is having a duty to return that amount. Understood, everyone? Suppose if you take consignment example, consignor principal, consignee is an agent. So consignee for getting goods, he will pay advance, and once goods reach the destination, loading and unloading charges and commission, special commission, normal commission, simply remuneration to the commission, sorry, remuneration to the consignee. All these amounts, consignee is eligible to deduct before he remit final sum. Understood? Next one, right to remuneration. If his remuneration is pending, he can exercise lien right with respect to principal property. That's what the third thing. But one thing, my dear students, he is eligible for the remuneration only with respect to the acts which were done within the authority, within the direct, within the whatever the things done within the authority given by the principal, simply complying the directions of the principal, whatever the activities he did, only for that portion he is entitled to the remuneration. If he is guilty of any misconduct, then he is not entitled to the remuneration, and moreover, with respect to that loss, agent is personally liable to the principal. Next one, agents lien on principal property. Yes, for getting the money, legal for providing legal services, whatever remuneration he is entitled to, so he can exercise lien on principal's property. Understood? Next one, right to indemnity. Sima, agent is doing all these acts representing principal. So while doing these acts, whatever expenses agent incur, or whatever losses agent is going to suffer, it is the duty of the principal to ratify the agent, sorry, to indemnify the agent. In previous chapter also, in contract of indemnity also, I told you, manufacturer, dealer. So dealer is selling the goods on behalf of manufacturer. So any loss to the dealer when he is acting according to the instructions of the manufacturer, it is the duty of manufacturer to compensate, to indemnify the dealer. I told you, right? So while executing the mandate given by the principal, whatever the losses suffered by the agent, it is the duty of the principal to indemnify the agent. Next one, right of indemnification against acts done in good faith. Only the acts done in good faith. Only the acts done in the good faith. And for this, whatever the losses agent is, suffering with the loss, whatever the amounts, agent is suffering with the loss, only for those amounts, principal is liable to compensate agent. Understood? See, the point is very clear. See, I'm having some goods, ma. I'm having some goods. I called agent, so please sell the goods, I told. So agent, based on my statement, what he did? He entered into a contract with some third party. And without telling to the agent, you know what I did? I sold all these goods personally. One second. So I sold all these goods without communication to the agent, you know, personally. Now agent, you already made a contract with third party. Now agent is not in a position to supply the goods. The third party sued agent. So today, what happened, sir? You know, in this example, what happened? So agent was made liable to the third party. So whatever losses, you know, agent suffered because of my statement, you know, all those losses, definitely I'm liable to the agent personally. Of course, you know, third parties will recover loss amount directly from me if I'm known to them. If I'm known to them, third parties can recover that, amount from me. It's not about loss, ma. Suppose, you know, the point is, when you enter into a contract, when you make a promise, if you are not in a position to fulfill the promise, definitely you will be treated as defaulting person, and the aggrieved party will recover some amount from you in the form of damages. Now whatever the loss, you know, agent is suffering with because of, you know, principal negligence, all those amounts, you know, principal is liable to the agent. A non-liability of the employer of agent to do a criminal act. You know, agency is applicable only for lawful acts. Forgot to tell you. Only for lawful acts, contract of agency is applicable. With respect to unlawful acts, with respect to criminal acts, you know, contract of agency is not applicable. Therefore, you know, act of agent with respect to unlawful act, agent is personally liable. Principal is not at all liable. Next one, right to the compensation for injury caused by the principal negligence. As we already discussed, you know, principal failed to communicate with agent with respect to doing a task. Suppose, you know, I'm having a car. I called my agent, come on, take this car to the mechanic. And I failed to tell that, you know, brakes are not working. I didn't told. So brakes are not working, I didn't told. I simply call him and I told, take the car to mechanic. Now, while going, yes, he observed that brakes are not working and he met with an accident. A medical bill of 20,000 rupees came. Now, who is liable to compensate that person, sir? Obviously, me, because I failed to communicate the special points. You know, I failed to disclose the faults in the goods. Understood, ma? So these are the rights of the agent. Next one, principal liability to the third parties. Principal liability to the third parties. So as long as agent acts within the principal authority, the act of agent is not liable, principal is personally liable. So principal liability for the acts of the agent, that's what I told you. General rule is applicable here also. And what happens if agent exceeds the authority? So the transactions beyond the agent's power, you know, principal is having a two options, either to approve it or to reject it. But in this topic, you know, we are having a point that, you know, agent committed an act. If it is within the authority, if it is outside authority. And there is one more point, part of activity is within the authority and remaining part is outside the authority. Then what is the consequence? For an act within the authority, act of agent, principal is liable to third party. For an act outside the authority, agent is personally liable. However, if principal approves the transaction, simply principal ratify the transaction, principal is personally liable, agent is not liable. But coming to the, you know, part of the transaction within the authority and remaining part outside the authority, in that case, you need to check whether those acts are separable or inseparable. If they are separable, then principal is bound by the act which is within the authority, and the act which is outside the authority, principal is not liable. If both the acts, you know, is inseparable, so consolidated acts are, the separation is not possible, then principal is having an option to reject the entire transaction or to approve the entire transaction. If we select a reject option, then agent is personally liable. Is it clear, ma? So principal not bound when excess of agent's authority is not separable. So next one, notice given to the agent. So knowledge of an agent is equal to knowledge of the principal. Any information you give to the agent, it is nothing but information given to the principal. So it's like that only, you know, in case of company, corporate organizations, corporate entities. any letter addressed to the managing director of the company, that means it is a letter addressed to the company separately. No need to write a letter in the name of the company. Is it clear? So knowledge given to the agent, notice given to the agent is nothing but notice given to the principal. And moreover, agent should get the knowledge, that person should get the knowledge being an agent. So because he is acting as an agent and he got the information, only with respect to that information, principal is liable. Principal is bound by that information. Suppose, he got this information before becoming agent. I got this information before I become agent to some other person. Later I became an agent. Now with respect to this matter, that person is not responsible. Only point is I'm acting as an agent. Any information given to the agent, nothing but information given to the principal. Next one, principal's liability for agents, fraud, misrepresentation, civil wrongs taught. Very simple. If agent is committing fraud, which is within his authority, definitely fraud, misrepresentation is not within the authority. But the point is, he's manipulating the cash balances. Suppose, I'm having an agent who can collect dues from the debtor. So my agent is collecting the money, but he's not accounting that money in my account. He's personally diverting certain funds. Now he's doing the fraud with respect to an activity which is within his authority. Now, with respect to those frauds, misrepresentation taught, principal is liable to the third party. And if agent is doing fraud, misrepresentation with respect to activities which are not within the authority, then he is personally liable. He is personally liable to the third party. So, example, just now I told you. So, I give authority to my agent to collect amounts from debtors. He is collecting the money from debtors and he is diverting the funds. With respect to this fraud, I am personally liable to the third party. That means, I can't recover a single extra rupee from the third party. Next one. What can be the exception? Now, liability of principal, inducing belief that agents' unauthorized acts were authorized. Simply, pretended agent, pretended agent as well as estoppel. So, in case of estoppel, act of agent, principal is liable. In case of pretended agent, if principal ratifies the agent act, then principal is personally liable, or else agent is personally liable. Understood. So without authority done acts or incurred obligations to the third persons on behalf of principal, the principal is bound by such acts or obligations if, as by his words or conduct, induces such third persons to believe that such acts and obligations were within the scope of authority. What estoppel. Next one, personal liability of agent to the third parties. The general rule agent is not having any personal liability. Agent will not have personal liability. Act of agent, principal is liable. However, we had certain exceptions. So if agent is acting for foreign principal or abroad foreign resident, in that case we can't make a foreign principal or foreign abroad person directly liable to the third party. So in those cases, who is personally liable, sir? The answer is agent is personally liable. And which agent does not disclose the name of the principal, in case of undisclosed principal. So agent is not communicating who the principal is. Obviously, third party without any option, third party will recover amount from the agent. And then, agent is representing a person who is not in existence, or the person is in existence but he's a minor. So in that case, the principal will not have any liability. That agent will have a liability. In case of pretended agent, and where principal is not approving the act of pretended agent, then pretended agent is personally liable. And whenever agent exceeds the authority, in this case also, the principal is personally liable to the principal is not liable to the agent. Sorry, the principal is not liable to the third parties. The principal is not liable to the third parties. Agent is personally liable to the third parties. Next one, rights of the third party. The principal, agent, third party. If third party knows who the principal is, who the agent is, in that case third party will 100% he will get rights over the principal. Third party won't get rights against agent. So this is the case of disclosed principal or named principal. So we are having three principles. Listen carefully for understanding this topic. We are having three types of principles. One is named principal, unnamed principal, undisclosed principal. So just see the point. Fact of agency, name of principal. So in case of named principal, fact of agency, name of principal disclosed. In case of unnamed principal, fact of agency disclosed, whereas name of principal remains undisclosed. In case of undisclosed principal, both fact of agency, name of principal remains undisclosed. Listen carefully. See, I'm DV Subramaniam, agent to Harsha. So now I'm revealing the fact of agency and I'm revealing the name of the principal. So now Harsha will be called named principal. Act of agent, named principal is liable to the third party. Third party will get complete rights over principal. In case of unnamed principal, see, I'm making statement like this. Hello, I'm DV Subramaniam. I'm agent. And I don't want to communicate my principal details. Now tell me, my dear students, third party from whom they will claim the amounts. See, I'm telling that, sir, I'm buying this laptop for my principal. Third party, what he will ask, who is your principal? Sorry, sir, I won't disclose my principal details. In that case, I'm personally liable to the third party. If third party, not because of me, but because of some other sources, he's having knowledge of my principal, then he can make my principal liable. So until principal details are disclosed, agent in case of unnamed principal is liable to the third party. Now in case of undisclosed principal means, I'm just entering into the contract, I'm not revealing the fact of agency, I'm not revealing the name of principal. So both fact of agency, name of principal remains undisclosed. Now what third party thinks? Third party thinks that I'm dealing for myself, I'm entering into contract for myself. So later, I communicated the details of principal. Now third party is having a three options. 2 to 3 options. What options? Why? I'll tell you. See, I'm not disclosing the name of principal and I entered into contract with third party. Later, third party came to know that I'm an agent, I'm having a principal. Now, what third party can do? Third party can simply tell that, sir, you obtained my consent without disclosing the details of agency and without disclosing the name of principal. So my consent is not free. By way of concealment of facts, you entered into the contract. See, this becomes voidable at the option of me. I'm going to cancel the contract. This is option available to the third party. Or he may approve the activity. Okay, sir, whoever it might be, that person is also very good person. Okay, I'll continue with the contract with that person. I'll continue the contract with your principal, sir. In that case, the contract comes into the picture between, principal and third party. The third option available to the third party is, so third party can choose specific performance. So third party can tell like this, sir, I thought that you, a trustworthy person, you are entering into contract for yourself. If I knew this fact that you are entering into contract with on behalf of that person, I wouldn't have entered into the contract. And I'm asking you to perform the contract. Only you have to perform the contract. So I'm making you personally liable with respect to this contract. Now in this case, a contract will be continued with the agent and agent is going to have a personal liability. So principal will not get any personal liability. So the point which I want to tell you is, in case of named principal, all general rules will apply. In case of unnamed principal, all general rules will apply only when the name of principal is known. In case of undisclosed principal, the rights and liabilities of agent and principal depends upon the option chosen by the third party. Understood? Next concept, termination of agency. In how many modes, agency gets terminated? By way of agreement, agency will be terminated. Or, principal removing the agent, or agent resigning from the agency. By way of agreement, by way of revocation by principal, by way of renunciation by the agent, simply agent resigning. So termination of agency comes into the picture. So by the act of parties, agency will be terminated in 3 ways: agreement, revocation, renunciation. Whereas by operation of law, the activity which I delegated to the agent, he performed the contract. Upon performance, when the activity is fulfilled, contract of agency comes to an end. Sir, where agency is for a fixed tenure, say for suppose 1 year. On completion of 1 year, contract of agency comes to an end. Death and insanity of the principal, death of the agent, parties no more, contract of agency comes to an end. Principal became insolvent, contract of agency comes to an end. Subject matter, For what purpose I appointed him as an agent? I appointed you as an agent. The purpose, it is impossible to happen. Suppose I appointed you to sell my house property. The next day, earthquake happened. House property completely damaged. Subject matter destroyed. Contract of agency comes to an end. Principal becoming alien enemy. Foreign principal suddenly war declared with that country. So principal becoming alien enemy. Contract of agency comes to an end during the war period. And termination of subagent's authority. See, principal is having agent. Agent is also having one more agent. Nothing but subagent. When principal terminates agency, automatically subagency will also comes to an end. Subagency will also comes to an end. So principal no need to give separate notice for termination of subagency. Understood, ma? But we had general rules with respect to revocation, with respect to renunciation. Those general rules are, first of all, if it is a premature revocation or premature renunciation, that means before expiry of the period only, if you are removing him from the agency, or if that person is resigning from the agency, then they need to compensate the aggrieved party. Aggrieved party. Is it clear? But if there is a valid justifiable ground, then compensation is not required and notice to be given. And the revocation and renunciation, either it can be expressed or implied. Principal doing the activity which was delegated to the agent, implied revocation, or agent not at all attending to the principal business, implied renunciation. Understood? Next one. When the agency is irrevocable. So generally, contract of agency is revocable, ma. Revocable. The person who is having authority to delegate is also having an authority to terminate the agency authority. However, in some situations, agency becomes irrevocable. One such case is agency coupled with interest. Agency coupled with interest. So I think 3 times, practical question came on this topic. Generally, agency is formed for the benefit of the principal. But sometimes, agency will be formed for the exclusive benefit of the agent. So agent is having interest in the subject. And this subject, the interest he is having at the time of creation of agency, at the time of entering into the agency. In the absence of contract to the contrary, such an agency is irrevocable. See, he should have some benefit other than remuneration. Generally, agent will have interest in every agency, remuneration. But this is something, beyond his remuneration. Beyond his remuneration. Generally, contract of agency, principal is having interest. So principal can't do all the things within the limited time. But sometimes agency will be formed only for the exclusive benefit of agent. So agency coupled with interest. Example, A gives authority to B to sell A's land and to pay himself out of the proceeds. So actually, B gives some money to A. So A is the debtor, B is the creditor. A is not paying any amount to B. That's why A authorized B to sell the land and recover sale proceeds. From the sale proceeds, whatever amount I'm due to you, direct those amounts. For balance amount, give to me. Give it back to me. So accordingly, B was appointed as an agent. So in this agency, along with A, who is having interest, sir? B is having interest. What kind of interest? Is it a remuneration interest? No, something beyond remuneration. In the absence of agency, in the absence of contract to contrary, these types of contracts are irrevocable. That means tomorrow A can't revoke B's authority until A discharge B dues. Suppose if A is paying complete money to B, complete dues to B, now B's interest in that agency comes to an end. Now A can terminate contract of agency. But keeping B's interest, A can't terminate contract of agency. Even at death of a principal, agency can't be revoked. Agency can't be revoked. And whenever agent incurs personal liability, or whenever agent exercises authority partially, in all these cases, principal can't terminate agency. Agency becomes irrevocable. And what are the effects of the termination? As you all know, from the date of termination onwards, act of agent, principal is not liable. But here, the point is when the matter got communicated with public. So a date of knowledge of public is important. From that date, act of agent is not principal is not liable to the third parties. Agent is personally liable to the third parties. Understood, ma? Everyone. So termination effective date, effective time of the termination. So when the notice actually reaches the public, so from third party point of view, when it comes to their knowledge, from that point onwards, agency termination is effective. Next one. So yes, agent is having a properties belonging to the principal, and suddenly principal got deceased. Now agent should hold all the properties on behalf of the legal heirs of the principal, and legal representatives comes into the picture. He should return all those things to the legal representatives or legal heirs. And I already told you, once you terminate agency, it automatically leads to termination of sub-agency authority. So this is a small, this is a marathon with respect to contract of agency. So with this Indian Contract Act, we completed. The next topic of marathon is Negotiable Instruments Act 1881. So this chapter is having a weightage of 12 to 14 marks, now including multiple choice questions. Very interesting chapter and very simple chapter. Don't take this chapter, choice. Follow me carefully. Before I start negotiable instruments, let's have a small discussion on contract of sale. So in a sale contract, you will find two parties, seller, buyer. Now sale, this sale is of two types. One is cash sale. The other one is credit sale. Under cash sale, the delivery of goods, delivery of ownership and payment of money will happen simultaneously. So seller will deliver the ownership, seller will transfer ownership to buyer will pay money immediately. It's a cash sale. But coming to the credit sale, seller will give some time period to the buyer to make payment. So delivery happens at one point of time and payment with respect to the delivery of goods will happen in future. So under credit sales, the buyer is used to give instrument to the seller. So this instrument gives a right to the seller. So tomorrow, on maturity date, you just come and claim money from me, or I'm liable to you this much amount. I will pay you this much amount on so and so date. If buyer makes default in making payment of this instrument, definitely seller will get a right over buyer. Seller can sue buyer, seller can take any action against buyer. In addition to this, this instrument similar to money, it is also transferable. Seller will have a creditor, seller will get goods from suppliers, seller need to pay amount to the creditors, yes or no. Seller will also have a supply creditors. So in every business, every business person will have creditor, every business person will have a debtor, yes or no. So business person will collect amount from the debtors and he will make payment to the creditors. So here, seller, if he has money, he will transfer money to the creditor. If he is having instrument, he will transfer the instrument to the creditor. So that means similar to the money, this instrument is also having a negotiability character, transferability character. Understood? So now this instrument is not a substitute to money, it is just complement to the money. So like this, in trade community, many people are following this kind of payment mechanism. And government of India observed this mechanism and they granted legal recognition to such payment mechanism. Accordingly, the law of negotiable instruments was enacted. So it was originally enacted in the year 1881, but the date of commencement is 1st March 1882, as we all know. So that's it. Law of negotiable instruments came into the picture. But government of India, it gave legal recognition only to the three instruments. So negotiable instruments cover only three instruments. What are the? Promissory note, bill of exchange, check. Promissory note, bill of exchange, check. Only these three instruments are covered under Negotiable Instruments Act 1881. Now let's see the meaning of negotiable instruments. So we are having two words, negotiable instruments. Instrument is nothing but a written document. A written document capable of creating rights and obligations on the parties. Rights and obligations on the parties thereto. So first of all, it's a written document. Instrument should be in writing. And the document, it's not just a document. It is capable of creating rights as well as obligations. Now, if you look into the example, buyer is having an obligation. So in future date, on future obligation. So when due date comes into the picture, buyer is liable to pay amount to the seller, and seller is having a right, right to get payment from buyer. So rights and obligations on the parties thereto. Now, if such instrument is transferable, if such instrument is freely transferable from one party to another party by way of delivery in case of bearer instrument, by way of endorsement and delivery in case of order instrument, then such instruments are treated as negotiable instruments. So very simple meaning, negotiable instruments. See, we are not having a meaning under Negotiable Instruments Act. I'm just telling you, negotiable instrument, a written document capable of creating rights and obligations on the parties thereto. If it is freely transferable from one party to another party, such instruments are called negotiable instruments. I used the word bearer instrument and order instrument. I'll explain these two terms in the next 5 to 10 minutes. Is it clear? But when you come to the definition of the negotiable instruments, we had a definition. Negotiable instrument refers to the bill of exchange, promissory note, check payable either to the order or to the bearer. So very simple definition. Negotiable instrument means promissory note, bill of exchange, check payable either to the order or to the bearer. Now, if you look into the features of the negotiable instruments, every instrument should be in writing only, written instrument. Definitely it should have a signature or else the instrument is invalid. Next one, it is transferable freely and indefinitely, an infinitum number of times. I already told you this instrument is having characteristics similar to the money. So money is freely transferable. So negotiable instrument is also freely transferable. So for transferring this instrument, no need of new contract. Simply, you can pass on the instrument. You can you can transfer title of the instrument to the next person. And there is no limit on number of transfers. Infinitum number of times you can transfer this instrument, but this transfer should happen, before within maturity. Holder in due course gets a good title to the negotiable instrument even though the title of transferor is defective. The Negotiable Instruments Act is an exception to nemo dat quod non habet. So the general rule, nemo dat quod non habet means no one can transfer better title than he possesses. So transferee title is equal to transferor title. So transferee will get same title as that of transferor. He can't get better title than that of transferor. But coming to the negotiable instruments, the legal recognition given to the instrument is one of the privilege we get because of legal recognition to the instrument is here the transferee will get better title than transferor. So transferee title is better than that of transferor. That means even though transferor title is defective, even though transferor is not having title, but transferee will get a good title, provided he need to satisfy three conditions. He should receive this instrument for consideration before maturity, and he should receive this instrument in good faith. Such transferee is treated as holder in due course. Detailed discussion of holder in due course I'll definitely give you after some time in this marathon only. So Negotiable Instruments Act is an exception to a rule nemo dat quod non habet. No one can transfer better title than he possesses. However, under Negotiable Instruments Act, a transferee will get better title than transferor possesses. Next one, negotiable instrument may have more than one payee jointly or alternatively. Now, if you take 2000 rupee note, yes, I can give this note to only one person. I can pay this amount, I can pay this amount only to one person. Suppose if I am liable to you 1000 rupees, I'll give you 2000, you will give me 1000, you will return me 1000. So at one point of time, this instrument, this money will have only one payee. But coming to the negotiable instruments, it can have more than one payee. That means, you can write more than one payee details on the instrument. First of all, who is the payee? So payee is the person who is entitled to receive amount on maturity date. Payee is the person entitled to receive money on maturity date. And instrument is drawn or made for consideration. Every instrument must contain an unconditional promise. If it is a promissory note, the negotiable instrument will contain unconditional promise. If it is a bill of exchange, it will contain unconditional order. And every instrument should be dated, signed, and next one, it should contain a money details, money, how much amount, some payable. So when to pay, how much to pay. So and the who is entitled to receive the amount of the payment. So everything should be there on the instrument. An instrument should be delivered. So me simply drawing of instrument does not create a liability. So simply drawing an instrument. Suppose I'm drawing a check in the name of my creditor and I'm keeping check in my pocket. Do you think the instrument is valid? No, that the instrument is not enforceable. See, this instrument is enforceable only when I deliver this instrument to my creditor. Then only my liability gets commenced. Then only his right over the instrument gets commenced. Understood, ma? So presumptions as to the negotiable instrument, as you all know, whenever the instrument is created, whenever the instrument is transferred, so law presumes that every instrument is created for consideration only. So buyer giving instrument to seller means, buyer bought some goods on credit basis from seller. So there is a consideration, only for consideration this instrument was created, and date mentioned on the instrument is the date of the instrument. Time of acceptance, every bill of exchange was accepted within a reasonable time after its date of the instrument but before the maturity. So if the bill of exchange is accepted, if it is a accepted bill of exchange, sir, when acceptance is given, sir, the acceptance may be given between date of the instrument and date of the maturity. It is a presumption, and every transfer of the negotiable instrument should be done before its maturity, and we presume that all the transfers happen before maturity only. What is a maturity? I'll tell you, just wait. And order of endorsements, I'll keep this point pending, you'll get to know at the end. Next one, every promissory note bill of exchange should be stamped, and every holder of the instrument, we presume that he is a holder in due course. And next one, in the event of dishonor of the instrument, when the instrument is forwarded to the court, court presume that this instrument is dishonored due to non-payment or due to non-acceptance. See, these are just presumptions and these are revocable. These are revocable. So until you know the fact, these presumptions will apply. For example, if you take accommodation bill, these bills are drawn without consideration. So until you show the proof, until you submit the evidence that this instrument was drawn without consideration, so till that point of time, court or anyone will presume that this instrument is created for consideration. Understood? These are just presumptions. These are revocable presumptions if contrary is proved. Understood? So let's begin our discussion with let's continue our discussion with a promissory note. So promissory note. So negotiable instrument definition, just now I told you negotiable instrument means promissory note, bill of exchange, check, payable either to bearer or to the order. Understood? So first instrument is promissory note. So what is a promissory note, sir? It is an instrument in writing containing an unconditional undertaking signed by the maker to pay a certain sum of money only to a certain person or order of certain person or to the bearer of the instrument. So we'll have a sale transaction. So buyer, seller. Unfortunately, this is a credit sale. So now buyer becomes debtor, seller becomes creditor. Now debtor is giving an instrument to the creditor. So he is making an instrument like this. So I promise to pay Mr. C a sum of rupees 3,000, 3 months after date, 3 months after date for the value, and it should be stamped, signed by Mr. D. So yes, every instrument should be dated. The date of the instrument is, imagine, 1st April 2023. Now this is the promissory note. Yeah, this is a promissory note. Example sake I'm telling you, this is a promissory note. So you can see here, a promissory note is an instrument in writing. Yes, this is in writing, containing an unconditional undertaking. Undertaking is nothing but a responsibility. See, debtor is accepting a responsibility. Debtor is telling to the creditor, sir, I purchased goods from you worth 3,000 rupees and I'll definitely make payment of rupees 3,000 after 3 months. And I'm giving this instrument as a security. Are you getting my point? So there is a promise. Is there any condition to this promise? Is there any condition attached to the promise? No. Suppose I promise to pay Mr. C if rain falls tomorrow. I promise to pay C if C marries D. I promise to see if earthquake happens in India. So all these are promises but attached to the conditions. Promises attached with conditions. So a conditional undertaking is invalid. The promise should be unconditional. And we had an exception to this rule. You can attach a condition provided that condition is certain to happen. Suppose I promise to pay Mr. C after the death of Mr. D. I promise to pay Mr. C after the death of Mr. D. Now, death is a condition, death will definitely happen. So there is no person on this earth who survived for infinite number of years. Understood? So death will certainly happen. Now, yes, there is a condition attached to the promise, and this condition will certainly happen. So this kind of conditions, conditions which is certain to happen, then they are valid promissory notes only. First of all, the promise should be unconditional. If you want to attach a condition, that condition should be certain to happen. If it is certain to happen, then also promissory note is valid. Then also, it will be covered under Negotiable Instruments Act. Act will apply. Next one, there should be promise to pay. And there should be an express promise to pay. Yes, when something is in writing, definitely it is an express contract only. Understood? So promissory note is an instrument in writing containing unconditional undertaking signed by the maker. Yes, Mr. D, debtor, the person who is making this instrument, he is signing the instrument. So promise to pay certain sum of money. So the money should be certain. That means there should be no contingent additions, contingent deletions. The amount should be certain or capable of being certain. Suppose 3,000 plus interest at the rate of 12% for 3 months. Now here the amount is not certain, but it is capable of being certain. You can add interest and you can arrive at certain amount. So when I'm using the word money, the money should be legal tender money. Suppose, if I tell that, I promise to pay Mr. C a sum of $3,000, it is not a valid promissory note. Are you getting my point? So legal tender money, amount should be certain. And, the promise should be with respect to money only. So the promise should be related to only money. It should not be related to any kind. Suppose, I promise to pay Mr. C a sum of rupees 3,000 and to deliver 10 kilograms of gold, 10 kilograms of silver. This is invalid promissory note. If it is invalid promissory note, Negotiable Instruments Act is not going to apply. And, it should be, the promise should be the promise to pay certain sum of money to certain person. So who is entitled to receive the amount, that person we call him as payee, and the person who creates this instrument we call him as a maker. So maker's nature of liability is primary and unconditional. So who is the maker in this case? Maker of the instrument is Mr. D, debtor. His nature of liability is primary and unconditional. So on due date, on maturity date, he need to make payment to Mr. C. Understood, ma'am? So here the details of the payee is provided. The details of the payee are given. So when the details of payee are given, such kind of instrument is known as order instrument. So instrument is containing an order. The person who is entitled to receive the payment, the details are provided in the instrument. Such kind of instrument we call it as order instrument. Suppose if the details of payee are not provided, then on maturity date, whoever possesses this instrument, he is entitled to receive amount of the instrument. Such kind of instruments are known as bearer instruments. Very simple. Payee details present, sir. Payee details present. Order instrument. Payee details not given, sir. Not provided. Then bearer instrument. So in case of order instrument, the person whose name is mentioned in the instrument is eligible to receive the amount of the instrument. In case of bearer instrument, the possessor of the instrument is entitled to receive the amount of instrument. Are you all getting my point, students? But according to Reserve Bank of India Act 1934, section 31, no person except Government of India and Reserve Bank of India can issue bearer promissory notes. Only Government of India and Reserve Bank of India are having power to issue bearer promissory notes. Other people can't issue bearer promissory notes. Are you all getting my point, students? Everyone. So this is all about promissory note, and parties should be certain. All other conditions we'll see. So to the order of certain person and to the bearer of the instrument. So we are having two parties: maker, payee. Maker, one who makes the instrument, simply debtor. His liability is primary and unconditional. Payee is the person entitled to receive the amount of the instrument, so simply creditor. So all essentials, I discussed in writing: express promise to pay, unconditional promise signed by the maker, promise to pay certain sum and only money. Payee should be certain and the instrument should be stamped. As per Indian Stamp Act, every man-made instrument should be stamped, or else those instruments are not enforceable. The object of Indian Stamp Act is simply to collect revenue. That's it. Nothing more than that. So it should be adequately stamped. Adequately stamped means the stamps affixed on the instrument should cover the value of the instrument. Understood? So this is all about promissory note. And the next topic is bill of exchange. So bill of exchange is an instrument in writing containing an unconditional order signed by the maker. Signed by the maker to pay a certain sum of money to a certain person or order of certain person or bearer of the instrument. The definition of the bill of exchange is very simple. Just look at the example. Same example ma. Seller, buyer, sale contract. Unfortunately, this is a credit sale. Now seller becomes creditor, buyer becomes debtor. Now you know creditor is imposing an order. Creditor is ordering a debtor. Creditor imposes an order on debtor. Make payment of so and so amount to so and so person on so and so date. If order is imposed by the creditor, that means if instrument is created by the creditor and if it is drawn on the debtor, that instrument is nothing but bill of exchange. Observe the difference. Promissory note is an instrument created by the debtor, whereas bill of exchange is an instrument created by the creditor. So creditor draws bill of exchange on debtor. Suppose A is selling goods to B, and to A Mr. C is the creditor. To Mr. A, C is the supplier. Okay, for avoiding confusion, yes. S supply raw materials to A, and A is producing finished goods and A is selling finished goods to B. Now, unfortunately, both the transactions are credit transactions. B is liable to A and A is liable to S. Now, what A will do? So, he will simply draw instrument like this. I order Mr. B to pay Mr. S or order a sum of rupees 3,000 3 months after date for the value. So man-made instrument, so stamp is required and signed by A. So date of the instrument, 1st April 2023. Accepted, Mr. B. So now when you read this instrument, so what you understood? So Mr. A is imposing an order on B. What is the order? Make payment to S or order. How much? 3,000. Amount is certain. When? 3 months after date. The maturity date. Just date of instrument, add 3 months and add grace days. So yes, for the value of the goods I sold to you, I'm drawing this instrument. And finally, it was signed by the maker of the instrument. So here the name of the maker is drawer. Who is drawer? Mr. A. And yes, on whom this instrument is drawn? On Mr. B. So instrument is drawn on Mr. B. And to whom this instrument is made liable? To whom the amount is, to whom Mr. B is liable to pay. To whom Mr. Drawee is liable to pay. Sir, yes, he is known as payee. So a bill of exchange is typically a tripartite agreement, tripartite instrument. So where you will find drawer, drawee, payee. Sometimes drawer and payee may be same person. Sometimes drawer and payee may be same persons. In that case, you can see bill of exchange is having only 2 parties. But majority cases, you can see 3 parties, drawer, drawee, payee. Now let's discuss the liability of each and every person. So coming to the drawer. Drawer is the one who draws the bill of exchange. So what is the nature of drawer liability? It depends upon drawee. Yes. See, in case of unaccepted bill, the drawer's nature of liability is primary. Whereas in case of accepted bill, that means drawee giving consent to the bill, drawee's liability becomes primary and drawer's nature of liability becomes secondary, and conditional. So why secondary? Tomorrow if Dravi makes payment, no problem, drawer gets discharged. But if Dravi fails to make payment to the payee, then payee will come and recover that amount from drawer. So drawer is having liability next to Dravi, so secondary. And if Dravi fails to pay the amount, then only drawer is liable. That's what conditional liability. So drawer is having secondary and conditional liability towards accepted bill, whereas unaccepted bill, drawer's liability is primary and unconditional. So who will give acceptance, sir? Drawi will give acceptance. And in addition, we are having two parties, Drawi in case of need. So when Drawi is not available, so don't treat that instrument as dishonored. Send this bill to a Drawi in case of need. That means refer this instrument to another person who will definitely give acceptance in case original Drawi is not available or original Drawi rejects the instrument. That party we call him as Drawi in case of need. Understood, everyone? And next one, we are having another party, acceptor for honor. If the instrument is dishonored due to due to non-acceptance, and if the payee wants to take action against the drawer on behalf of drawer, if any third person, if any person, outsider giving acceptance in order to honor the instrument, such person will call him as acceptor for honor, and such acceptance is acceptance for honor. So acceptance for honor will be given subsequent to dishonor of the instrument, and the nature of bill is dishonored bill with noting and protest. We'll discuss all these points in the coming questions. Don't worry. So bill of exchange will contain three parties: drawer, drawee, payee. Drawer's liability secondary to the accepted bill. Drawee's liability is primary to the accepted bill, and payee is the person entitled to receive amount of the instrument. Now looking at the essentials of the bill of exchange, first of all, instrument should be in writing. Yes, this instrument is in writing only. Containing an order to pay. Yes, there is an order. So don't think that order indicates command, or it's not something like Drawi is a slave to you. It's not like that. It's just a direction. It's just a direction. Next one, this order should be in express form. Yes, when something is in writing, definitely it is in express form only. Next one, the order should be definite and unconditional. So you should not attach any conditions. Conditional order is a null and void. Of course, if condition is certain to happen, then that instrument is valid. Next one, it should be signed by drawer. Yes, you can see drawer Mr. A signed the instrument, and this instrument is created for money only, and that amount should be certain, and only money, legal tender money, should be indicated on the instrument. Next one, all the parties to the instruments, that is drawer, drawee, payee, should be certain. Simply giving the names of the parties is not sufficient. The details of the persons should be given on the instrument. Simply Mr. B means you can find the name of Mr. B. You can find millions of people with the name Mr. B, many people. So you need to give complete details of the person. So parties should be certain. So parties should not be fictitious. Parties should be certain. And as we already know, man-made instrument stamping is mandatory. So once this instrument is completed, then delivery should happen. So delivery from drawer to payee. First drawer to drawee for acceptance, and then next drawer to payee for the purpose of getting legal enforceability to the instrument. So these are the essential features of the bill of exchange. Understood? So differences you can see: debtor creating an instrument promissory note, creditor creating an instrument bill of exchange. Debtor's liability, maker's liability under promissory note is primary, whereas maker's liability under bill of exchange is secondary. Accepted bills secondary. And you'll find two parties in bill of promissory note. You'll find three parties in bill of exchange. Promissory note will have a promise, bill of exchange will have an order, as usual So bill of exchange, promissory notes, payee to a certain payee, or order of the payee, or bearer of the instrument. But Reserve Bank of India Act, I told you, Reserve Bank of India Act restricted the persons from issuing bearer promissory notes and bearer bill of exchange payable on demand. So there can be a bearer bill of exchange, but there can't be a bearer bill of exchange payable on demand. These are the restrictions imposed under Reserve Bank of India Act 1934. The next type of the instrument is check. And as usual, forgot to tell you, acceptance is of two types. Acceptance is of two types. So here you can see drawee giving acceptance, right? This acceptance is of two types. One is qualified acceptance. The other one is unqualified acceptance. Qualified acceptance is nothing but conditional acceptance. Conditional. So imposing conditions with respect to limiting the liability, reducing the amount, increasing the time of the instrument, tenure of the instrument, or altering the place of payment, changing the place of payment, etc. Simply if you impose any condition in the acceptance, we call it as qualified acceptance or conditional acceptance. Qualified acceptance generally void, it makes instrument void. Unqualified acceptance, without any conditions, it makes instrument valid. Coming to the qualified acceptance, whether it is a void or valid, it is up to the holder. The holder is having an option to accept the qualified acceptance or to reject the qualified acceptance. If holder is okay with qualified acceptance, then instrument is valid. If holder rejects the qualified acceptance, then instrument is void. Holder have to take a care. If you are accepting qualified acceptance bill, you need to take prior consent from the parties. You need to take consent from the prior parties, or else the parties from whom you didn't took the consent, they are going to get discharged. They are not liable to you. Understood? So instrument is negotiable, ma. So I will give instrument to you. You can transfer instrument to someone. Someone can transfer instrument to their creditors. The person is in the hands of holder. Yes, the names reflecting on the instrument, simply from whom this instrument is transferred. All the persons are liable to the holder. So all the prior parties to the instrument are liable to the holder. Now the question is, in case of qualified acceptance, if holder fails to get prior consent from the prior parties, then all those parties will be discharged. Holder can recover instrument amount only from the drawee, simply acceptor. Understood? Next concept is check, ma. Next concept is check. The beauty of the Negotiable Instruments Act, topic 1 is linked with the last topic, ma. That means you can understand first topic only when you understand last topic. I'll give my best to you. Just try to follow me carefully. Some points which you didn't understand right now, you can understand them subsequently. By the time I complete this chapter, you will understand these topics in a comfortable manner only. So the next topic is check. So what is meant by check? So check is a bill of exchange drawn on a specified banker and not expressed to be payable otherwise than on demand, and it includes electronic image of truncated check and check in the electronic form. So you can see check here, pay a sum of rupees. I'll just write the details. So date 1st April 2023, pay Mr. Charan rupees 10,000. And yes, I'm creating this instrument, I'm drawing this, I'll just sign the instrument. So check being a bill of exchange, check will satisfy all the conditions. Check is required to satisfy all the conditions of bill of exchange except two conditions. What are they? For check, acceptance is not required. Acceptance is not required for check. And next one, the concept of maturity is not applicable to the check, because check is always a demand instrument. Check is always a demand instrument. So you can see here, not expressed otherwise, two negative words, just eliminate them. So every check is a demand instrument. Demand instrument means what, sir? So no need to wait for some time period, no need to wait. Immediately, the moment I give you check, you can go to bank and you can collect the money. So opposite to the demand instrument is time instrument. Under time instrument, what happens, I'll keep some time. Suppose, I promise to pay you 3 months after date. That means, you can collect amount from me only after 3 months. During these 3 months, I'm not liable to you. You won't get right on me. In case of bill of exchange, I order you to make payment 3 months after date. That means, only after 3 months you are liable to pay me, or you are liable to pay to the payee. So during these 3 months, I'm not having, I won't have any right on you, and you won't have any liability towards me during these 3 months. So time instrument. But coming to the check, it is always a demand instrument. A bill of exchange can be demand instrument, can be time instrument. But coming to the check should be always a time instrument or demand instrument. Check should be always, come on, tell me, check should be always a demand instrument. Check includes two kind of instruments, that is, electronic image of a truncated check and check in electronic form. But before discussing these points, just look at the point. Check is always drawn on a specified banker. specified banker. That means who the drawee is, banker. See, I'm having account in Punjab National Bank. Now I can draw a check only on Punjab National Bank. I can't draw a check on State Bank of India where I'm not having account. Understood? So now you can see an example. See, Mr. V, yes, I bought goods from Mr. C. I'm the debtor and C is my creditor. To settle this sale consideration, say for suppose 50,000, I'm drawing a check on Punjab National Bank. So bill of exchange, check is a bill of exchange, yes or no? So you get a doubt, sir. Bill of exchange is an instrument drawn by the creditor, right? But in your example, a debtor is drawing an instrument and it was made payable to creditor. How it is correct? So don't look between, don't look the relation between V and C. Just look the relationship between V and Punjab National Bank. See, Mr. V is having account in Punjab National Bank. In that account, the balance is, say for suppose 90,000. So with respect to this 90,000, PNB is my debtor and to PNB, I am the creditor. I'm the creditor to PNB. Now, I'm imposing an order on the PNB. So bill of exchange is an instrument in writing containing unconditional order. So I'm ordering PNB to pay a certain sum of 50,000 to Mr. C. And check, you all know it is a demand instrument, so no time for payment will be mentioned on it. If you mention any time period, then instrument is void. Understood, ma? So now look at the parties in this case. You are having three parties, ma. One is the drawer of the instrument, Mr. V, drawer. The next one is drawee. Drawee is always a banker, specified banker, and payee. Sometimes in case of self check, you can observe, drawer and payee both are one and the same. Self checks. Understood? So three parties are there. Drawer. Here drawer is the person one who makes the check. Drawee is the person on whom the check is drawn. Payee is the person who is entitled to receive money. Now when you look into the essentials of check, it should be in writing. Obviously instrument should be in writing. Check is also in writing. And it should contain an order to pay. Express order to pay. And this order should be definite and unconditional. And check should be signed by drawer. Next one, check should contain a sum of money, details of the money. That amount should be certain sum of money. Money should be legal tender money, as you all know. Next one, all the three parties, drawer, drawee, payee, should be certain, so not fictitious. And next one, it is always payable on demand. So stamping, acceptance not required. This is not a man-made instrument. This is an instrument made by the banker according to the Banking Regulation Act and Reserve Bank of India Act. So this doesn't require any stamping, ma. So no need of stamping and no need of acceptance. Why? If PNB, if my banker is having a sufficient bank balance, then only it will make payment. Or else, it won't make payment. It will dishonor the instrument. Understood? So the primary liability lies on the drawer to maintain sufficient funds before issuing the checks. Understood? So if sufficient money is there in my account, definitely the primary liability lies with Punjab National Bank only. So now, check is of two types, ma. Bearer check, order check. Bearer check means, payee details not present, bearer check. Order check means, payee details present, order check. So in case of order check, who can receive the amount of the instrument? The person whose name mentioned on the instrument. The person whose name mentioned on the instrument can recover amount of the instrument from banker. If no name, no payee details are mentioned, then it is a bearer instrument. The possessor of the instrument can get that money, can recover the money of the instrument. Understood, ma? So with this, three instruments, promissory note, bill of exchange, check, we completed. Of course, we are having two small points, electronic check and truncated check. I'll tell you. The electronic check means, check in electronic form, simply online payments. Now, when you look into the NEFT, UPI transfers, RTGS transfers, all this comes under, electronic check only. So where creation of the check, typing, writing, amount, how much, who the payee is, and then signing in the form of digital signature or entering one-time password. So simply creation, making, next one, signing, transfer, everything will be online only. That is check in electronic form. Example, you can record NEFT, RTGS. Coming to the truncated check. Truncated check, initially this is a check in a physical form. But in the process of payment, in the process of making a payment, this will be converted into online copy. This will be converted into soft copy. Such conversion is nothing but truncation, and such check is known as truncated check. I'll tell you. See, drawer is having account in Axis Bank and payee is having account in Punjab National Bank. So drawer send the check to payee. Now payee is having two options. Either come to drawee bank, stand in a queue, collect the money. Or he's having another option, deposit it with his banker. PNB. PNB is known as collecting banker. Now collecting banker, what it will do, sir? Generally it will forward this check to Axis Bank. Upon verification, Axis Bank will give consent to PNB. PNB will credit the amount to payee account. But banks will receive, don't think that they will receive only one check per day. They will receive a number of checks. And don't think that all banks will stand in a queue. No, don't think that all banks will be at one place. No. So all banks will have a department in a clearing house. So now the point is, all the banks will forward the checks to the clearing house. The clearing house, a respective branch, respective bank will forward the checks to remaining branches. So yes, PNB department will call Axis department and they will tell that like this, we received a check which was drawn on your bank. Now clearing house will get that information from Axis Bank, whether the account is there or not, whether account balance is there or not, and then next one, whether signatures are matching or not, everything. So once Axis Bank give consent to clearing house will give consent to the Punjab National Bank. So the point is, check is a paper form. Check is in paper form. Ultimately, these transmissions, it will take more time. So yes, there will be delay in payment, first thing, and next one, it is in a paper form, so unsecured manner. So it is subject to wear and tear. And moreover, the payments with respect to this kind of checks, it's not in a timely manner. Definitely they will consume some 3 to 4 working days. So to avoid this time, a process was introduced, that is a truncation. The moment collecting banker receives the check, he will take a photocopy of the check, simply scan copy. That scanned copy will be sent to the clearinghouse over email, instant email, immediately. Clearinghouse will forward the mail to Axis Bank. They will immediately give consent and clearinghouse will forward the consent to PNB. PNB will credit the amount. This will happen in one day. Now here, you can avoid a paper form of check, and next one, the payments are very prompt. So in 1 or 2 working days, the payment will be credited. So minimizing the size of the object, we call it as truncation. Paper check, you can see, paper forms, for example, this much. Now image, when you take image, you can see, small size and, short pic in a mobile or in a laptop, you can see it. So for the purpose of transmission, substituting, truncated check is used. So in truncated check originally it is in a paper form. Creation, making, signing, everything is manual, but in the process of transmission, in the process of payment, it gets converted into a soft copy, electronic image. That is nothing but truncated check. Now the provisions of Negotiable Instruments Act, which are applicable to check, are equally applicable to electronic check as well as truncated check. Essentials, we already completed writing. No, it's a wrong word, express order to pay, definite and unconditional order signed by the drawer maker. Some in the orders must be certain. Order to pay money, and all the 3 parties should be certain. Check is always a demand instrument. Check should be always drawn on banker only. Understood, ma? So these are the 3 types of the instruments. Next one. So yes, differences, you can go through it. Bill of exchange check, bill of exchange, drawee can be any person. Drawee can be any person. But coming to the check, drawee should be a specified banker. Next one, bill of exchange can be time instrument or demand instrument, but check should be always a demand instrument. Bill of exchange doesn't require stamping. Sorry, bill of exchange requires stamping. Check doesn't require stamping. Bill of exchange, noting and protest is mandatory. Noting and protest is mandatory if his instrument is dishonored. But for check, noting and protest is not required. So like that, we had a differences. You can write these differences only when we complete the chapter. Next topic is holder in due course. I'll cover everything, don't worry. Holder in due course, very important. You can't expect a question paper without holder in due course topics. So holder is a person. He must be entitled to two rights, one is he must possess instrument in his own name. Next one, he is entitled to recover or receive the amount of the instrument. When these two conditions are satisfied, then only we call him as holder. Everyone, holder is a person. He should satisfy two conditions. One, he is entitled to possess instrument in his own name. He is entitled to recover amount of the instrument. Suppose if you take a bearer instrument, I already told you bearer order. Bearer instrument, bearer instrument, the details of the payee are absent. So simply the possessor is entitled to recover amount of the instrument. Whereas order instrument, the payee whose name mentioned in the instrument, only that person can recover amount of the instrument. Okay, so this classification was happened only because of negotiation, ma. The reason is negotiation. How can we negotiate? How can we transfer bearer instruments, sir? Bearer instrument you can transfer only by simple delivery. With a view to transfer ownership, if you keep instrument in the hands of your creditor, that's it. Delivery is set to be completed. Negotiation is completed. Sima, I went to a shop. I bought some items. The value of items is 2000 rupees. The moment I take 2000 rupees from my pocket, the moment I keep 2000 rupees in the hands of shop owner, that's it. Ownership with respect to 2000 rupees gets transferred to the shop owner. And you all know it's a bearer instrument. 2000 rupees is a bearer instrument. On that instrument, you can see I promise to pay bearer a sum of rupees like that. A matter will be there. Just go through it. You will come to know. So simply by delivery, ownership will be transferred in case of bearer instrument. Now the person who holds that instrument is the owner of the instrument. Holder is nothing but owner only. Holder is nothing but owner only. Now coming to the order instrument. Suppose one of my client gave me a check. Audit fees 15,000 rupees. He gave me a check. On the check, my name is mentioned. So who is the payee? I'm the payee. Now who is entitled to receive the amount of the instrument? Only Mr. D.V. Subramaniam. Now I'm having a creditor. The due is 15,000. Now I want him to collect amount of the instrument. If he show this check in the bank, banker will make payment to me, not to him. Why? The name of the instrument, the name on the instrument is Mr. D.V. Subramaniam. Now I should do something so that my ownership should be transferred to that party. That something is nothing but negotiation. And for the purpose of negotiation, what I'll do? I'll simply make endorsement and delivery. So endorsement is a means. Negotiation is an objective. So negotiation is my ultimate objective, transfer. But for achieving that objective, I need to employ some resources. Those resources are endorsement and delivery. Endorsement, simply on the back of the instrument or on the face of the instrument, I will make a signature. So pay, for example, my creator Mr. Charan, pay to Charan, I'll sign it. This is a full endorsement. The moment I deliver this instrument to Charan, he becomes owner of the instrument. He becomes holder of the instrument. Now you come to know who is the holder. So simply holder means the person who possesses instrument in their own name. If it is a bearer instrument, there should be a possessor. That means they receive this instrument under delivery. If it is an order instrument, he should receive that instrument under endorsement and delivery. That is condition 1. So now tell me, my dear students, finder of lost goods, thief, are they holders or not the holders? The answer is not the holders. Why? Finder of lost goods, finder of lost instrument, he didn't get the instrument under delivery concept. Someone lost it and he took the instrument because Indian Contract Act is imposing an obligation on finder to find out the true owner and to return the item to the true owner. Yes or no? Yes or no? The next point, if you see the thief concept, when you look into the thief concept, what happens here? He is stealing the instrument from the owner of the instrument. That means he is not getting instrument under delivery. He's looting an instrument from the owner. So therefore, and moreover, these two people are not entitled to possess instruments on their own names. So in their own names, they are not entitled to possess. So finder of lost instrument and thieves are not treated as holders. Next point, he must be entitled to recover the amount of the instrument. That means he should be a qualified person. Suppose I'm insolvent. I received instrument. Now I can't recover amount of the instrument. On behalf of me, official assignee, official receiver can recover the amount of the instrument. Now, an insolvent person or a person disqualified by the law, even though they possess instrument in their own name, but they are not entitled to recover amount of the instrument. Therefore, they are not treated as holder of the instruments. Understood? Next one, holder for value or holder in due course. So holder for value. If a person becomes holder, for consideration. No, that means, for consideration only he is getting the instrument. Then we call him as holder for value. Understood? So the next topic is holder in due course. So holder in due course, he is a holder. In addition to the holder condition, he should satisfy three conditions. That is consideration, and he should possess instrument. He should get an instrument before maturity, and he should get this instrument in good faith. That means without sufficient cause to believe that any defect existed in the title of the person from whom he delivered the title, from whom he derived his title, and the instrument should be complete and regular on the face of it. So that means it should be complete. So any person satisfying these conditions, holder plus consideration, obtaining instrument in good faith. Good faith means he should not have any knowledge about the defects in the title of the transferor. And next one, he should receive instrument before maturity. Of course, if it is a demand instrument, this condition is not applicable. So when these conditions are satisfied, he will be called holder in due course. The privileges, the privileges of holder in due course, you can see one by one. Sorry, we will have a discussion on one by one. A holder in due course means a person satisfying these four conditions. First of all, he should be a holder. He should receive instrument for consideration. He should receive instrument in good faith and before maturity. So good faith means what? So he should not have any knowledge of defects in the transferor title. I'll discuss this point with you. Just wait 5 to 10 minutes. Before during these 5 to 10 minutes, let us complete types of negotiable instruments. Order instrument, we already discussed. If instrument is payable to a certain person, particular person, or expressed to be payable to a order of particular person, then it is nothing but order instrument. Of course, that order instrument should not contain these words, prohibiting transfer or indicating an intention that it shall not be transferable. Suppose, pay to A only. Adding this word only, it indicates that yes, payment should be done only to A, not to any other party. Now, when you are adding these words, it leads to the restriction on transfer. So now Mr. A or the subsequent parties can't transfer this instrument. Why? Because the instrument is containing an order only make payment to one person, that is only A. So adding this kind of words, the instrument loses negotiability character. If the instrument loses negotiability character, then Negotiable Instruments Act is not applicable. Sima, agreement enforceable by law will become a contract. Indian Contract Act will apply. In that agreement, if people removes this legal enforceability word, if they don't want legal enforceability and they waive this legal enforceability, now this is simply an agreement. To this agreement, Indian Contract Act will not apply. Courts will not accept this kind of agreements. Yes or no? Similarly, as long as instrument is a Negotiable Instruments Act will apply. Clear? So if you are adding a words so that the instrument is losing negotiability character, then it is no more a negotiable instrument and Negotiable Instruments Act is not going to apply. Next, bearer instrument. An instrument is payable to bearer if it is expressed to be payable. So that means I promise to pay bearer, or on which the last endorsement is endorsement in blank. Just now I told you an order instrument can be negotiated by way of endorsement and delivery. First of all, order instrument means what? The details of payee present. Now, listen carefully. A gave check to B. So, in check, yes, you can find like this, pay B. Sum of rupees 8,000 and signed by A. Now, this is an order instrument. So, B is having a creditor, Mr. C. B is having a creditor, Mr. C. Now, if B want to make C owner of the instrument, then he need to negotiate the instrument. So, through negotiation, a holder can transfer his title to the subsequent parties. To the subsequent parties, ownership will be transferred only through negotiation. But since this is an order instrument can be negotiated by way of endorsement and delivery. So, endorsement means simply on the back of the instrument or on the face of the instrument, simply signing by the holder. So, B keeping sign. Keeping his signature on the instrument. So now the point is, if we add the direction of payee, suppose if we mention the details of the payee like this, pay to C and B signing the endorsement, this kind of endorsement we call it as full endorsement. The effect of full endorsement is an order instrument will be continued as an order instrument only. Order instrument continued to be order instrument. Suppose B, without indicating the details of payee, suppose he is keeping payee details blank. Payee details blank. The last endorsement, under the last endorsement, the pay details are blank. Such kind of endorsement, we call it as blank endorsement. And the effect of blank endorsement is an order instrument will be converted into bearer instrument. Understood? So blank endorsement converts order instrument into bearer instrument. So that's the definition of bearer instrument. So bearer instrument, at the time of creation, it is a bearer. Or at the time of creation, it is an order. But due to blank endorsement, it becomes a bearer instrument. The promissory note, you can't create a bearer instrument. Of course, you can convert order promissory note into bearer promissory note by making blank endorsement. Hope everyone understood the point. At the time of creation of promissory note, payee details should be present. Now the payee, the person who is the holder of the instrument, he can make blank endorsement so that he can convert order instrument into bearer instrument. This is permitted. So promissory note can't be made payable to bearer means at the time of creation, this restriction, these rules will apply. But in the process of negotiation, you no need to satisfy these conditions. So under negotiation, promissory note can become bearer. But when you look into the face of the promissory note, it is an order instrument. Why? It contains the details of the payee. In the process of negotiation, it got converted into bearer instrument, permitted. Next one, demand instrument. If no time for payment is specified, time for payment is not specified, then it becomes demand instrument. So it can be presented for payment at any time. Time instrument, if time period is specified, say for suppose 1 month, or on 1st August 2024, or 3 months after date, 3 months after site, or after the death of Mr. D, after happening of an event, after death of D. So like these points, if you observe on the instrument, then that instrument is a time instrument. Time instrument, the maker of the promissory note or drawee of the bill of exchange, simply acceptor, they are liable only after expiry of the time period. Only after expiry of the time period. And moreover, every time instrument is eligible to get 3 grace days benefit. Next kind of instrument is inland instrument. Inland instrument. Only 3 points you need to understand. First one, drawn or made. So bill of exchange drawn, promissory note made. Next one, drawn or made. This is condition A. Condition B. Condition B. Payable in. Condition number C. Payable by a person resident of. Payable by a person, simply drawee in case of bill of exchange, payable by a person resident in. So you are having 3 questions, 3 points, drawn or made, payable in, payable by a person resident of. So to these 3 questions, the first one should be in India. And out of BC, anything should be in India. Either B or C should be in India. So A and B combination or A and C combination. That means, drawn or made in India or made payable in India. Or drawn or made in India and drawn upon a person resident in India. So any of these conditions are satisfied, then we call it as inland instrument. So an instrument which is not an inland instrument, we call it as foreign instrument. So foreign instrument means it is an instrument which is not inland instrument. If a foreign instrument is dishonored, subject to the foreign negotiable instruments law, this instrument should be noted and protested in the event of dishonor. Coming to the inland instruments, such condition is just optional. Noting and protest are just optional. Noting and protest will act as an evidence that instrument is dishonored. See, tomorrow I'm the holder of the instrument. Tomorrow, one of the instrument got dishonored. Suppose one of the instrument got dishonored. So immediately I'll go to the court. Sir, so and so person failed to make payment, sir. Now court, based on my statement, based on my representation, it won't give judgment. It will investigate the things. So it will call the maker of the promissory note or acceptor of the bill of exchange. Did you make payment or did you made a violation in fulfilling your duties? So after inquiry, investigation, finally court will give judgment. So this will definitely take a lot of time. To minimize this, to minimize this time wastage and for faster judgment, I'll go to notary public. I'll give the dishonored instrument to the notary public. I'll ask him to cause noting and protest. Notary public on behalf of me, he will present one more time for payment. If the counterparty is making payment, no problem, instrument is said to be honored. If counterparty, if he is not again, if he is not making payment and is returning the instrument, now notary public, public servant, he will write the reasons of dishonor on the instrument, that is nothing but noting. In addition to that, he will issue a separate certificate with respect to dishonor of the instrument. We call it as certificate of protest. So noting, protest, very simple concepts. Noting, reasons of dishonor will be recorded on the instrument itself, noting. Separately recorded on a certificate, and a separate certificate was issued, certificate of protest. Now these two things will act as an evidence in the court of law that instrument is dishonored. So without wasting much time, judge will give judgment. Understood? So for foreign instruments, noting and protest is mandatory, subject to foreign negotiable instrument laws. Once again, I am telling you. And in case of foreign instrument, this is a really a tricky point. Really a tricky point. Just try to understand the paragraph. Try to understand the condition. Drawer of a bill of exchange, he is from USA. Drawee of a bill of exchange is from UK. So drawer, drawn bill of exchange. So place of drawing, place where the instrument is drawn is USA. And place it got accepted, place it got accepted is UK. Finally, this instrument is endorsed to a person resident of India. Now, in the person, in the hands of Indian, this instrument is a foreign instrument. You're getting my point. Now, this instrument is dishonored. Now, this Indian person, if he want to file a suit on drawer, then the person, the drawer liability is decided by the place where the instrument is drawn law. I'm repeating the point. The drawer, suppose the payee, Indian, if he want to file an action, if he want to take an action on the drawer, then the place, the law where the place the instrument was drawn, law of the place where the instrument is drawn, that law is going to apply. Suppose as per USA law, for a dishonored instrument, drawer should pay interest at the rate of 12%. Then drawer is liable to pay 12% interest. Indian person is entitled to get interest at the rate of 12%. Suppose if this Indian payee want to take action against a drawee, then the law of the place where the instrument got accepted, will decide. Or simply where it was made payable, it's not accepted, where the instrument is made payable. See, the respective liabilities of the acceptor and endorser by the law of place where the instrument is made payable. So place where the instrument got accepted, UK, and place where the instrument is made payable is also UK. On the instrument you will find all these terms and conditions, so let me tell you one more time. So the liability of the maker of the instrument or drawer of the instrument is regulated by the law of place where the instrument is drawn or made. So let me tell you one more time, you'll get a clarity. So foreign instrument, it got negotiated and finally it reached a payee from India. So this instrument is drawn in USA and it was accepted and payable in UK, but finally dishonored due to non-payment. Now this Indian payee, if you want to take action against a drawer, then the law of place where instrument is drawn will apply. If you want to take action against endorser, or if you want to take action against a drawee, then place where the instrument is made payable, that law is going to apply. Suppose as per UK law, rate of interest would be 13% per annum. 13% per annum. Now if this Indian payee take action against a drawee, then this Indian payee is entitled to recover 13% interest. If Indian payee wants to take action against drawer, then he can recover interest at the rate of 12% only. So respective country laws will apply. Which country laws are? On whom you want to take action? Sir, I want to take action on drawer of the instrument or maker of the promissory note, sir. Maker of the promissory note or drawer of the bill of exchange, sir. Okay, place where it is drawn, that law is going to apply. Sir, I want to take action against the acceptor of the bill or endorser of the instrument. Okay, place where it is made payable, that place law is going to get applied. That is all about liability of the maker drawer in case of foreign instruments. Next one, ambiguous instrument. Ambiguous, confusion, not clear, uncertain. Just look at the example, but before going with the example, just see the point. In case of bill of exchange, the maker and in case of promissory note, the maker. Who is the maker? So in case of bill of exchange, creditor is the maker. In case of promissory note, debtor is the maker. And what is the nature of liability? Nature of liability of maker. Maker's nature of liability. Sir, in case of bill of exchange, maker's nature of liability is secondary and unconditional. Sorry, secondary and conditional. And in case of promissory note, nature of maker's liability is primary and unconditional. Are you all getting my point, students? Observe the situation. Bill of exchange, who is the maker? Creditor. Promissory note, who is the maker? Debtor. And what is the debtor nature of liability under promissory note? Primary and unconditional. What is the creditor liability under bill of exchange? Secondary and conditional. These are the features of the bill of exchange and the features of the promissory note. Understood? Understood. Now the point is ambiguous instrument. On the face it's a bill of exchange, but features are matching with promissory note. Features are matching with promissory note. Such kind of instruments we call them as ambiguous instrument. So where an instrument may be construed either as a promissory note or a bill of exchange, or the holder may at his option treat it either and the instrument and henceforth shall henceforth be treated accordingly. I'll tell you an example. Suppose Mr. A drawn bill of exchange on M. So A is the drawer of the instrument. That means A is the maker of the instrument. Follow the example. Only I'm going to tell you only one example. Only with this example you should get a clarity on this. So who is A? Drawer, maker, and M is a drawee to the instrument. And this was made payable to a P, pay of the instrument. Now, as per bill of exchange rules and regulations, as per bill of exchange features, maker's liability for bill of exchange is secondary and conditional, and drawee's nature of liability is primary and unconditional. So on the face of the instrument, what is the instrument? Bill of exchange. Face of the instrument, bill of exchange. Okay. So later P came to know that Mr. M is minor. He is incompetent to the contract. So minor is not liable under any arrangement. Accordingly, this drawee is not at all liable. In that case, tell me who is liable to Mr. P? Who is liable to Mr. P? Sir, A is liable to Mr. P. And what is A's nature of liability? Sir, without any restriction, primary and unconditional. So who is A? Maker. What is his nature of liability? Primary and unconditional. First of all, what is the name of the instrument? Bill of exchange. See, the name is bill of exchange, but the features are matching with the promissory note. Observe my example carefully. So name bill of exchange, but maker is having primary and unconditional liability. Why? Because the drawee is incompetent person. Suppose drawee is a minor, or drawee is a fictitious person. Example, drawee is a fictitious person, or drawee is an agent to drawer. In all these three examples, just observe, just analyze. Who is the drawer? Mr. A. What is his nature of liability? Primary and unconditional. See, maker having primary and unconditional liability is nothing but a promissory note. But when you look into the instrument is containing the word, order, everything, unconditional order, promise to pay certain sum of, order to pay certain sum of money to certain person, or order of certain person. Everything is like, bill of exchange. So name a bill of exchange, features promissory note. There is a confusion. Such instruments are treated as ambiguous instruments. And holder will be given an option. Come on, holder, you decide. If you want to treat it as a bill of exchange, it will be bill of exchange. If you want to treat it as a promissory note, it will be promissory note. So next subsequent parties, subsequent parties will treat this instrument according to your option only. And once you select the option, it will be irrevocable. So if you choose it as a promissory note, it will be promissory note forever. Understood, ma? So an ambiguous instrument treated as a promissory note or a bill of exchange, and it can't be treated differently afterwards. Once you treat it as an instrument, subsequently you can't modify it. And of course, if the amount mentioned on the instrument, in figures and words, if both are not matching, suppose, in figures it's 80,000, and in words it is like 8,000. Now, which thing I should take, sir? There is a confusion, no, sir. Now, do you think holder will have an option to select the correct option? No, 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 no. Holder will not have any option to choose. Here, when there is an ambiguity with respect to the amounts, so you just go with the words. Why? Because, a man will write words correctly, but with respect to figures, there may be a confusion. So there is a probability that he may write wrong number. But coming to the words, he will write incorrect only. He will write as a man of ordinary prudent. Yes or no? Are you getting my point, students? Everyone? So this is all about ambiguous instrument. Next one is inchoate instrument. Generally, instrument should be complete in all aspects. If it is incomplete in certain aspects, like amount of the instrument, details of the payee, tenure of the instrument, payee details, place of payment, if these are incomplete, then we call it as inchoate instrument. So instrument may be incomplete in all aspects, or it may be incomplete with respect to amount aspect. So generally, the drawer of the instrument, if he is not sure with respect to the amount of instrument, how much is the actual amount, if he is not sure with respect to the actual amount of consideration, he will give a blank instrument to the holder, and he will authorize holder to fill up the amount. So on the date of the transaction, whatever would be the amount, you just fill that amount on the instrument. Like that, giving a blank instrument is nothing but inchoate instrument. So the holder gets an authority to make or complete the negotiable instrument. Understood? So conditions, in order to call an instrument as an inchoate instrument, some conditions should be satisfied. That is, it should be signed. The maker of the instrument should sign the instrument. It should be stamped. Of course, this condition is not applicable to check, only for promissory note and bill of exchange. And this instrument is either wholly blank or partially blank. With respect to amount, partially blank. The person signing such negotiable instrument delivers it to another person. So it should be signed, stamped, delivered instrument. So these three conditions should be satisfied. In addition to this, there should be certain blanks. So here the drawer of the instrument is giving a permission or authority to the holder to fill up the amount. Such kind of instrument we call it as inchoate instrument. Inchoate instrument. Now, sir, how much amount we can fill, sir? How much amount we can fill? See, the holder of the instrument can fill intended amount. Intended amount. So what is the actual amount of the consideration? Only that much amount he can fill. But coming to holder in due course, he can fill any amount, full amount, subject to the value of stamps affixed, value covered by the stamps, value covered by the stamps, subject to the value covered by the stamps. I'll tell you. Suppose each revenue stamp, it is covering a value of 1 lakh rupee. Example, each revenue stamp is covering a value of 1 lakh rupee. Now buyer is sending a promissory note to seller. I'll take one note for better understanding. Yes, each revenue stamp, imagine each revenue stamp is covering a value up to 1 lakh rupee. So for 1 lakh rupee transaction, one stamp should be affixed. So buyer is making a promissory note and he is sending the promissory note to seller. However, he is not sure with respect to the consideration. So it might be 7 lakhs to 8.5 lakhs. The range would be 7 lakhs to 8.5 lakhs. So what this buyer did, he made a blank promissory note. He signed the promissory note and he affixed almost 9 stamps. Why? Because for each 1 lakh, one stamp is required. Now if the consideration would be 8.5 lakhs, then 8.5 stamps required. Half stamp is not possible, 9 stamps. So he fixed 9 stamps. He fixed 9 stamps and he signed all the 9 stamps. He signed the promissory note. So the sign should be on all the stamps. Stamp should be cancelled by way of signature. Now buyer is giving a permission to the seller to fill up the amount. So on the actual date of transaction, imagine the consideration is just 8 lakhs. Now how much amount the holder, the seller can fill up in the blank, sir? Only 8 lakhs. Suppose if seller fill it as a 9 lakhs, how much amount he can recover, sir? And how much amount he can recover, sir? Only he can recover 8 lakhs only. He can recover only 8 lakhs. So the holder of the instrument, the party next to the, a maker of an inchoate instrument, he can recover only the actual consideration, intended amount, that is only 8 lakhs. Even though he fill a highest amount, even though he fill it up with more amount, he can recover only the actual consideration, that is 8 lakhs. Understood? Suppose the holder, since it is a negotiable instrument, no need to wait till maturity. He can negotiate this instrument to some other person. Suppose yes, transfer this instrument to H for 9 lakhs consideration. 9 lakhs consideration. H is a person received this instrument for entire 9 lakhs. H is not having any knowledge with respect to the fraud committed by yes. So H is thinking that yes is having title with respect to 9 lakhs. Yes, fill this blank as a 9 lakhs. Yes, fill this blank with 9 lakhs, and yes, transfer this instrument to H. H received this instrument for entire 9 lakhs. H received this instrument in before maturity and in good faith. Good faith means H is not having any knowledge of yes defects title. Yes is having a defective title. See, yes is not having a title with respect to 9 lakhs. Yes is having title only with respect to 8 lakhs. That fraud thing H is not aware of. Now H will be called holder in due course. I already told you, holder in due course, the title of the transferee, the title of the holder in due course is always superior than transferor title. So transferee will get better title than transferor possess. Are you all getting my point? Transferee title is always better than transferor title. That's what Negotiable Instruments Act teaches us. Are you all getting my point? Now see the case. How much amount H can recover? The question, how much amount H can recover? Sir, H can recover entire 9 lakhs, sir. Why, sir? Yes is having title up to 8 lakhs only, no, sir. Of course, H being holder in due course, the holder in due course will get complete title, provided he should receive instrument for complete consideration, he should receive instrument before maturity and in good faith. So since H satisfied all these three conditions, and moreover he is a holder, he will get title with respect to entire 9 lakhs. Sir, what if, yes, instead of filling it as a 9 lakhs, if we fill it as 10 lakhs, the blank was filled with 10 lakhs, and yes, transfer this instrument for 10 lakhs. Now for how much amount H is entitled to recover? Sir, H is entitled to recover only 9 lakhs. Why? Because he will get title. He will definitely get title. Actually S is having a right up to 8 lakhs, but H will get a title of up to 9 lakhs. More than 8 lakhs, but restricted to 9 lakhs. The reason is only 9 stamps were affixed. So now the instrument can cover value up to 9 lakhs. I told you each stamp is covering a value of 1 lakh. 9 stamps are affixed. So 9 stamps will cover value of 9 lakhs. Now holder in due course can recover any amount subject to the value covered by the stamps. Understood, ma? So that's what advantage of holder in due course. Advantage being a holder in due course. So holder in due course can recover whole amount, but not exceeding the amount covered by the stamps. Whereas holder, he can recover only the intended amount. So for how much amount he was given authority, only that much amount he can recover. You may ask me, sir, if H recover 9 lakhs from B, then it is a loss to B, no sir. 1 lakh loss to B, no sir. No problem. B will recover amount from yes, payment made under mistake. B will recover amount from yes, and yes committed the fraud, right? So yes is liable to B rupees 1 lakh. B can recover 1 lakh from yes. Understood, everyone? So this is an inchoate instrument. Next one. So with this, we are having one more instrument, that is, fictitious bill. So fictitious bill is an instrument where the drawer and payee are fictitious. Either drawer or payee or both fictitious, we call it as fictitious instrument. So drawer, the one who makes the instrument; payee, the person who is entitled to receive amount of the instrument. Both, if these both drawer and payee are fictitious, then we call it as fictitious bill. Very simple. I'm drawing instrument on you, but I'm not giving my details. I'm giving the details of a person who is not in existence. Why? You are my relative. If I ask you money, you are not paying me. You're not paying me. That's why, before giving a goods on credit basis, I told you these goods belong to so and so person. Actually, that so and so person is not in existence. Now I'm drawing a bill. I'm pretending. I'm making a. I'm writing a bill like this. So this bill was originally drawn by a person, and that person is not in existence. Sima, for example, Mr. Chaitu is not a real person. He's not in existence. Now I'm drawing an instrument in the name of Chaitu. So I'm telling that Chaitu is the owner of the goods and Chaitu is drawing the bill of exchange, and this should be made payable to Chaitu. Like that, I made an instrument and you accepted to this instrument. Now looking at the instrument, drawer is Chaitu, payee is Chaitu, both are, drawer and payee, both are fictitious. So this is a fictitious bill. So generally fictitious bill is not enforceable. Why? Because when you look into the features of bill of exchange, the parties drawer, payee, drawee should be certain persons and distinct persons. But if you look into the example, drawer, payee, fictitious, so these are not enforceable. Of course, if this instrument transfers to holder in due course, then again this instrument gets enforceability character. That means, the acceptor of the fictitious bill is liable to only holder in due course and subsequent parties. So that's it, all about, types of the instruments. Next one, what is the capacity to incur liability under the instrument? Any competent person, competent person. Simply competent person is liable to the negotiable instrument. Next, maturity of the negotiable instrument. Very simple. Maturity concept is only time instrument is having a concept of maturity. Demand instrument will not have a concept of maturity. So with respect to maturity, with respect to time instrument, for calculating maturity date, you need to add the time period and you need to add 3 grace days. And finally, if the maturity date falls on public holiday, then the maturity date would be the immediately preceding business day. Immediately preceding business day would be the maturity date. Suppose, sir, if a maturity date falls on emergency holiday, sir, emergency holiday, then the due date will fall on succeeding business day. Understood, ma? Understood. And all these are general rules. You can read it. So you can read it, all the general rules, ma. So all general rules, you can read it. So simply, if instrument is made payable on a specified day plus 3 days. Understood. If an instrument is made payable on stated number of days after date, so date of the instrument, add so and so number of days. So on happening of an event, happening of the event, date plus time period, and finally add 3 grace days. Understood. So when you are adding a time period, the date on which instrument is drawn or date on which instrument got accepted or the date of happening of the event, that date shall be ignored while calculating maturity date. Okay. And I discussed section 25 also. So we already completed holder in due course. Let's see the privileges available to the holder in due course. Very, very, very important. You can expect 4 to 6 marks question from this area, privileges of holder in due course. In case of inchoate instrument, a person signing and delivering to another a stamped but otherwise inchoate instrument. So I already told you, in case of inchoate instrument, holder in due course can recover full amount subject to the value of stamp affixed. Subject to the value covered by the stamps fixed on the instrument, whereas holder can recover only intended amount. In case of fictitious bill, generally fictitious bill is unenforceable, but holder in due course can enforce the fictitious bill. The next one, escrow instrument or conditional instrument. So conditional instrument, here you can't see condition in the instrument, ma'am, because if condition is added to the instrument, then instrument becomes null and void. Instrument becomes null and void. So conditional instrument means condition imposed on delivery. So here, there is a condition on delivery, but not on instrument. So in delivery, I'm imposing a condition, on happening of this event only, I'll make payment like this. If you impose condition in delivery, we call such instrument as conditional instrument or escrow instrument. Simply, there is no condition on the instrument. Why? Bill of exchange should be an unconditional, bill of exchange should contain unconditional order. Promissory note should contain unconditional undertaking. Now tell me where you can put a condition. So if you put a condition in these instruments become null and void. So here the conditions will be kept in delivery. Now the point is, Yes, I imposed a condition in the delivery. Suppose, I'm giving promissory note to you. Apart from this, I'm executing another agreement with you, stating that this promissory note is enforceable only after happening of this event. Like that, I give this promissory note. What you did, you separated that promissory note and agreement copy, and you are transferring this promissory note to some other person, and who is, that some other person is receiving instrument for consideration, and he don't know about this undertaking, he don't know about this arrangement. That means he is acting in good faith, and he received instrument before maturity. Now that person will be called holder in due course. Now that person will get a title. Actually, transferor is not having title, but transferee, since he satisfied all these conditions, he will get good title. He can come to me and he can recover amount from me. Now I can't argue that, stating that, sir, this is an escrow instrument, sir, you won't get any title, sir. I can't make argument. I'm liable to him. I'll pay amount to him, and subsequently I can recover amount from my payee. It is different, ma. Next one, if instrument obtained by unlawful means or for unlawful consideration. Generally, instrument, if it is passed under unlawful means or unlawful consideration, that instrument is generally null and void. Null and void. I'll tell you an example for understanding all these concepts. Just look at the example. From A, B took the instrument under unlawful means, fraud. So yes, a promissory note, it was prepared by A, and under fraud, B took the promissory note from A. So unlawful means. Now I'm asking you a question, my dear students. Tell me, unlawful agreement, is it enforceable or not enforceable? Not enforceable, sir. Then tell me, do you think B will get a title? No, sir. B will not get any title. No title. Now from B, C got the instrument. Why? B lost a betting game. B told that India is going to win all the 4 matches in a test series with Australia, border Gavaskar trophy. Like that, B made a bet. She told it's not possible. So finally B lost the bet, and under betting arrangement, simply under unlawful consideration basis, this instrument was transferred to C. Now is this enforceable arrangement? No. Accordingly, will C get a title? No title. Next thing, C gifted this promissory note to D. So gift, in case of gift, that means no consideration. If there is no consideration, then he is not a holder in due course. He is simply holder. Sir, what title holder will get, sir? Holder will get a transfer title. That means, will D get title? No title, because C is having a no title, so D will also get no title. Next one, from D, E got the instrument again by way of fraud. Now will E get the title, sir? No title, because unlawful means. And E transferred this instrument to H. H received this instrument for consideration in good faith and before maturity. Now H will be treated as holder in due course. Holder in due course will get a valid title even though transferor has no title. Suppose if you observe in this case, transferor is not having any title, but the transferee H will get a good title. Sir, what it indicates? So having good title, what is the consequence? That means tomorrow H can recover amount from E, H can recover amount from D, H can recover amount from C, H can recover amount from B, H can recover amount from A. And I'm telling you, my dear students, no one can deny their liability. Now A can't argue that, sir, this instrument was transferred under fraud, sir, I'm not liable to you. B can't say like this, under unlawful consideration this instrument was passed. No, E can't tell that like this, instrument is full of defects, sir, you won't get any title. It's everything is nonsense. H, holder in due course, he will get a valid title. His title is superior than that of transferor title. Not only holder in due course, any person obtaining instrument from holder in due course, any party obtaining instrument from holder in due course, whoever it might be. Suppose H transferred this instrument to G under gift, or G is already having a knowledge of all the defects, he's having a knowledge of defects in the instrument, or G received this instrument after maturity, Now the point is, Is G a holder or holder in due course? He is not holder in due course. He is just a holder because he violated all the conditions. Now, what title holder will get, sir? Holder will get transferor title. Who is the transferor in this example? Sir, the transferor in this example is Mr. H, sir. So, what title Mr. H is having? Sir, H is having good title, sir. Now, G will also get a good title. That means any person obtaining instrument from HDC, he will get a good title only, even though he is having a knowledge of fraud. But only exception, there is an exception. Suppose, finally this instrument was transferred to Bima. G transferred instrument to B. Or I'll take one small, I'll add one more party. G transferred this instrument to Mr. Y. Y received this instrument for consideration in good faith and before maturity only. So Y is also HDC and he will also get good title. And to Y, Mr. B is the creditor. So that's why Y transferred this instrument to Bima. Y made a negotiation in favor of B. Now what title Mr. B will get? I told you, any party deriving instrument from HDC will get same title as that of HDC. Correct? Yes. Now Mr. B, who is a party to the fraud, obtained instrument from HDC. Now my question, what title Mr. B will get? What title Mr. B will get? Are you all getting my question? So what is the answer? Sir, the answer is B will get no title. Very simple logic. If you tell that B will get a good title, definitely all fraud persons, what they will do, under one instance they will transfer instrument to HDC, under another instance they will take same instrument from HDC. The final conclusion, any party deriving instrument from HDC, he will get same title as that of HDC, even though he is having a knowledge of fraud. But if he is a party to the fraud, he won't get any title. Understood? So that's what I told you. So unlawful means, unlawful consideration, and no one can deny the original validity of the instrument, and no one is having a power to question the payee's capacity to endorse. Say for suppose, E is a minor. E is a minor. E is a minor. And from E, H obtained this instrument for consideration in good faith before maturity. Now, no party can question the title, no party can question the capacity of payee. So, E is a minor. Mr. H, you got this instrument from E. Agreement with minor is void and you obtain instrument under such agreement. So, that instrument is not enforceable. We are not liable to you. Like that, they can't escape from their liability. They are still liable. So, that's what my privileges of holder in due course. Privileges of holder in due course. Next one, payment in due course. Payment in due course. So if a person, maker of the promissory note, I'll write here, maker of promissory note, drawee of bill of exchange, and accept, drawee in case of banker, simply note drawee banker. Maker of promissory note, acceptor of bill of exchange, and drawee banker in case of check. Drawee banker in case of check. These people will be discharged from their liability. Discharge of liability, discharge from liability. Discharge will happen only when they make payment, and such payment should be in due course. If such payment is in due course, then only this party gets discharged. Sir, what is meant by payment in due course? Payment should be as per apparent tenor. Apparent tenor means apparent on the instrument. Whatever the instructions are appearing, according to those instructions only you should make payment. Suppose, it is an order instrument, pay to Mr. Praveen. So the name Mr. Praveen is there. Now, yes, the maker of the promissory note or acceptor of the bill of exchange, whoever it might be, they will be discharged only if they make payment to Praveen only. Suppose if they are making payment to Rahul, they are not said to be discharged. Amount on the instrument is 10,000. They should make payment of 10,000 only. Are you all getting my point? Suppose if it is a bearer instrument, they can make payment to any person whoever hold the instrument. So as per instructions, they should make payment. And they should make payment in good faith. That means they should not have any suspect. They should not have any ground to suspect whether the possessor is having a title or not. If they are having any doubt, they should make an investigation. and without negligence, simply no, in good faith and negligence, and the payment should be made in money only. So here, good faith, we are having a point, does not afford a reasonable ground for believing that he is not entitled to receive payment of the amount therein mentioned. So simply, payment in good faith means should not have any doubt. You should not have any question. Is this person entitled to receive this much amount of instrument? If you are having a doubt, you should make an inquiry. Then only you should make payment. Or else you are making payment negligently. If you are making payment negligently, such payment is not said to be in payment in due course. Accordingly, you are not said to be discharged. You are said to be you are liable. Understood? Understood, everyone? So next thing. So we completed kinds and types of the instruments. Promissory note, bill of exchange, check. We already completed. So the next topic would be mostly crossing of checks. Noting and protest, we completed. Crossing of checks. Crossing of checks. So checks are of two types, ma. It is a open or uncrossed check. Next one, crossed check. So crossed check, yes, on the face of the instrument, you can see two transverse parallel lines on the left top corner of the check. Usually, it's a customary practice to have these two transverse parallel lines on the left top corner of the check. So it may be on anywhere of the check, it may be like this, it may be like this. So simply drawing two transverse parallel lines on the face of the check, it is nothing but crossed check. So crossing is an instruction given by the drawer to the drawee banker. So what is the instruction, sir? First of all, in case of open check or uncrossed check, the payment mechanism, we'll see the payment mechanism. Suppose Mr. David issued a check to Mr. Pradeep. So David drawn a check on State Bank of India. So Mr. David is a drawer, Pradeep is a payee, and check was drawn on SBI. So drawee bank, SBI. Say for suppose it is an open check. Now Pradeep will have two options in order to recover money of the instrument. Pradeep, either he can go to drawee bank directly, stand in a queue, and he can collect amount of the instrument. This is option 1. Option 2, he can deposit the check in his bank account. Suppose Pradeep is having account in Punjab National Bank. So he can deposit a check in PNB. So PNB will act as a collecting banker. So PNB will forward the check to State Bank of India. And State Bank of India will remit the amount to PNB. PNB will credit the amount to Pradeep bank account. So simply PNB will act as an agent, to Pradeep. So this is option 2. So payment across the counter, this is option 1. Payment across counter, this is option 1. Payment through banker, this is option 2. So these two options are available if the check is open check. However, under crossed check, option 1 is disabled. Option 1 is disabled. So here, drawer will give strict instruction to the drawee banker. Don't make payment across the counter. Make payment only through banker. Now, any person who want to encash the check, he should have a bank account and he can collect the amount of instrument only through his banker. Are you all getting my point, students? Sir, which type of check is more safe, sir? Crossed check is more safe. Why? If it is an open check, you can't trace the person who recovered the amount of instrument. Why? So simply he will go to the bank counter, he will withdraw the amount. Now you can't trace the person who recovered the amount of instrument. But if it is a crossed check, even if the check got misplaced, finally the amount will be credited to a person bank account. So you can trace out the bank details and you can trace out the person who is having that account, and you can record the amount in case check is misplaced. Understood? Now this crossing is of 4 types, ma. Actually 2 types, it's not 4 types. Crossing is of 2 types. One is general crossing, the other one is special crossing. And among general crossing and special crossing, you will find 2 more crossings. It is non-negotiable crossing. Next one, account payee crossing. So you can see combination like this, general crossing, general and non-negotiable crossing, general and account payee crossing. Next one, special crossing, special and non-negotiable crossing, or special and account payee crossing, like that. So crossing generally it is of 2 types, general crossing, special crossing. So what is meant by general crossing, sir? What is the meaning of general crossing? So here, just drawing two transfer parallel lines across the check, yes, it is known as general crossing. The person, the payee, in order to collect the amount of the instrument, he should have a bank account. He should deposit the instrument in his bank account. The collecting banker will collect the amount. Are you getting my point? So drawer is giving instruction to the banker. What instruction? Don't make payment across the counter. If you receive the check across the counter, don't make payment. When you receive the check from a bank, then only make payment. Any bank, any bank. In India, we are having some 20 plus banks. So from any bank, if you receive the instrument, you just make payment to the bank only. That's what general crossing. But coming to the special crossing, in addition to two transfer parallel lines, you can see the name of bank. Say for suppose HDFC Bank. HDFC Bank. Here, drawer is giving instruction to bank. How many instructions he is giving to the bank, sir? Two instructions. What are those two instructions, sir? First one, don't make payment across the counter. Second one, make payment to the bank whose details are mentioned between two transfer parallel lines. Suppose, David is giving check to Pradeep. David is having account in State Bank of India and Pradeep is having account in HDFC, for example. Now, David, he issued a check, it was specially crossed. Specially crossed means simply, general crossing plus name of the bank. So between these two transfer parallel lines, he wrote the name of HDFC. Now, what type of instruction, what instruction he is giving to SBI? SBI, don't make payment across the counter. When you receive the check across counter, don't make it dishonor the check. And if you're receiving a check from any bank, from bank other than HDFC, then also don't make payment. Only when you receive check from HDFC bank, then only make payment. That means, you have to make payment only to the HDFC bank. So that is what special crossing. Sir, can I do special crossing 2 times or 3 times? That means, can I do special crossing in favor of more than one bank? No, only one bank name is permitted. You can't add 2, 3, 4 banks. Because adding 2, 3, 4 banks, it leads to general crossing only. Are you getting my point? Now you will get a doubt. Sir, what is the difference between general crossing and special crossing? See, under general crossing, Mr. Pradeep, suppose, Pradeep is having account in 5 banks. What are they? Axis Bank, Bank of Baroda, Canara Bank, Dena Bank, and then Federal Bank. He's having account in all these 5 banks. Also HDFC Bank. So total 6 banks he's having account. Now Pradeep, in order to recover amount of the instrument, he can deposit check with any bank. Any bank. Coming to the special crossing, Pradeep can recover amount of the instrument only when he deposit check with HDFC Bank. Why? HDFC name was mentioned between two transfer parallel lines. Are you all getting my point, students? Everyone. So special crossing, special instruction. And you can't add 2 or more bank names between two transfer parallel lines. So special crossing can be done only once. But there is an exception. The exception is the banker in whose favor special crossing was done. The banker in whose favor special crossing was done, he can make one more time special crossing. He can make one more time special crossing. I'll tell you the logic. See, nowadays, due to advancement in technology, everything, you can transfer online. But the problem, during 20th century, there is no such technology. Just see the case, SBI is there. Next one, 2 banks I'm taking, for example, Punjab National Bank from Punjab and Tamil Nadu Mercantile Bank from Tamil Nadu. There is no connection between these 2 banks. Imagine. So here, drawer, he drawn a check on Punjab National Bank and it was made payable to payee who is having account in Tamil Nadu Mercantile Bank. And drawer, what he did? He gave a specially crossed check. So he mentioned the name of Tamil Nadu Mercantile Bank between these 2 transfer parallel lines. The problem is Tamil Nadu Mercantile Bank is not having direct connection with PNB. But both the banks are having a common connection with State Bank of India, SBI. So what Tamil Nadu Mercantile Bank manager can do? So he can do one more time special crossing. So simply he can add the details like this, SBI and Tamil Nadu Mercantile Bank manager. So manager signing the crossing. Now you can observe there are 2 special crossings on the instrument. One is done by the drawer. The other one is the Tamil Nadu Mercantile Bank. It is the bank in whose favor special crossing was done. Now, if you observe the relation between, payee and Tamil Nadu Mercantile Bank, it's like principal and agent relation. And if you observe the if you observe the relation between Tamil Nadu Mercantile Bank and SBI, it's like principal agent relation. And if you observe the relation between payee and SBI, it's principal and sub-agent relation. This kind of sub-agency is permitted. In contract of agency also, I told you, actually appointment of sub-agent is invalid. Appointment of sub-agent is invalid. But we had an exception. If nature of trade permits, then appointment of sub-agent is valid. I told you, right? So just observe the situation. Special crossing you can do only once. However, the banker in whose favor special crossing was done, he can make special crossing one more time. The difference between general crossing and special crossing: a person having a bank account can collect the amount of the instrument, whereas specially crossed check, a person having bank account in the bank which name was mentioned between two transfer parallel lines, only that person can record the amount of the instrument. My dear students, just answer my question. Because of crossing, is the negotiability character getting affected? Negotiation of the instrument, right? Instrument is negotiable. So because of crossing, is negotiation getting affected or not? The answer is no. Negotiation is not affected. So you can transfer these checks, but the ultimate person who want to recover amount of the instrument, he should have a bank account under general crossing, and he should have a bank account in the bank in whose name, in whose favor special crossing was done under special crossing. So crossing is not at all affecting the negotiation. But coming to the non-negotiable crossing and account payee crossing, these types of crossing are going to affect negotiation of the instrument. So account payee crossing, first we'll discuss account payee crossing. So same example, David drawn a check on SBI and it was made payable to Pradeep. See, Pradeep is having account with Punjab National Bank. Now account payee crossing means simply drawing two transfer parallel lines and adding the words account payee. So what it indicates, sir? Under account payee crossing, the drawer is giving instructions to two banks. One is to the drawee bank and the next one is to the collecting banker. Sir, what instruction is giving, sir? First of all, drawee banker, don't make payment across the counter. Payment across the counter is disabled. So make payment only through the banker. And collecting banker, you're collecting the amount of instrument. Don't pay amount directly to the payee. First credit the amount of the instrument in the account of payee. First credit the amount of the instrument in the account of the payee. Sir, that thing only will happen. No. Just listen me carefully, ma. Under general crossing or special crossing, what happens? I'll tell you. Suppose, David gave instrument to Pradeep. Pradeep negotiated instrument to A. A negotiated instrument to B. B negotiated instrument to H. Now, under general crossing or, special crossing, what happens, the payee of the instrument, H, when he deposit instrument with the bank, so collecting banker will collect the amount of the instrument and he will deposit that amount in the H account. Why? In the process of negotiation, yes, who ultimately become holder of the instrument? H became holder of the instrument. Now, the collecting banker will credit the amount to the account of the H. However, under account payee crossing, the collecting banker can't pay amount directly to the holder. First of all, he should credit the account of the payee whose name is mentioned on the face of the instrument. So on the face of the instrument, it's like this: pay to Pradeep. Now, yes, the collecting banker, whoever it might be, PNB, HDFC, whoever it might be, they should collect the amount and they can't directly pay the amount to the holder of the instrument. First, he need to credit the amount of the instrument to the payee's account. And who is the payee? The payee whose name mentioned on the face of the instrument. That means at the time of creation of the check, who is the payee? Only to that person account, first amount should be credited. Later, it can be paid to some other person. That means, it can be debited to some other person according to the instruction of the payee. Now tell me, my dear students, is account payee crossed check a negotiable instrument or not negotiable instrument? The answer is it's not a negotiable instrument. Why? You can't negotiate the instrument. Even if Pradeep negotiates this instrument to, suppose if Pradeep negotiates this instrument to A to B, B to ultimately RBI governor. Now RBI governor, even if he deposit this instrument in his account, the amount will be credited to the account of Pradeep only. Later on, based on Pradeep instruction, that amount may be transferred to some other. But the point is, the amount which is debited in Dravi bank account, it should be credited to the payee whose name is mentioned on the face of the instrument. Therefore, this instrument is not at all transferable. Negotiable Instruments Act is not recognizing such kind of crossing. Now coming to the not negotiable crossing, it looks like this. Simply drawing two transfer parallel lines and adding the words non-negotiable. Non-negotiable. So what it indicates? What it indicates? The answer is simply the instrument will lose its negotiability character. Negotiability character will be deleted or avoided. The character of negotiability gets affected. However, the instrument is still transferable. Sir, what it is? You are telling that negotiability character was eliminated and you are telling that instrument is transferable. Yes, ma, instrument is transferable. However, transferee will get transferor title only. Why, sir? Instrument already lost negotiation character. Sorry, instrument already lost negotiability character. I'm telling you, negotiation and transfer both are one and the same to some extent. But there is a thin difference between negotiation and transfer. The thin differentiation is negotiation under Negotiable Instruments Act. The transferee will get better title than transferor possess. Whereas under transfer, the transferee title is subject to transferor title. I'm telling you the difference once again. Negotiation versus transfer. Under transfer, nemo dat quad non habit will apply. So transferee will get transferor title. That's it. But coming to the negotiation, transferee will always gets better title than transferor possess if he satisfy three conditions. Under account payee crossing, instrument is not transferable, instrument is not negotiable. Simply note the title as well as instrument, both are not at all transferable. But coming to the non-negotiable crossing, the instrument is just, the title of the instrument is just losing negotiability character. However, the instrument is still transferable, still like, similar to the goods, they're transferable. But the point is, if transferor is having good title, transferee will get same title. If transferor is having a defective title, then transferee will also get a defective title. So listen to the example carefully. By way of fraud, B obtained a check from A. What kind of check it is, sir? It is a just generally crossed check or specially crossed check. That's it, generally or specially crossed check. So now B obtained this instrument by way of fraud. So definitely B will have no title. B's title is defective. Now from B, C got the instrument. C got this instrument for consideration and in good faith. Since it is a check, maturity concept will not apply. Now C, yes, who is C, sir? Holder in due course. Why? He satisfied all the conditions. He became a holder for consideration and he is not having a knowledge of defects in the title of check. He is not at all having any defect in B's title. Now the point is, C is a HDC, so C will get a better title than B possess. Therefore, C will get a valid title. Valid title. Now same example, listen carefully. From A, B obtained a check by way of fraud. By way of fraud. And this is, not negotiably crossed check. Not negotiable crossed check. Now B passed this instrument to C. B passed this instrument to C. So C got this instrument for consideration in good faith. Now C is HDC, correct. What title C will get, sir? No title. Why? See, because of not negotiable crossing, instrument already lost negotiability character. Therefore, the transferee's title is subject to transferor title only. Transferee will get same title as that of transferor. So under non-negotiable crossing, if transferor has no title, then transferee, even though he is like a holder in due course, he can't get any title. Why? Already it lost negotiability character. So Negotiable Instruments Act is not applicable to that instrument. Therefore, nemo dat quad non habit will apply. If Negotiable Instruments Act is applicable, then nemo dat quad non habit will not apply. Transferee will get better title than transferor possess. Just observe the difference between example 1 and example 2. So generally cross check, specially cross check, there is no objection at all. HDC will get a valid title. But if it is a not negotiably cross check, the transferee will get same title as that of transferor. If transferor is having a good title, then transferee will also get a good title. So that's the differences between, general crossing, special crossing, not negotiable crossing, and account payee crossing. So many people, confusion. Many people is having a confusion that, account payee crossing and not negotiable crossing both are one and the same. No ma. Account payee crossing, there is a direction from the drawer. The instruction direction is to the both collecting banker as well as paying banker. Drawee banker. Drawee banker make payment through a bank. Collecting banker don't pay amount directly to the holder of the instrument. First credit the amount to the account of payee whose name mentioned on the face of instrument. It's like a restrictive crossing. Instrument loses both negotiability and transferability character. Understood? Now who can cross the checks? Drawer of the check. Drawer of the check. While making the check, he can draw the, he can cross the check. Suppose, drawer gave an open check. Now holder, for getting protection, he may cross it. He may cross it as a general crossing or, special crossing. Suppose it is already a generally crossed check, sir. Now holder can convert into special crossing simply by adding the name of the banker. Adding name of banker. Understood? Now coming to the banker. Yes, banker can also convert open check to crossed check. At the time of collection only, they will draw two transfer parallel lines like this. If it is a generally crossed check, now adding the name of the bank, it will be converted to specially crossed check. Are you getting my point? Suppose it is already a specially crossed check, sir. No problem. The banker in whose favor special crossing was done, he can do one more time special crossing. So we had types of crossing, ma. Restrictive crossing or account payee crossing. This is not having a legal recognition under Negotiable Instruments Act. However, under Income Tax Act 1961, a business person can claim expenditure. If that expenditure is above 10,000 rupees. Did you remember the limit? So 10,000 or more payment, more than 10,000 expenditures. More than 10,000 rupees expenditures, you will get a deduction only if such payments are happened through account payee crossed checks. But account payee crossed check is not at all recognized by Negotiable Instruments Act 1881. So big conflict. That's what, these topics lost practicability. Fine. Not negotiable crossing. I told you. Instrument loses negotiability character. The title of the instrument loses negotiability character. However, instrument is still transferable. So it doesn't affect the transferability of the instrument. However, transferee will get same title as that of transferor. Next one, protection of liability to the paying banker and collecting banker. First of all, why banks will get liability? Very simple, ma. You already read contract of agency, right? Now principal, agent, two parties are there. As long as agent works within the authority delegated by the principal, act of agent, principal is liable to the third party. Yes or no? If agent exceeds authority, if he does an act which is outside the authority, in that case principal is not liable, agent is personally liable. You all know this matter, right? Now similarly here, drawer is like a principal, whereas drawee bank is acting as the agent. Now, as long as agent works within the scope of drawer, agent is not liable, principal is liable, agent gets protection. However, agent exceeding the authority, if we do any activity, then principal is not bound by the act of agent, agent is personally liable. Correct? Now, just look at the case, ma. Drawer gave a check like this, ma. Rupees 10,000 and signed by drawer. Between these two transfer parallel lines, Canara Bank name was added. Canara Bank. First of all, this was drawn on State Bank of India. Now, if you look at this instrument, the State Bank of India is given a series of instructions. First thing, don't make payment across the counter. Make payment of only 10,000 rupees. Next one, make payment only when you receive check from Canara Bank. This is third instruction. And first of all, I'm the authorized person. Only I can give you instruction. So you can check my authorization by matching the signature. So verify my signature. Am I authorized person or unauthorized person? Now banker should verify all these things. And banker should make payment according to the instructions given by the drawer. If banker is making payment according to the instructions of the drawer, then banker will be protected. Even though the amount is credited to the wrong person, banker is not at all concerned with such payments. Banker is protected. So I'm talking about paying banker. Paying banker is nothing but drawee banker. At the time of making payment, we call it as paying banker. Understood, ma? Everyone, I'll tell you, suppose this is a specially cross check, and and banker is making payment across the counter, or banker is making payment to HDFC bank, or banker is making payment of 50,000, or suppose it is a forged instrument, banker negligently making payment. Now in all these cases, banker is acting outside the authority, so banker will not be protected. Banker is liable. Are you all getting my point, students? So check payable to order. Now banker should make payment to the order of the instrument. So whose name is mentioned on the instrument, or in the case of last endorsement, whose name is mentioned, only that person is entitled to recover amount of the instrument. So banker is liable to only that person. If banker is making payment to different person, then banker is not protected. Banker is liable. Next one, payable to bearer. Now whoever possesses the instrument, yes, banker is liable to that person. If banker is making payment to such person, banker will be protected. And payment of check crossed generally. So generally crossed check, yes, payment should be done through the banker, not across the counter. If bank follows this rule, banker will be protected. Of course, the amount, even if credited to the wrong person account, banker is not liable. I'll tell you one example. Suppose A gave a check to B. A drawn a check on State Bank of India, and A gave a check to B. So B was a little bit negligent, B lost the check, and C found the check. It's a bearer check. C found the check. C went to State Bank of India and collected the amount of the instrument. Now, SBI paid amount to the correct person or wrong person? Sir, wrong person, sir. But SBI is not concerned with such payment. SBI is protected. Why? Because it's a bearer instrument. SBI can make an assumption that whoever possesses the instrument is the owner of the instrument. Accordingly will make payment. Why? The reason is simple. So banks daily, it will make payment of n number of checks, n number of checks. It is not possible for a banker to conduct an investigation. See, from whom you got the check. Did directly A gave check to you? Wait, we are going to call A. A, hello A. Did you give any check to Mr. C? No, right? Come on. So, you are not entitled to receive the amount of the instrument. Do you think banker will run a detective agency, an investigation agency? No. The banker can make an assumption. Are you all getting my point, students? Suppose, this is order check only. This is order check. See, forged B's signature, and he made a forged endorsement in his favor. Forged endorsement. Here, forgery didn't happen to the instrument. Forgery happened to the endorsement. So banker is concerned only with respect to the signatures of the drawers, but not signature of the endorsers, signature of the holders. Why? Banker will have a signatures of account holders only. Banker will not have a signatures of total India population, Indians. Yes or no? So banker is concerned only with respect to drawer signature. Banker is not concerned with respect to any other signature. So in case of forged endorsement also, yes, SBI is making payment to C. No, SBI will be protected. Why? Because SBI verified all other instructions. SBI followed all other instructions. Are you all getting my point, students? Even if payment goes to the wrong person, and if banker is making payment in due course, then banker will be protected. Now, specially cross check. The banker liability comes to an end when the payment is made through the banker in whose favor the special crossing was done. And there are important situations where it is said that protection to the paying banker. See, payment in due course of cross check, payment of cross check of out of due course. Out of due course. One is in due course, the other one is out of due course. We'll see out of due course. Any banker paying a check crossed generally otherwise than to a banker. In case of generally crossed check, banker, paying banker is making payment to a person other than banker. That means, natural person, or a check crossed specially otherwise than to the banker to whom the same is crossed. So in case of special crossing, paying banker is making payment to any person other than specially crossed banker. Now, in such cases, the banker shall be liable to the true owner of the check for any loss he may sustain owing to the check having been so paid. Understood? And this point I already discussed with you. So If drawer signature is forged and still bank is making a payment, then banker is not protected, banker is liable. It is the duty of banker to verify whether principal is having authority to do the act, whether the principal is authorized person or not. So drawer signature, it is the duty of the banker to verify whether signatures are matching with the specimen signature or not. In case of forged endorsement, banker will be protected. Banker is not concerned with forged endorsements. Banker is concerned only with forgery on the instrument. Now coming to the collecting banker case. So collecting banker is simply an agent to the payee. As long as he acts as an agent to the payee, he is not at all liable. He will be protected. Because act of agent is not liable. Who is liable? Principal is liable. Yes or no? So he should act as an agent only. The bank which receives the payment of a crossed check on behalf of its customer is known as collecting banker. Non-liability of the banker receiving payment of the check. A banker who has in good faith and without negligence received payment for a customer of a check, payment for a customer of a check, simply acting as an agent, either processed generally or specially to himself, shall not, even in case of title of the check proves defective, shall not incur any liability to the true owner of the check by reason only of having received such payment. Now I'll tell you an example which is exactly opposite to this rule. Okay. So we'll have an example. Sima. So David issued a check to Pradeep. What kind of check? It is a not negotiably crossed check. Not negotiable crossed check. So David drawn this check on State Bank of India. Pradeep is having account with Punjab National Bank. So from Pradeep, under fraud, Mr. Praveen took this instrument. So by way of fraud, Praveen took this instrument. Now tell me what title Mr. Praveen will have? A defective title or simply, no title. Why? Agreement, if consent is obtained by way of fraud, it becomes voidable at the option of aggrieved party. Definitely voidable contracts, aggrieved party will cancel the contracts. It becomes void. Now Praveen is not having any title. Suppose, Praveen, he deposited this instrument with his bank, Axis Bank. Axis Bank simply it is acting as an agent. It presented the instrument with SBI. SBI made payment to Axis Bank. Now, SBI is protected. Why? Because it is not making payment across the counter. It is making payment through the banker. So SBI will be protected. So protection to the SBI, protection to the paying banker done. Now coming to the Axis Bank, it is collecting amount on behalf of a wrong person. But it don't know that matter. It is acting in a good faith. It thinks that Praveen is having a title. So Axis Bank is not at all having a knowledge about this fraud. If Axis Bank is having a knowledge of the fraud and still if it is collecting the amount of the instrument, then Axis Bank will be held liable to the Pradeep, to Mr. Pradeep. But here Axis Bank is simply acting as an agent. It is acting in good faith only. Therefore, Axis Bank is not at all liable to any person. Are you all getting my point, students? So collecting banker gets protected. As long as collecting banker is acting as acting as an agent, so the agent will be protected. Suppose I am extending this example, Suppose Praveen is having certain dues to Axis Bank, He is having some dues to Axis Bank. And Axis Bank recovered this check from Praveen. So you are having dues to us, right? So we are recovering this check from you. Now, Axis Bank is becoming holder to the instrument. Axis Bank is not acting as an agent to Praveen. It is simply acting as a holder. Why? Praveen transferred this instrument not for the purpose of collection, but in order to settle the dues. Now, Axis Bank became holder. Tell me what title Axis Bank will get. Sir, Axis Bank received this instrument for consideration only, and Axis Bank received this instrument in good faith only. They don't know about the fraud. Now, do you think Axis Bank will get a good title? The answer is no. Axis Bank will get no title. Why? This is a not negotiable crossed check. Instrument already lost negotiability character. However, instrument is transferable. Now here, Axis Bank, it is presenting this instrument with SBI for the purpose of money, and SBI paid the amount to Axis Bank. Now in this case, Axis Bank will not get protection. Axis Bank will be held liable to Mr. Pradeep. So why, sir? Because here Axis Bank is not acting as an agent, it is acting as a principal. You're getting my point? So Axis Bank is liable to Mr. Pradeep, the true owner, and Axis Bank can recover this amount from the wrongful person, Praveen. Is it clear, ma? Next one. Acceptor and acceptor for honor. Already I completed these points, ma. Acceptor, the drawee, when he give acceptance, he will be called acceptor. And acceptor for honor, if the instrument is dishonored, due to non-acceptance. And already I covered these two types of acceptance, ma. General, qualified. I told these points, qualified acceptance. Holder may give consent to the qualified acceptance. In such case, all previous parties not consenting to it or discharge. All these points I completed. Acceptor for honor. If the instrument is dishonored due to non-acceptance, the holder may cause noting or protest to such instrument, ma. So say for example, so we'll have an example. A drawn a bill of exchange on B. Before acceptance only, A negotiated this instrument to C. Yes, it is possible. But until acceptance was given, until that instrument gets acceptance, the drawer's liability is primary and unconditional. Once Mr. Drawee gives acceptance, the drawer liability becomes secondary and conditional, and drawee liability becomes primary and unconditional. C transferred this instrument to D, and D transferred this instrument to H. H presented this instrument with B for acceptance, and B dishonored the instruments. B rejected the instrument. Now the instrument is dishonored. So what H did? He went to notary public and he caused the instrument noting and protest. Now using this noted instrument, using this dishonored instrument, the holder is not required to wait till maturity. He can take action immediately. Suppose holder want to take action against SEMA, and holder sent a legal notice to C. Come on, you need to pay amount by the next day. Like that, he sent a legal notice. Now on behalf of C, the person, an outsider, say for example X, is coming forward, and with the consent of H, he is giving acceptance to the dishonored bill of exchange. Now such acceptance is nothing but acceptance for honor, and Mr. X will be treated as acceptor for honor. At the time of this acceptance, the instrument is already dishonored due to non-acceptance, and it is not a normal bill, it's a noted or the protested bill. So an outsider who is not connected with the instrument, if he is giving acceptance for the honor of the instrument, is called acceptor for honor. On maturity date, H, once again he will present the instrument with B for payment. If B dishonors this instrument, if B rejects the instrument, then H, he need to present the instrument to X immediately. So X is liable to H. After making payment, X can recover amount from either C, or X can recover amount either from A. So X can recover amount from the party on whose behalf he gave acceptance, and from all the prior parties. So these are the rights and liabilities of acceptor for honor. Understood? Next one. So you can go through all the essentials, all the points I discussed with you. So liability of acceptor for honor, rights of acceptor for honor. Acceptor for honor is liable only when drawee dishonors the instrument on maturity date once again. And once acceptor for honor makes the payment, he is having a right over prior parties. Next one, negotiation of non-negotiable instruments. So what is meant by negotiation? Already told you. See, Mr. A is holder of the instrument. He is having right to possess the instrument in his own name, and he is having right to recover amount of the instrument in his own name. Now, in order to make the next party holder of the instrument, what are the things Mr. A is doing? That process, I call it as negotiation. So simply negotiation means transfer of a negotiable instrument to any other person so as to constitute the person the holder of such negotiable instrument. Simply for transferring ownership of the negotiable instrument, whatever the thing you are doing, we call it as negotiation. And how negotiation will be done, sir? If it is a bearer instrument, negotiation will be done by way of delivery. If it is an order instrument, negotiation will be done by way of endorsement and delivery. So now next concept is delivery. See, delivery, is required not only at the time of negotiation but also at the time of making the instrument. The maker of promissory note should deliver instrument to payee, promissory note. And next one, drawer of the bill of exchange should deliver this instrument to the drawee, and drawee, after giving acceptance, he should return back the instrument to drawer, and drawer should deliver this instrument to payee, or else instrument is not at all enforceable. Even in case of check also, drawer should deliver the instrument to payee. So delivery is required not only at the time of negotiation but also at the time of creation of the instrument. So without delivery, the instrument is not said to be enforceable. And this delivery is of two types: actual, constructive. Actual means physical possession of the instrument gets transferred. Suppose A giving instrument to B physically, he is transferring physical instrument to B. Yes, this is said to be actual delivery. Constructive delivery happens by way of acknowledgement. By way of acknowledgement, suppose A called B, sir, where are you? I'll give you check, or I'll give you instrument to you, sir. B told, no problem, you hold the instrument till maturity date on my behalf. You hold the instrument till maturity date on my behalf. Like that, B made a statement, and A told, okay sir, from now onwards I'll hold this instrument on behalf of you. So now there is no change in possession. Before negotiation, A is having an instrument. Even after negotiation also, A is having the possession of the instrument. But here the possession is not for A, the possession is for B. So without change in possession, if delivery is completed, such delivery we call it as constructive delivery. And we already discussed conditional delivery. It's nothing but escrow instrument. So imposing conditions on delivery, we call it as escrow instrument. So in case of escrow instrument, no one will get title of the instrument. However, holder in due course will get title of the instrument. Do you remember? Next one. So types of delivery, I told you. So the instrument is delivered upon a condition and for a special purpose. The instrument can't be negotiated until condition is satisfied. Of course, to this general rule, holder in due course is an exception. And one more point, ma. So in case of endorsement, even in case of order instrument also, not only bearer instrument, order instrument also, the negotiation is completed only by delivery. I'll write the formula simply. Negotiation in case of bearer instrument, negotiation will happen by way of delivery. In case of order instrument, negotiation will happen by way of endorsement and delivery. That means delivery is required not only in a bearer instrument but also in order instrument. And who should deliver this order instrument? The person, whoever is making endorsement, the same person should make delivery also. Suppose a person made endorsement, and before delivering the instrument he got deceased. No, the endorser died. In that case, can legal representative simply deliver the instrument so as to make a negotiation of the instrument, sir? No, it is not possible. So the legal representatives are required to make endorsement one more time, and they're required to deliver the instrument. Then only the negotiation is said to be effective and the endorsee will get a valid title to the instrument. So delivery effective between the parties not required, ma. And then negotiation by endorsement and delivery, I told you this is required for order instruments. So endorsement, already told you, endorsement is simply nothing but signing on the face or back of the negotiable instrument or on a slip of paper. If the instrument is completed with full of endorsements, then you can attach a slip of paper to the instrument, simply additional sheet. In your examination hall, when your answer booklet is completed, you can take additionals, right? So you can attach a paper, the slip of paper, or technically we call it as a launch. So simply signing on the back or on the face of the instrument with a view to transfer ownership. With a view to transfer ownership of the instrument, we call it as endorsement. So if you just simply put signature on it, if you simply endorser, in endorsement, you'll have two parties. One is endorser, the person who is making endorsement, and endorsee, the person in whose favor endorsement is done. Are you getting my point? So simply, if endorser signature is kept, sir, only endorser is keeping his sign and endorsee details are blank. Endorsee details are blank, endorser signing the endorsement. Such kind of endorsement, we call it as blank endorsement, or we call it as general endorsement. So everything, every endorsement should be in writing, and it should be signed by the holder of the instrument, or else it is invalid. Next one, the endorsement is valid only if the negotiable instrument is signed by the holder. That's what I told you. Now simply signing on the back or face of the instrument with a view to transfer ownership to the next person, or with a view to achieve the objective of negotiation, such kinds of endorsement, it is nothing but blank or general endorsement. Sir, in addition to signature, yes, endorsee details are also present, sir. Endorsee details also given, sir. In that case, we call it as full endorsement. So full endorsement or special endorsement. So the specialty of general endorsement, it converts order instrument into bearer instrument. Order instrument will be converted to bearer instrument. The specialty of full endorsement, the order instrument will be continued to be as the order instrument continued to be as order instrument only. Is it clear? And you can convert a general endorsement into special endorsement by simply filling up the blank. By simply filling up the blank. So I'll give you one example. See, Seema, A gave a promissory note to B. B is the payee of the instrument. What B did, pay to, so he kept blank, and B signed this endorsement. Now, B delivered this instrument to C. So in the hands of C, this instrument is not an order instrument. This is a bearer instrument. Why? The last endorsement is blank endorsement. Therefore, instrument loses the character of order instrument and it will be a bearer instrument. Now, subsequent parties can treat it as subsequent parties. In the hands of subsequent parties, it is a bearer instrument only. Now, suppose C want to negotiate this instrument to D. Negotiate this instrument to D. Now, what C did, he simply wrote the name of D in the blank. He simply filled the blank. Now, adding the name of payee in the blank, what happens, the blank endorsement gets converted into full endorsement. As a result, bearer instrument will be converted to order instrument in the hands of Mr. D. So this is the effects of bearer and blank and general blank and special endorsement. Next one, restrictive endorsement. Generally, holder will have three rights. Holder of the instrument will have three rights. One is right to recover the amount of instrument. In case if the person is not paying the amount, he is having sue right. He can sue the prior parties. And the third right is he can make further negotiation. No need to wait till maturity date. If required, he can negotiate this instrument to the subsequent parties. Further negotiation. Are you all getting my point, students? Further negotiation. Now, by way of negotiation, all the rights of this person will be transferred to the subsequent parties. Subsequent parties will get all these rights by way of negotiation. And this is an order instrument. So order instrument can be negotiated by way of endorsement and delivery. Are you all getting my point? So under restrictive endorsement, what the current holder will do, he will remove the further negotiation right. He will give only a recovery as well as suing the prior parties. Only this right to the next parties. He will remove further negotiation right to the subsequent parties while making while making negotiation. Now the subsequent parties, either they can recover the amount or they can sue prior parties. They can't make further negotiation. So the restrictive endorsement, the consequence is instrument will lose negotiability character, which I already told you under order instrument. Under order instrument, I already told you, order instrument should not contain words which prohibits or which restricts further transfers. Do you remember? So under restrictive endorsement, the next party will get all the rights except right of further negotiation. Only this person is permitted to recover the amount of the instrument. Next one, partial endorsement. Instrument is drawn for 10,000. Partial endorsement means part of the amount making, if you are making endorsement for part of the amount, say for suppose 8,000 rupees endorsement. So pay to B 8,000 and A signing the endorsement, we call it as partial endorsement. In the eyes of law, partial endorsement is invalid. Why? Because you can't split the instrument into two parts. You can't tear the instrument. If you tear the instrument, that instrument becomes null and void. Are you all getting my point, students? So partial endorsement in the eyes of law, it is null and void. However, It will be valid if you add one more statement like this. So already received 2000 rupees from the maker of the instrument. Now I'm making negotiation for the remaining amount. So P to pay to B 8000 balance amount, and A signing the endorsement. Now this is a valid endorsement. So partial endorsement is invalid in the eyes of law. Next one, conditional endorsement. Simply imposing conditions in the endorsement, we call it as conditional endorsement. So you can't keep conditions in the instrument. However, you can keep conditions in the acceptance, qualified acceptance. It may be valid depending upon holder consent. And you can impose conditions in delivery, escrow instrument. Escrow instrument is enforceable, valid. But you need to wait whether conditions are fulfilled or not. You need to wait till the satisfaction of the conditions. And you can impose conditions in the endorsement. So simply, pay to A on safe arrival of the goods. So here I am imposing condition not in the instrument. Here I am imposing conditions in the endorsement. Everyone getting my point, students? So conditional endorsement, this is also valid. But the point is endorser liability, endorsee right to receive, these two things depends upon a condition imposed in the endorsement. Suppose endorser is making endorsement like this: pay to E on safe arrival of goods, and signed by endorser. Now the point is endorser liability or endorsee right to recover amount of the instrument depends upon safe arrival of goods. Suppose goods didn't reach destination, all the goods got damaged during transit only. Now endorser is not liable. Endorsee will not get any right to recover amount of the instrument. Are you getting my point, students? Everyone. Suppose if this condition is satisfied, then endorser liability begins and endorsee right to recover the amount of the instrument will also get started. So simply, happening or non-happening of these conditions won't affect the liability of party primarily liable to that instrument. Party having primary liability to that instrument. Who is a party having primary liability to that instrument? Maker in case of promissory note, acceptor in case of bill of exchange. These people liability won't get affected. It's only the matter of endorser liability and endorsee right. Suppose if this condition is not satisfied, then this person will have no liability towards the next party. This person will have right over prior parties. Understood? So here we are having four types of endorsements. But before discussing these four types of endorsements, let's discuss some basic rules with respect to endorsement. A is the holder of the instrument. An instrument is transferable, right? Sima, maker of the instrument, he gave an instrument, he created an instrument. So maker, imagine this is a promissory note and A is a payee. So M made a promissory note in favor of A. This instrument is negotiable in nature. So A transferred this instrument to B. A negotiated this instrument to B. B negotiated this instrument to C, and C negotiated this instrument to D. So the point is between these two, A and B, A is endorser, B is endorsee. And between B and C, B is endorser and C is endorsee. And between C and D, C is endorser and D is endorsee. Suppose D retains this instrument till maturity. Now D will be the payee of the instrument and he's the holder of the instrument. So on maturity date, Mr. Holder is having a duty to present this instrument to Mr. M. So presentment for payment. If M makes a payment, no problem, all the parties to the instrument gets discharged. Suppose if M makes a default, then this holder can recover amount of the instrument from any of the prior parties. So any of the prior parties. That means every endorser is liable to all subsequent parties. Endorser is liable to subsequent parties. First point, remember, every endorser is liable to all the subsequent parties. A is liable to B, A is liable to C, A is liable to D, B is liable to C, B is liable to D, C is liable to D. Second point, endorser is liable not only for instrument amount. Don't think that only for instrument amount he is liable. He is also liable for expenses related to the instrument to the subsequent parties. Sir, expenses means, if they, in the event of dishonor of the instrument, suppose, holder caused that instrument noting and protest. Now, noting and protest expenses. Do you think notary public will do the services at free of cost? Do you think notary public will provide these services at free of cost? Obviously no. Obviously no. Obviously no. So he will charge some amount, that is nothing but expenses. So endorser is liable not only for instrument amount but also expenses related to dishonor. Next one, Sima, endorser is liable to subsequent parties only if he receives notice of dishonor. Now, how he know about the dishonor of the instrument? First of all, on maturity date, if maker of the promissory note makes payment, there is no problem to the intermediate parties. All the parties gets discharged. But whether maker is making payment or not, whether maker defaults the payment or not, how endorser comes to know? He comes to know only by way of notice of dishonor. Yes or no? Only by way of notice of dishonor, endorser will come to know that instrument is dishonored. So endorser is liable under first point and second point only if he receive notice of dishonor. And finally, endorser becoming endorsee due to subsequent endorsements. If endorser becomes endorsee, then all intermediate endorsers, all intermediate parties stands discharged. All intermediate parties stands discharged. Example, A gave instrument to B, B negotiated instrument to C, C negotiated instrument to D, D to E, E to F, F to H, and finally H to D. So previously Mr. D is endorser, but due to subsequent endorsements, E became holder of the instrument, E became endorsee. Now on maturity date, suppose A makes a default. Imagine A makes a default. Now D, the holder, imagine that he's asking H. H will definitely ask F. F will ask E. E will ask D. So there is a cyclic action, circuitry action, right? So to avoid this circuitry action, if the endorser is becoming holder subsequently, then all intermediate parties, H, F, E are said to be discharged. They are not liable. So D can recover amount from only C, B, A. So this is the fourth point. So 4 points we discussed. Every endorser is liable to all his subsequent parties. Second point, is liable not only for instrument amount but also expenses of the instrument. Third point, endorser is liable only when he receives notice of dishonor. Fourth point, all intermediate parties, if endorser is becoming holder subsequently, then all intermediate parties will automatically gets discharged. Now, sans recourse, first thing, conditional endorsement already discussed. Endorsement by which endorser makes his liability dependent upon happening of some event. Okay, fine. Next one, facultative endorsement. Sans phrase endorsement. So, facultative endorsement. When it is desired to waive certain rights, the appropriate words are added to indicate the fact notice of dishonor dispensed with. Example. So if endorser want to relinquish his rights, then he will make facultative endorsement. First of all, is endorser having any right? Yes. What is the right? Receiving notice of dishonor. So simply, if endorser making a facultative endorsement, that means tomorrow if instrument is dishonored, no need to send any notice of dishonor to me. Straight away come to me. I will pay you the amount. I will pay the amount. So simply, whatever rights I'm having, I'm cancelling those rights. That's what facultative endorsement. So in facultative endorsement, condition 3 will not apply. That means endorser is liable under condition 1 and condition 2, rule 1 and rule 2, even though he didn't receive notice of dishonor. Next one, sans phrase endorsement. The words when added to the end of the endorsement indicate that no expenses should be incurred on account of the bill. So if endorser is making a sans phrase endorsement, that means he is giving an instruction to the holder. what instruction is giving to the holder. Tomorrow if this instrument is dishonored, I'm liable only for instrument and I'm not concerned with expenses. So don't incur expenses on my behalf. Even if you incur expenses, I'm not liable for those expenses. I'm liable only for instrument amount. So he is giving that instruction by way of making sans price endorsement. So under sans price endorsement, rule number 2 is not going to get applied. Understood, my dear students? So facultative endorsement, simply endorser is cancelling his rights. Next one. Sans price endorsement, simply endorser is telling that don't incur any expenses on my behalf. Don't incur any expenses on my behalf. Even if you incur expenses, I'm not liable for expenses. I'm liable only for instrument amount. Coming to the sans recourse endorsement, the endorser declines to accept any liability on the instrument of any subsequent party. So simply he himself withdrawing from the instrument. Tomorrow if anything happens to the instrument, I'm not liable to this instrument. That means tomorrow if the instrument is dishonored, suppose A giving instrument to B negotiating the instrument to C to D to E to F to G to H. Now Mr. E is making a sans recourse endorsement. That means he expressly withdrawing from the instrument. He himself withdrawing from the instrument expressly. So tomorrow if the instrument is dishonored, H can recover amount from G, H can recover amount from F, but H can't recover amount from E. E is not at all liable. Why? He already withdrawn from the instrument by making a sans recourse endorsement. So now here, rule number 1, that is, every endorser is liable to all subsequent parties. E is not liable to subsequent parties. That means condition 1 dissatisfied. And condition 2, every endorser is liable for expenses also. Endorser is liable for expenses to all the subsequent parties. Yes or no? The point we discussed. Now here, when sans recourse endorsement is done, he himself expressly withdrawing from the instrument. Therefore, he is not at all bound by the expenses also. First of all, I'm not liable to the instrument. That means, I'm not even liable for expenses also. I'm not even liable for expenses also. Understood, my dear students? Next one. Now, Mr. E is not liable to the instrument, correct? Yes, sir. Mr. E is not liable to the instrument. In that case, what is the need of sending notice of dishonor to this person? That means no need to send notice of dishonor to this person. No need to send notice of dishonor to this person. And finally, we are having fourth condition. If endorser is becoming endorsee subsequently, all the intermediate parties stands discharged in order to prevent circuitry action. We had this point, right? Yes or no? Now let's see the same example. A is the maker of the promissory note, gave instrument to B. B negotiated instrument to C. C negotiated instrument to E. E made sans recourse endorsement in favor of F. F made endorsement in favor of negotiation in favor of G. G to H, and finally H to E. So what is the effect of sans recourse endorsement? He is not liable to the subsequent parties, right? He is not liable to the subsequent parties for both for expenses, as well as instrument amount. In that case, he is not entitled to receive any notice of dishonor. But here, the person E who is making sans recourse endorsement, he became holder subsequently. Now, what about the intermediate parties? Are they liable? Are they discharged? The answer is all the intermediate parties are liable to E. They are not discharged. Why? Because you just see the diagram. E can demand H to make the payment. H can demand G to make payment. G can demand F to make payment. However, F can't ask E. Why? Because E as an endorser, he made sans recourse endorsement. Now F can ask only C or B or A. So circuitry action was prevented. So intermediate parties are not discharged. They are still liable. So fourth condition is also not applicable here. First of all, endorser becoming holder, we call it as negotiation back. We call it as negotiation back. Understood, ma? Understood. So sans recourse endorsement, sans price endorsement, facultative endorsement, all these are types of conditional endorsements. Hope everyone understood the rights as well as liabilities of the endorser and endorsee under different types of endorsements. Next one, conversion of blank endorsement into full endorsement, already explained, just go through it. So 58 section already completed, 59 also completed. So instrument acquired after dishonor or when overdue, the transferee will get same title as that of transferor. Transferee will get better title only when he receive instrument in good faith before maturity, not after dishonor or after maturity, right? Overdue means after maturity. Dishonor means, it's already time period expired and the party is not making payment, dishonored instrument. So the transferee will get same title as that of transferor, he won't get better title. And accommodation note bill already, you all know, accommodation note or bill, generally not enforceable. However, if instrument reaches holder in due course, then all prior parties are held liable to the HDC. Negotiation back, just now we discussed see, P gave instrument to A negotiated instrument to B negotiated instrument to X negotiated instrument to Y, and finally Y negotiated this instrument to A. Y negotiated this instrument to A. So endorser becoming holder subsequently, we call it as negotiation back. What is the effect? All the intermediate parties, B, X, Y will be discharged. However, if the original endorsement is sans recourse, then there will be no circuitry of action and A could sue Y, X by as well as B. Next one. This question is not required. Hund is not relevant for you. Next one, discharge. The important concept, discharge of instrument. Discharge of instrument. Tell me, when instrument is said to be discharged? The answer is when the purpose of creation of the instrument is fulfilled, then instrument is said to be discharged. Ultimate purpose of creation of the instrument, when the ultimate purpose is satisfied, then instrument is said to be discharged. So tell me for what purpose instrument is created? Only payment related purpose, right? So if the payment is done, if the payment is made in due course, then instrument is said to be discharged. When instrument is said to be discharged, then all the parties to the instrument, all the endorsers are ultimately gets discharged. Listen carefully, ma. Mr. M is a maker of the promissory note. He issued promissory note in favor of P. M created promissory note and he issued promissory note in favor of P. P negotiated this instrument to A to B, and finally B to H. On due date, M made payment to H, ma. M made payment to H. First of all, what is the nature of M's liability? The nature of M liability is, maker liability is primary and unconditional. Primary and unconditional. Yes or no? So M's nature of liability is primary and unconditional. So the person who is having primary liability, if that person is discharged because of making payment, then all the parties, all the endorsers will automatically gets discharged. This is first case. And second one, cancellation or release. Suppose H, without consent of prior parties, if H cancels the name of M, or if H expressly removes M from the legal obligations, releases M from the instrument, then ultimately these parties gets discharged. The reason is simple. Release of principal debtor, all the sureties gets discharged. We discussed under contract of guarantee, right? So Mr. M stands in the position of principal debtor and H stands in the position of creditor. If principal debtor makes default, creditor can recover amount from prior parties, simply sureties. So here when you release the principal debtor, automatically the endorsers who are standing in the position of surety automatically gets discharged. So by way of cancellation of the instrument, by way of releasing the party primarily liable, so instrument is said to be discharged. And party primarily liable becoming holder of the instrument. M gave instrument to P. P gave instrument to A to B, B to C, C to H. Ultimately to H, M is the creditor. So H transferred instrument to M. So maker on or after maturity, on or after maturity. So maker becoming holder of the instrument, automatically instrument gets discharged. Instrument gets terminated. Understood, ma? Next one, discharge of a party to the instrument. Discharge of instrument is different. Discharge of a party to the instrument is different. What is the difference? If instrument is discharged, all the parties to the instrument automatically gets discharged. But discharge of a party, it vice versa is not possible. Discharge of a party doesn't mean discharge of an instrument. I'll tell you one example. Suppose maker gave instrument to payee. Maker created an instrument and he issued a promissory note. Sorry, he delivered instrument to P. P negotiated instrument to A. A negotiated instrument to B. B to H. On maturity date, H presented this instrument to M for payment. Presentment for payment. M made default. M didn't made the payment. And H went to A and H demanded payment from A. A made payment to H. A paid the amount to H. Automatically, A and subsequent parties B automatically gets discharged. This is a discharge of party to the instrument. However, A will have a right over prior parties. A can recover amount from B. A can recover amount from M. That means if a payment is done by a person other than party primarily liable to the instrument, then that person who is making a payment and subsequent parties gets discharged. However, prior parties are still liable. Similarly, same example, M to P, P to A to B, B to C, C to H. Now, H without consent of C and B, H, is cancelling the name of A, or he is releasing the A from the instrument. Now, cancelling one of the endorsement or releasing one of the endorser, it ultimately affects the subsequent party rights. Therefore, subsequent parties automatically gets discharged. So, this is also discharge of party to the instrument, but not discharge of the instrument. Next one, by way of negotiation back. M gave instrument to P, P to A to B, B to C, C to H, and finally H to A. So A is becoming holder of the instrument, endorser becoming holder of the instrument. Subsequently, all the intermediate parties gets discharged. Are you getting my point? But instrument is still negotiable, instrument is still enforceable. A can recover amount from either P or M. Understood? So negotiation back. Next one, allowing drawee more than 48 hours to accept. Actually, for acceptance, the holder should give 48 hours excluding public holidays. The time period is 48 hours excluding public holidays. Now, if holder, without consent of prior parties, if holder is giving more time to the drawee, more time is more than 48 hours, then the prior parties from whom the holder failed to get consent, all such prior parties gets discharged. Even in case of qualified acceptance, it is the duty of holder to get consent from the endorsers. It's like a variance. Qualified acceptance is like a variance. If creditor is agreeing to the variance without consent of surety, surety automatically gets discharged. Here also, when acceptor, when a drawee is giving qualified acceptance, holder should get consent from prior parties. He is seeking some modification. Is it okay to you all? Then only he should give consent to the qualified acceptance, or else the parties from whom he didn't took consent, all such endorsers, all the parties gets discharged with respect to that instrument. And sometimes, under operation of law, suppose, endorser becoming insolvent, or, the debt becomes time barred, then also the parties gets discharged. Understood? So insolvent, partner, one of the endorser is becoming insolvent. Only that insolvent endorser will be discharged and remaining parties are still liable. Understood? Next one, material alteration to the instrument. First of all, what is meant by material alteration? So every 3 attempts you can expect a question from this concept, material alteration. So material alteration is nothing but modification. Material means simply significant. So which type of alteration we can call as material alteration? We had a definition to it. Not every alteration is a material alteration. Only few alterations are treated as material. That is, an alteration which is which is affecting the character of the instrument or operation of the instrument, or or which affects the rights and liabilities of the parties to the instrument, which affects the rights and liabilities of the parties to the instrument. Such alteration we call it as material alteration. Example, alteration of character to the instrument. Example, this is a open check. Now someone simply, the holder just he drawn a two transfer parallel lines across the check. Now it becomes cross check. So generally open check, you can get payment across the counter, but cross check you can get payment only through the banker. Now character of the instrument has been changed. Are you getting my point? So any alteration which is affecting the character of the instrument, or any alteration which is affecting the rights and liabilities of the parties to the instrument, such alterations we call it as material alteration. And these alterations are not done by the the maker of the instrument. This was done by the various persons when the instrument is in transmission. I'll tell you. Just listen to the example carefully, ma. So M made a promissory note and issued this promissory note to P to A to B. Now, in the course of negotiation, in the process of negotiation, or in the course of transmission, either P or B or subsequent parties, if they are making alteration to the instrument, we call it as a material alteration when it is affecting the character of the instrument. So one such example, crossing an open check. Next one, converting order instrument into bearer instrument by way of blank endorsement. Converting blank endorsement into full endorsement by adding the name of the endorsee. So all these cases, the instrument is said to be materially altered. And sometimes, suppose, if instrument is created for 8,000 8,000 words, 8,000 figures also 8,000. Now one of the holder, what he did, he simply added 10 and he simply added letter Y after 8. Now what happened? The original instrument is of 8,000 rupees, but after alteration the instrument became 80,000. The amount of the instrument became 80,000. Now this is definitely affecting the rights and liabilities of the parties to the instrument. Originally the prior parties are liable for 8,000 and subsequent parties are having a right to recover only 8,000. But because of this alteration, the rights and liabilities of the parties got affected. So this is a material alteration. So when you read Negotiable Instruments Act, certain material alterations are allowed, like converting open check into crossed check. Next one, converting generally crossed check to specially crossed check. Converting order instrument into bearer instrument into order instrument. All these are permitted. So there would be no effect in such cases. But cases where material alteration is not allowed, for example 8,000 modified as 80,000. So such kind of material alterations, it makes instrument void. The altered tenor will be void and the original tenor of the instrument will be valid. That means the parties are not liable to the altered instrument. The parties are liable only with respect to original tenor of the instrument. So originally the instrument is created for 8,000. So the parties are liable for 8,000 only. Understood? So you can see where the instrument is not treated as void and where the instrument is treated as void, you can see here. So filling blanks of inchoate instrument, converting blank to full, crossing of checks, all these are not, all these, even though they are affecting the character of the instrument, even though they looks like a material alteration, but they are permitted under Negotiable Instruments Act. There is no impact. Next one, dishonor of the instrument. So dishonor. See, when the purpose of creation of the instrument is satisfied, we call it as the instrument is said to be discharged. When the ultimate purpose of creation of instrument is not fulfilled, then we call it as dishonor of the instrument. So when the ultimate purpose is not satisfied, we call it as dishonor. Instruments will be dishonored because of two reasons. Coming to the bill of exchange, due to non-acceptance, and bill of exchange, promissory note, check, dishonor may be happen due to non-payment. Now when instrument is presented for acceptance and you fail to obtain acceptance, then instrument is said to be dishonored due to non-acceptance. If an instrument is presented for payment and you fail to get payment from the party, then instrument is said to be dishonored due to non-payment. and you are having illustrations, you are having a list of circumstances where instrument is said to be dishonored due to non-acceptance. You can go through them, you can easily understand them. So if the drawee does not accept it within 48 hours from the time of presentment, if the drawee does not accept within 48 hours from the time of presentment, and where the presentment is excused, the bill is not accepted, the drawee is incompetent to contract, drawee can't be found after reasonable search. Now, generally, the presentment is required for making, for treating an instrument is dishonored due to non-acceptance. You're getting my point. But under some circumstances, even without presentment, you can call it as, you can treat that instrument as dishonored. For example, drawee called me and told, sir, no need to present the instrument, sir. I'll come to your premises, I'll accept it. That's why I didn't present the instrument. And drawee didn't came to my premises. Drawee didn't give acceptance. Now I can treat that instrument as dishonored. The drawee is a minor, no need to present. You can call it as instrument, you can treat that instrument as dishonored. Drawee can't be found even after reasonable search, fictitious person, fictitious person. Next one, I presented this instrument, 48 hours expired, 48 hours time completed. Excluding public holidays, 48 hours time completed. But still, there is no reply from the drawee. I can treat that instrument as dishonored due to non-acceptance. So these are the circumstances, ma. So drawee is a fictitious person. Drawee gave qualified acceptance and holder may treat this instrument as dishonored. So what is the consequence of dishonor by non-acceptance? Very simple. Holder can show all prior parties instantly. So this is like anticipatory breach. At your CA foundation, you read breach is of two types: actual breach, anticipatory breach. So in case of anticipatory breach, no need to wait till maturity date. So immediately he can take action against prior parties. So no need for waiting till the maturity. Prior parties can be sued immediately. And dishonor by non-payment. So condition 1, you need to present this instrument for payment and you fail to get payment. When these two conditions are satisfied, the instrument is said to be dishonored due to non-payment. So when the instrument is dishonored, I already told you under endorsement, it is a duty of the holder to serve notice of dishonor to the prior parties whom he want to make liable. If he failed to give notice of dishonor to prior parties, then prior parties who didn't receive notice of dishonor, they automatically stands discharged. Understood? So mode of giving notice, time of giving notice. Yeah, I'll tell you these points. But listen to the example. M drawn instrument on N and it was made payable to P. P negotiated this instrument to Q. Q negotiated this instrument to R. R to S, finally S to H. So H is the holder of the instrument. On due date, it is the duty of H to present this instrument to N for the purpose of payment. And if N makes default, N fails to make the payment, then H can recover amount either from S or Q, P, M. But he will get this right only if he give notice of dishonor. Suppose H served notice of dishonor to R. S didn't get any notice of dishonor. Automatically, S gets discharged. Now, R paid amount to H. R is making payment to H. Now, R will get right over the instrument. So, R can recover amount from Q, P, M. However, R gave notice of dishonor to P. R didn't give any notice of dishonor to Q. Therefore, Q automatically gets discharged and P will be held liable to R. The moment P makes payment to R, so P will get right over M. Are you getting my point? So now in this example, who is giving notice of dishonor? Either holder of the instrument or the person whom holder wants to make liable. These people can give notice of dishonor to the prior parties. Effect of not giving notice of dishonor, the parties gets discharged. Understood, ma? So notice by whom, notice to whom, and contents of the notice. Very simple. Instrument is said to be dishonored. Instrument is dishonored due to the reason, like that. Time of giving notice, reasonable time. And omission to give notice of dishonor, the parties to whom notice of dishonor is not served, they will be discharged. Mode of giving notice, you can give notice orally or in writing. You can send it through post, speed post, courier, email, and you can give notice to the agent of the principal also. So anyway, all these are valid modes of serving notice only. And when notice of dishonor is not required, when notice of dishonor is not required. In case of facultative endorsement, just now we discussed facultative endorsement, endorser is relinquishing his rights. So in case of waiver by the party, no need to serve notice of dishonor, but still the party is liable to pay, liable to the instrument. And payment stopped. In case of check, drawer is having a power to give instruction to banker. So don't make payment of this check like that. He can give instruction to the banker. So yes, when payee presents this instrument for payment, banker told the payee that, sir, sorry, this instrument was dishonored due to stop payment order from drawer. Now payee is not required to communicate that matter with drawer. Why? Because drawer is responsible for dishonor. If you are a party responsible for dishonor, no need to give the notice. The main objective of giving notice is to intimate you about the dishonor. And you already know that instrument is dishonored. So ultimately, what is the reason? Why should I give notice of dishonor to you? Party not found. So endorser not found. No need to give notice of dishonor. When you find endorser, you can make him liable straight away. Unavoidable circumstances. So simply, maybe the holder of the instrument met with an accident or sudden sickness, sudden death. In that case, for reasonable time period, even though you didn't serve notice of dishonor, you can make prior parties liable. The prior parties are not discharged. And parties receiving must transmit notice of dishonor. I told you that only. See, in my example, Mr. R got notice of dishonor from H. Now R can transmit the notice of dishonor to prior parties. P got notice of dishonor from R. Now P can transmit notice of dishonor to M. And one more point, notice of dishonor is not required to be given to the person who is responsible for the dishonor. Why? They are already aware of the fact that notice instrument is dishonored, and they are the persons responsible for dishonor. Understood? Next one, agent of presentment. When you give notice of dishonor to the agent, notice to the agent is nothing but notice to the principal. Contract of agency, we discussed this point, right? Next one, next concept, check. So almost we are at the final stage of marathon of Negotiable Instruments Act 1881. So dishonor of the check. Section 138, most practicable concept, relevant concept. Nowadays you can have this concept. So yes, right now I think two of my clients, I gave advice regarding section 138. When a check is dishonored due to insufficiency of funds, then the drawer will get a punishment. The punishment is imprisonment up to 2 years or fine up to 2 times of the instrument amount. 2 times of the instrument amount or both. When instrument is dishonored due to insufficiency of funds, the drawer is going to get the punishment of imprisonment up to 2 years or fine up to 2 times of the instrument amount or both. But for levying this punishment, 6 conditions are to be satisfied. The conditions are: this instrument should be issued for discharging a legally enforceable debt. Suppose drawer is giving an instrument as a gift to payee. Now this instrument is dishonored due to insufficiency of funds. Now is this drawer liable under section 138? The answer is no. Why? Because gift is not legally enforceable. Gift, there is no consideration. Only in order to discharge a legally enforceable debt, drawer should issue a check to the holder. And the holder should present this instrument to banker within 3 months. That means within its validity period. As per RBI guidelines, a check is having a validity of 3 months from the date of instrument. And bank should return the check stating that insufficiency of funds. Now the holder should give notice of dishonor to the drawer within 30 days of dishonor, 30 days of the intimation. And drawer should make payment to the holder within 15 days. So why drawer should be given an opportunity? So here drawer should be given an opportunity. The meaning of this point is drawer should be given an opportunity. Why? Because being a businessman, daily he will check the bank balance and he will issue the checks. Today business person gave a check and the payee, he forgot to encash the check. 1 month completed. And drawer very busy with his business, he didn't prepare bank reconciliation statement. And on the date of issuing check, he checked the bank balance. He thought that bank balance is sufficient to discharge the payments, and he is issuing the checks. So a month back, he issued a check to one of the payee. Now that person went to the bank for encashing the instrument, for encashment of the instrument. And banker told, sorry sir, this check is dishonored due to insufficiency of funds. Here, dishonor happened. So drawer dishonored the instrument, it's not intentionally, it happened unintentionally. It happened unintentionally. Lack of preparation of bank reconciliation statement, BRS. He thought that bank balance is sufficient to discharge the instrument. That's why he issued new instruments. All the new instruments got encashed. That's why bank balance came down and the previously issued check got dishonored. So this is an unintentional dishonor. So that's why, when you give opportunity to the drawer, so definitely drawer will use the opportunity. Drawer will make payment within the next 15 days. Of course, if drawer fails to make payment within the next 15 days, then holder should file a complaint in writing in court within the next 1 month. Then only this section 138 will be levied. Suppose, suppose just example. So for discharging legally enforceable debt only, legally enforceable debt, drawer gave instrument to the holder, the date of the instrument, for example, 1st April 2023, and holder presented this instrument with bank on 11th April 2023. So banker returned the check exactly on 15th April 2023, stating that instrument is dishonored due to insufficiency of funds. Now from here you need to add 30 days. 30 days, by 15th May 2023, the holder should communicate the matter with drawer. Imagine, holder gave the notice exactly on 15th May only. 15th May, exactly 15th May. It is within the time limit. Now, drawer should make payment within 15 days. What is the time limit? 30th May. So, simply add 15 days, 30th May 2023. So, by 30th May 2023, drawer should make payment to the holder. Sir, drawer failed to make payment by 30th May, sir. In that case, holder should file complaint by 30th June 2023. Now court will order. So what court will order? Court will levy the punishment. The punishment is imprisonment up to 2 years or fine up to 2 times the instrument of the amount. Sorry, up to 2 times of the amount of the instrument. Sometimes both. Depends upon frequency of offenses he commit. Understood? So that's it all about section 138, section 138. Now section 139 onwards, it's simply, penalty and offenses. So all the offenses under negotiable instrument are cognizable offenses, and they are compoundable in nature. Cognizant simply, someone file an application in court. If someone files a complaint in court in writing, then only these cases will be allowed. Simply, dishonor of the instrument, don't think that court will come forward and court will give judgment. So someone, the affected person should file a complaint in writing with court. Then only these cases will be handled. Then only, warrant will be issued in the name of the defaulted person. Understood? And under section 138, when a case goes to the court, when a complaint is filed in court regarding dishonor of the instrument, court will make a presumption that instrument is drawn or issued only for consideration. That means this instrument will be, this presumption will be always in favor of the holder. The presumption in beginning of the chapter also we saw a presumption under question 2 or 3. I didn't remember. Presumption, every instrument is created only for the consideration. So when an instrument, if it is dishonored due to insufficiency of funds, and when such complaint is filed in the court of law, so the court will always stands in favor of holder only. They will make they are under a presumption that instrument is created only for consideration. And since this is a presumption, it is rebootable. It can be revoked if contrary is proved. Suppose the drawer proved that, sir, this is given as a gift only, I'm having the evidence. If contrary is proved, until contrary is proved, court will stand in favor of holder only. Court will make a presumption that this instrument is drawn only for consideration. And next one, defense which may not be allowed in any prosecution under section 138. Suppose I'm the drawer, I issued a check and this check got dishonored due to insufficiency of funds. All the 6 conditions were satisfied. now court is levying punishment on me. Now I'm telling that sorry sir, I don't know the presence of section 138. I don't know that if the check is dishonored due to insufficiency of funds, definitely I'm going to get this much punishment, this much imprisonment, this much fine. I don't know, sir. So please allow me. Please remove all these punishments on me for this one time. I can't make argument like this. Ignorance of law is not an excuse. So you can't take a defense stating that I'm not aware of the conditions of section 138. I told you, if a check is dishonored due to insufficiency of funds, the drawer of the instrument may get an imprisonment up to 2 years or fine up to 2 times of the instrument amount or both, right? Yes or no? But the question is, if the drawer of instrument is a company, drawer of the check is a company, then who is going to face imprisonment? The company being an artificial person, how can you arrest a company? You can levy fine on the company. Company will pay fine out of its pocket. But imprisonment, who is going to get that imprisonment? The answer is person in charge. The person who is responsible, who draws the instrument. Simply, finance manager. If there is no finance manager, then finance director. If there is no finance director, then managing director. If there is no managing director, then all the directors of the company. So these people are going to get imprisonment. Understood, ma? But if you see the directors, a few directors, simply independent director or a director who do not participate, who didn't take any participation in day-to-day efforts, simply non-executive directors or nominee directors, directors appointed by the central government or state government. You're getting my point. So these people, non-executive directors, simply independent, example independent. Next, directors appointed by CG or SG, simply nominee directors, they are not going to get punishment under section 138 because they are not meant for participating in day-to-day affairs. They simply act as a watchdog, whether company is complying all the applicable rules and regulations, whether the company is following all the norms specified by the stakeholders. That's it. Once again, I'm telling you, you just read the examples are very important from examination point of view. So go through the examples. Here, the crux of the example, beneficiary immaterial. Who is the drawer of the check? Now, simply I'm drawing the instrument. Now, this instrument I'm giving you only for the benefit of my neighbor or for the benefit of my cousin. So my cousin is liable to you, right? My cousin is liable to you. In order to discharge his debt, I'm giving you the check. This check got dishonored. Now who is going to get punishment under section 138? Is it my cousin or the drawer? The answer is drawer. The drawer should take care while issuing the instruments. He should take care of the bank balance. He should check bank balance, whether bank balance is sufficient to discharge this instrument or not. Understood? So beneficiaries are not going to get punishment. Only the legal persons who are issuing these instruments are going to get punishment under section 138. And I told you, offenses under negotiable instruments are cognizance offenses. So only when the complaint is filed in writing within the stated period with a metropolitan magistrate or first class judicial magistrate, then only these cases will be entertained, or else the cases will not be entertained. That means these cases will not be taken up. Next one, section 142A. So this is a single drawer, single payee. Generally, drawer is having okay, listen to the example. Just drawer, payee. So drawer is having account in State Bank of India, Hyderabad, and payee is having account in Punjab National Bank, Tamil Nadu Mercantile Bank, Chennai. So drawer gave instrument to payee and the instrument is dishonored due to insufficiency of funds. Now I told you, payee can file complaint against drawer under section 138. So the complaint can be filed with a metropolitan magistrate or first class judicial magistrate. That's what I told you. Each and every district, each and every city, each and every town is having a metropolitan magistrate, first class judicial magistrate. Now the point is, within which jurisdiction, which jurisdiction you need to select. The answer is, when payee deposit this instrument, when payee deposit this instrument with his banker, collecting banker, the premises where collecting banker, or the premises or the place where payee is having a bank account. Sir, he is having a bank account in Chennai, sir. Then Chennai Metropolitan Magistrate or Chennai First Class Judicial Magistrate is eligible to take up this case, is eligible to handle the case. That means payee can lodge complaint only in Chennai Metropolitan Magistrate. Suppose payee, instead of depositing instrument with his banker, payee directly went to Hyderabad and payee deposited this instrument with SBI in Hyderabad branch. And he came to know that instrument is dishonored due to insufficiency of funds. In that case, Hyderabad Metropolitan Magistrate or Hyderabad Judicial Magistrate of first class is entitled or is eligible or competent. It is a competent court to handle the case. Are you getting my point? Where the instrument got dishonored. Suppose if he deposited instrument with his bank account, with his banker, now where he is having a bank account, that jurisdiction metropolitan magistrate or that jurisdiction first class magistrate is competent to take up the case. Instead of going to the collecting banker, if he directly go to the paying banker, if he directly came to know that this instrument got dishonored due to insufficiency of funds, then where the instrument is dishonored, in Hyderabad, metropolitan magistrate or first class judicial magistrate is competent to take up the case. Understood? Suppose drawer gave some 5 checks to payee. 5 checks, 1, 2, 3, 4, 5. So payee is having 5 branches. One is in Chennai, Madurai, Coimbatore, Delhi, Ahmedabad. And same fellow drawer is a customer to all these 5 branches. He issued 5 checks. In all these 5 locations, the checks got dishonored. Now, in all these 5 locations, metropolitan magistrate, is a competent court to handle the case. So initially, in 5 places, cases were filed. Later, payee came to know that the cases were filed in 5 different locations. Now, what payee can do? So he can transfer 4 pending cases to the first metropolitan magistrate court. It's up to the payee. So he can transfer all the pending cases to a single metropolitan magistrate court. Understood? So that's what section 142A. So transfer of pending cases to the single metropolitan magistrate jurisdiction. And next one, power of court to try case summarily. So here, trial offense, speedy trial, speedy and efficient disposal. Definitely, ma'am, when matter goes to the court, a lot of investigation will happen. A lot of time period is required. So the reason is, innocent should not be punished. We can release 100 culprits, but we should not punish an innocent person. But ultimately, we are punishing only innocent persons, right? Okay, fine. So depending upon the settlement of the cases, it's not settled. It's a speedy trial. Trial is nothing but handling of the case. Trial means here court will allow the drawer of the instrument, payee of the instrument to make a statements. So both parties will argue. So based on the argument and based on the evidence, finally the judge will give judgment. So when case goes to the judge, don't think that judge will give judgment based upon flipping up a coin. So if head comes, drawer is correct. If tail comes, payee is correct. It's not like that. So based on the statements, representations made by the parties and based on the evidences submitted to the court, they are going to give judgment. So this will definitely take a time. And this entire process, we call it as a trial. Understood? So yes, you're having a summary trial, but under summary trial, maximum imprisonment is 1 year and maximum fine is 5,000 rupees only. And in case of speedy trial, in case of speedy and efficient disposal, all these are varieties, various types of finalizing the case, closing the case. So speedy trial, you're going to get judgment in a faster mode. So depending upon simply, with the interest of justice only, we continue from day to day until its conclusion. unless court finds that adjournment of a trial beyond the following day. So simply in one day we are going to close this case based upon the statements made by the party, based on the representations of the parties and evidences of the parties. We are going to give judgment in a single day, PD 12. No, sir. Certain matters are required, sir. Certain matters to be discussed, sir. Certain evidences to be submitted, sir. Okay, then we'll shift it to speedy and efficient disposal. It will be, the conclusion will be given within 6 months from the date of filing of the complaint. Next one, section 143A, power to direct interim compensation. See, today a payee is filing complaint on drawer. No, court definitely, court will not have any knowledge who is the guilty and who is the aggrieved party. So definitely they need time to investigate the matter. Then they will come to know who is the defaulting person, who is the aggrieved party. At the end they will come to know. But this will take a time. For example, 1 year. Until 1 year, drawer is not required to pay amount to the payee, and payee, he will definitely suffer some opportunity cost. So payee is making argument, sir, I'm entitled to recover amount of the instrument, I'm entitled to receive amount of the instrument, but drawer playing some cheap tricks. Almost 1 year, for 1 year I'm having an opportunity cost. If I had that money, I can start a business, or I can resume the business operations, whereby I can generate some money. Yes or no? There will be an opportunity cost. So that's the reason, it's the court is having a power to levy interim compensation. So court can ask a drawer, come on, pay 20% of the instrument amount now to the payee. At the end, if you win the case, drawer, if you win the case, I'll ask payee to return back the amount along with interest, rate specified by RBI. If you lose the case, you need to remit balance 80% along with the interest specified by RBI for this tenure. So just interim compensation. This is not a final compensation. This is not full and final settlement. Interim. As long as case runs, this case will definitely take more time. So during this period, definitely this would be an opportunity cost to the payee. So first pay him 20%. If you lose the case, then pay balance 80%. Now, what is the time period for making interim compensation, for paying interim compensation? It's that 60 days. Of course, you can ask for extension, but the extended time period will not be more than 30 months. So finally, within 90 days, you need to make interim compensation. You need to pay interim compensation. Next one, offenses to be compoundable. That means, with compromise. Even the matter goes to the court, both drawer and payee, drawer of the instrument, payee of the instrument, if they come to a compromise, they can come to the compromise also. So payee, drawer, so drawer can come to payee, payee, this will take more and more time. So finally we will enter into a compromise arrangement. You please withdraw the case, I'll pay you the amount. So permitted, sir? Yes, permitted. Yes, permitted. So offenses under negotiable instruments are compoundable in nature. So with compromise, these cases can be withdrawn. And power of the appellate court to order payment pending appeal against conviction. So here you can observe two types of courts, trial court and then appellate court. Appellate, just wait. Appellate court. So lower court, higher court. It's like that. Lower court, higher court. Just I'll write it. Wait. Trial court, appellate court. So both drawer and payee went to trial court. Here, payee won the case, drawer lost the case. But drawer is having an evidence. Drawer is having another argument. So no, sir, payee should not win the case. I'm having this evidence, but trial court didn't consider the evidence. That's why drawer lost the case. So trial court ordered drawer to make payment to payee. So now what drawer can do? First thing, he can make payment. He can make payment, or else if he's having a best evidence, he is having an alternative argument, then drawer can file an appeal with appellate court. Appeal is nothing but challenging the decision of the lower court. You can file an appeal in the high court. So drawer he's having an option to challenge the trial court judgment. He can go to appellate court. Now the point is, in appellate court, so for going to appellate court, drawer should deposit 20% of amount ordered by the trial court as a deposit. Simply drawer should deposit some amount. How much? 20% of the amount ordered by the trial court. It's like a security deposit. Simply to avoid the people, simply to avoid the people who are not having a reasonable grounds but still filing an appeal in order to drag the case, in order to make some inconsistency to the aggrieved persons. So some parties definitely, ma, no, I know my mistake is there, but still I'll go to the court. Why? So matter will be dragged for a longer period, and this longer period, I can enjoy with that money. So this should not happen. No, only a people with reasonable grounds should prefer an appeal, not all the people. Not all the people. So here, appellant court, while accepting this appeal, they will ask drawer to deposit 20% of the amount ordered by the trial court. Now drawer, when he makes such deposit only, the appeal will be accepted by appellate court. So amount how much? 20%. What is the time period? 60 days from the date of order. So 20% of the fine or compensation awarded by the trial court. Understood. So finally, in appellate court also, drawer lost the case. Then what happens? The deposit made by the drawer will be transferred to the payee, and the balance amount along with interest, drawer is required to pay to payee. Suppose if the drawer, if the appellant is acquitted, free from charges, then what happens? All the deposits made by the drawer will be returned to the drawer. And whatever the amount payee got, payee should return these amounts to the drawer along with interest. Same time period, 60 days. You may get extension of 30 days, but nothing more than that. Understood, ma? So with this, the concept of negotiable instruments marathon we completed. The next topic of marathon is General Clauses Act 1897. We can expect 8 marks from this chapter, including multiple choice questions. The General Clauses Act is all about study of general words which were not defined in other acts. Every act, you will find definitions under section 2. But there are some general words like, from, to, shall, may, means, include, good faith, month, year, section, rule, subsection, subrule. So some common words which we use in all acts, and we can't find definitions to them. So all these words, which were not defined in other acts, were defined under General Clauses Act 1897. So when you come across these words, and if respective act is not defining the word, then kindly refer to General Clauses Act 1897. I'll tell you why, we had a separate act for general definitions. The reason, see, if you take a Companies Act, any act, Income Tax Act, Companies Act, section 2, you'll find definitions. In Companies Act, more than 90 words were defined under section 2. We had a definition to company, AOA, memorandum of association, prospectus, alter, and then a small company, one-person company, private company, public company. So everything, we had a definitions. Why? The reason is, in entire 470 sections of Companies Act, you find a word company, common. And, company means what? You'll find financial year. Financial year means what? Financial statements means what? Director of the company. Director means what? So now we need to define these words. If you start defining these words in all the sections, wherever it comes, defining those words under this section, what happens, the size of the law will be increased. The textbook, the size of the book will be increased. Why? So we are defining the word company almost, we need to define company word under all 470 sections. Now, instead of repeating all these points, in all the provisions, let's place all these common words, all these common definitions under one roof. Simply, at one place, that is, section 2, definitions part. So by having a definitions part, one can reduce the size of the law. They can shorten the law. So no need to repeat these words in all the provisions of the act. And similarly, so the general words which we use commonly in all the acts, so let's define them under one roof, one place, that is, General Clauses Act 1897. So here we are going to study the definitions and general rules of the construction. So first General Clauses Act was enacted in the year 1868. Later it got repealed. So what is meant by repeal? I'm going to tell you. Just wait for uh, 15 to 20 minutes. So first act got repealed, and second time, General Clauses Act 1887 was introduced, and this General Clauses Act 1887 was also repealed, and finally General Clauses Act 1897 was enacted. So the date of commencement is 11th March 1897. So coming to the applicability, it is applicable to all central acts. What is meant by central act? I'll tell you. Just wait. The objective of this General Clauses Act, the main objective, shorten the language of the central acts. When you define general words under General Clauses Act, now no need to define these words under respect to central acts. Therefore, the size of the act will be reduced. And to provide as far as possible for uniformity of expression in central acts by giving definition of a series of terms in common use. Suppose, if we start defining all these general words in all the acts, sometimes you may give more meaning to a word. In some acts, you may give less meaning to the word. So now what happens? You will miss uniformity of expressions. Instead of doing that, let's define all general words at one place where you'll have a same meaning, same expression for all the central acts. Understood, ma? So only two main objectives. One is to shorten the language of central act, and then next one to provide uniformity of expression in the central acts. See, I'm going to cover only important areas of this chapter, ma. So this is a marathon class. This is not a detailed lecture. I covered everything in a detailed manner in our regular classes, but this is a marathon, so I'll cover only important areas. Is it clear, ma? Applicability of General Clauses Act, here we can't explain from area point of view. Is it applicable to whole of India, or is it applicable to whole of India excluding Jammu and Kashmir? Here we can't decide like that. Here the Central Act, if it is applicable to whole of India including Jammu and Kashmir, then General Clauses Act with respect to Central Act is applicable to whole of India including Jammu and Kashmir. If any particular central act is applicable to a particular area, then General Clauses Act with respect to that central act is applicable only to the particular area. So applicability of General Clauses Act depends upon applicability of central act. And we had a main points, ma, preamble, definitions, means, include, shall, and may. So preamble, every act, ma, beginning under the title, short title, long title, you will find the preamble. So every act has a preamble. It will express the scope, object, purpose of the act, and it is the main source for understanding the intention of lawmaker behind the act. So let's have an example. If you take Negotiable Instruments Act preamble, an act to define, amend the laws relating to the promissory notes, bill of exchange, checks. So when you see the negotiable instrument, word negotiable instrument, you'll get a meaning like this. Instrument means a written document capable of creating rights and obligations on the parties thereto. Negotiable means freely transferable. So any written document capable of creating rights and obligation on the parties thereto, if it is freely transferable, then it is a negotiable instrument. Now everyone will start thinking like this, railway receipt, bearer debenture, share warrant, bill of lading, all these instruments, they are transferable. They are simply by delivery you can transfer the ownership. You can transfer the ownership. Understood? So now they are also negotiable instruments by custom, but our Negotiable Instruments Act is not going to apply to such instruments. How can you say, sir? Simply look at the preamble. So preamble, the act covers only three types of instruments, that is promissory note, bill of exchange, check. Understood? And one more important point, if there is any inconsistency between section provision and preamble, you need to follow sections only. You need to follow provisions of the act. You should not go with preamble. If provision is not clear, then take assistance of preamble. If provision is very clear, then follow the provision only. Understood, ma? Next one, definitions. In each and every act, you will find definitions under section 2. Next, means and or include. Means, certain definition use the words means. Such definitions are exhaustive in nature, complete in nature. They're not incomplete, they're complete, and they exactly define the term. Suppose if you look into the definition of company means, it begins with means, a company incorporated under this Companies Act. So company means association which gets incorporated under Companies Act, we call it as a company. That's it. So partnership firm, association of persons, body of individuals, they are not at all treated as a company. Next one, director. Director means, a director appointed to the board of a company. No, not every appointed person is a director, but every person who got appointed to the board, we call him as a director. So here we are defining the words. Here we are exactly defining the terms. So any definition, if it contains the word, means, it is exhaustive in nature and it is exactly defining the term. But if you find the word includes, so here we are not defining the word ma. It is simply, we are giving a list of the items, which the term will cover. Will simply gives the list of items, list of items which the term will cover. The word covers the following items, like that. Now, if you look into the definition of dividend, dividend includes interim dividend. So the definition is not defining the dividend. It's simply telling that dividend includes interim dividend. So why the definition? No, what is the significance of such definition? Very simple. The provisions of Companies Act which are applicable to the dividend are equally applicable to the interim dividend unless contrary is shown. Unless contrary is shown, all the provisions applicable to the dividend are equally applicable to the interim dividend. Suppose, interim dividend can be declared by directors. That provision is there. Now only that provision is applicable to interim dividend. Understood? Final dividend, it is declared by the members at general meeting. Now you need to apply that point only with respect to final dividend. So if there is no contrary, then the provisions applicable to the dividend are equally applicable to the interim dividend. You had a definition of debenture. Debenture includes stock. That stock. Next, share definition. Share includes stock. So includes, it is inclusive in nature. It's not exhaustive in nature. Understood? And if you find a word, with means and includes, like if you look into the word prospectus, prospectus means any document described and issued as a prospectus, and it includes shelf prospectus, red herring prospectus, and deemed prospectus. So this is also exhaustive in nature only. Getting my point, students? Next, shall and may. Shall is a mandatory thing. May is optional. It's not mandatory. It's a directory or enabling provision. So if any provision, if it contains the word shall, you are having a duty to comply that provision. Understood? So if you make default with respect to provisions having shall, then punishment is applicable. But sometimes you need to interpret may as shall. You need to interpret may as shall. Suppose if you take section 3 of the Companies Act 2013, a company may be formed for any lawful purpose. Here may be formed for any lawful purpose. There is a chance of second interpretation. The second interpretation is a company may also be formed for any unlawful purpose. But if you take second interpretation, it violates the main theme of the Companies Act 2013. So you should not take that second interpretation. You should stick on with first interpretation only. That's why here the word may, even though it is given may, you need to construe it as shall. Understood, ma? So may shall be read as may. Sometimes may shall be read as shall in wherever the situation demands. Next one, section 1 of the General Clauses Act, it will contain short title, long title, scope, extent, etc. So General Clauses Act contains only short title, and that is in the preliminary part of the act. And coming to the definitions, section 3 definitions, section 4 is also of definitions. Previously, before 1897 Act, we are having two more acts, 1868 and 1887. The point is the definitions which were defined under old acts. So what is the applicability of those definitions? Are they applicable or not applicable? If they are applicable, from which date onwards they are applicable? So that thing was explained under section 3 and section 4a. Section 3 is the definitions under the new act, and 4a, definitions related to previous enactments which got repealed. So the answer is, they are in existence only. They are applicable from the date of enactment onwards. Next one, act. So act under section 3 clause 2. So act used with reference to an offense or a civil wrong shall include a series of acts, words which refer to the acts done, extend also to the illegal omission. So simply, act covers the following items. Act means it covers a series of acts. Series of acts. It need not be a positive act. It may also be a negative act. Covers both negative as well as positive. So series of acts, the words we use, and the omissions, illegal omissions, all these items covers under the definition of act. Suppose I want money. No, I found a rich person. No, I traced out a rich person. Now I kidnapped a person. So kidnap comes under an act. No offense. In order to control that person, that person is crying, that or that person is, he's trying to escape. That's why, I gave him 2 to 3 blows. 2 to 3 times I kicked him. Now, that fighting, the blow I gave him is also comes under, act only, series of acts. Next one, I didn't supply any food to that person for 2 days, ma. So that, that person will come under my control and he will call his people so that I can get money, like that, it's my intention. Now all these things comes under the definition of act. So now, I omitted to supply material, food item to that person. It also comes under the act. And moreover, under companies act, every company is required to file annual returns with ROC. So directors failed to file those forms with ROC. Now that is an omission, illegal omission. It will also comes under the act. So simply doing an act, doing a thing is an act. Generally, many people think that so doing a particular task is nothing but act. But what the definition is telling you, even if you omit to do a thing, it will also comes under the act. For example, company is required to conduct a general meeting within 6 months from the closure of the financial year. 1 year, directors didn't made any call for general meeting. They didn't call general meeting. They omitted in calling. They omitted in calling general meeting. Now that omission is also treated as an act. So act covers including illegal omissions. Understood? So the definition, the example of which I told you is there in the material. Just go through it. Next one, affidavit. So affidavit is an inclusive definition. Affidavit includes affirmation, declaration. In case of persons allowing affirming or declaring instead of swearing, the above definition is inclusive in nature. It states that affidavit shall include affirmation and declarations. So very simple, I found this word mostly, when a person is contesting for elections, they are required to file an affidavit with election commissioner, EC. They need to file affidavit with election EC. So there you can find the matter like this, I so and so, my family members and my assets, my liabilities. So whatever information I am furnishing, whatever in the above information furnished by me is correct and complete. Like that, I'll make a statement and I'll sign the document. Now that document becomes affidavit. It is nothing but a declaration as well as affirmation. Simply, confirming the statement. Confirming this statement. I'm making a statement and I'm confirming this statement, and usually it is in writing. Of course, tomorrow, if any mistake is found in this document, I'll be punished a lot. Understood? So this is nothing but affidavit. Affidavit includes confirmation, affirmation, declaration. Next one. Central Act means what? Central Act. First of all, Central Act means Act of the Parliament. But we are having one more definition, and it also includes one part of the definition is it also includes an act of Dominion legislature or of Indian legislature passed before commencement of the Constitution. As you all know, till 15th April 1947, India is under the control of Britishers. Britishers ruled India. And on 15th August 1947, we got independence. And on 26th January 1950, Republic Day, we celebrate. Yes, that is the day of Constitutional Day. So we had our own Indian Constitution. So from this date onwards, we are having a parliament and, President of India. Now, Central Act means, the bill which was approved by the President. Before President, Parliament will give approval. So the bill which receives the consent of Parliament and President of India, it becomes an act and it is a Central Act. But before independence, before Constitution and after independence, during this time period of some, say for suppose 2.5 years, we are having a Constituent Assembly and it is headed by Governor General of the Council. Governor General of Council. So now Central Act covers both the things. An act approved by the General Council, Governor General of Council, and approved by President of India. So both comes under Central Acts. I told you, General Clause Act is applicable only with respect to Central Acts, not with respect to State Act. You're getting my point? The Governor General in Council or Governor General acting in a legislative capacity. So before Constitution, we had a Governor General and Constituent Assembly. After enactment of Constitution, we are having Parliament and President of India. The Central Act means simply act of the Parliament after Constitution, or act of a Governor General of in Council before Constitution. Next one, coming to the central government. Yes, central government is also of two types, ma'am. Before Constitution, the Constituent Assembly and Governor General in Council. And with respect to provinces, chief commissioners, administration part was held by chief commissioners, ma. So they will also come under the definition of central government. But after enactment of the constitution, president, parliament. Next, with respect to union territories, lieutenant governors or chief commissioners will also comes under the central government definition. And with respect to state government, not entire state government functions comes under central government, only the functions which are within the scope of authority of the central government only, those items comes under those functions comes under the central government. So simply president, parliament, lieutenant governors, next one chief commissioners. And with respect to states, a particular activities which were defined within the scope of the authority, so they will come under central government definition. Next one, commencement. Commencement means simply coming into the force. So commencement of act, suppose if you take Negotiable Instruments Act, it was enacted in the year 1881, Negotiable Instruments Act 1881, but it came into force with effect from 1st March 1882. Now commencement of an act is 1st March 1882. So commencement means simply coming into the force. Sir, if nothing is specified, what would be the time of commencement? Very simple, that midnight. So 1st March 1882 midnight means when clock hits 12 o'clock, night 12 o'clock, that is the starting point of the day. That is the starting point of the day. From that date onwards, the act comes into the force. Next one, document. Very, very important definition. So document, any matter either written or expressed or described upon any substance may be anything, paper, cardboard, banner, metallic strip. If you look into the lift, lift which carry passengers, lift, right side of the lift you can see instructions, how to use the lift, how not to use the lift, how many people should go at a time. So everything, detailed instructions will be given. Now that is also a document. So don't think that document should be always in a paper form only. No, on any substance. And that writing expressed, it by means of letters, figures, marks. So letters, words. So as per section, all these are letters, words, figures, numbers, marks, some diagrams, pie charts, diagrams, bar diagrams, everything, for expressing the matter and for recording the matter. And this document should be so people should have an intention to use this document, or which may be used, at least they may use that document in future for the purpose of recording that matter. So simply anything which is satisfying these four things, we call it as a document. First of all, it should be in writing, expressed or described upon any substance by means of letters, diagrams, figures, which is used, presently we are going to use it, or in future we will use it. So it should have a usage point. It should have a usage point. So simply writing like this, simply drawing like this, in future we are not interested to use this, or we can't use this. No, this is not a document at all. And why we are maintaining a document, sir? Simply for recording the matter. So books of accounts, mails, everything comes under the definition of document. And remember this point, my Indian currency notes are not covered, will not be covered under the definition of the document, because Indian currency notes, it is satisfying all the four conditions. So there, you can find a matter, you can find a letters, you can find a figures, you can find a substance. It is a substance, it is having some printing marks. So writing, no need be, no, writing includes typewriting, should not be in manual writing only. So typing will also comes under writing definition only, writing word only. Understood? So now Indian currency notes is satisfying all the requirements of the document, but it is not at all treated as a document. It was expressly provided that definition of document excludes Indian currency notes. Understood? Next one, financial year. So financial year means, under Companies Act, we had a separate definition for financial year. If companies are incorporated on or after 1st January, 31st March of the following year would be the closure of financial year. For other companies, 31st March of the relevant year will be the financial year. Like that, we had a definition in Companies Act. But coming to the General Clause Act, financial year means, it starts with 1st day of the April, ends with 31st of the March. Now there is a conflict between General Clause Act financial year definition and Companies Act financial year definition. Now which definition I should follow, sir? If you are following, if you are covered under Companies Act, follow Companies Act financial year definition. That means, if there is any inconsistency between General Act and Special Act, follow Special Act. Follow Special Act. Understood? Follow Special Act. So here also like that only. If that Special Act is silent, or if that Special Act is not defining a word, now come to the General Clauses Act. Now coming to the year, the commencement date is 1st January and the end date is 31st December. So financial year commencing on 1st day of the April and closure would be closure is 31st March. Next one, good faith. Good faith. In Negotiable Instruments Act, holder in due course, we studied the word good faith. In Indian Contract Act also, in pledge, I think. So pledged by non-owners, mercantile agent, pledged by a person having possession of the goods under voidable contract, pledged by a person having a limited interest, pledged by a co-owner. In all these cases, the pledge is valid only if party acts in good faith, right? We discussed these points. Now these acts are not defining a good faith. Now what is meant by good faith? So General Clauses Act, a thing shall be deemed to be done in good faith where it is in fact done honestly, irrespective of whether it is done negligently or not. So honestly, if you are doing the things honestly, then you are said to be in good faith. Even if you are negligent, okay, no problem, you are said to be in good faith. So the point is, there is a case study in with respect to good faith, so the person is very honest, sir, innocent, honestly, simply innocent, but he was very careless, sir, or he is very reckless, sir. Now can we say that the person is acting in good faith? No. HDC, if he had a reason to suspect some mischief, some manipulations have happened, so the person delivering the instrument is not having ownership, reasonable ground is there to suspect, but still, recklessly, carelessly, he's taking the instrument from that party. Now can he assume himself as holder in due course? No. So honestly, innocent is not sufficient. You should act as a man of ordinary prudent. Whether negligently or not. Negligence is not a question mark, but the point is, if you are a careless person, if you are a reckless person, in that case, you won't get this good faith concept. Good faith concept is not applicable to you. So that is the point, The last line I told you, the honest purchase made carelessly without making proper inquiries can't be said to have been made in good faith so as to convey good title. Next one, government. Government includes central government and state government. Government securities. So some of the definitions are not that much relevant, and you can get them by simply reading them. So I'm not explaining all the definitions, Immovable property, very important definition. Immovable property shall include, so we are not defining the immovable property, we are just giving the list of items covered under immovable property. So immovable property shall include land, benefits to arise out of land, things attached to the earth, permanently fastened to anything attached to the earth. Now land is an immovable property. Benefits arising out of the land, trees, soil, mountains, stones, next fruits, flowers. Until you separate them from land, they also come under immovable property only. Sir, fruit is also immovable property. Yes, but when you separate it from tree, it becomes movable property. Until you separate them, so standing crops, everything, they will come under the meaning of they will come under the benefits that are arising out of the land. So immovable property. Things attached to the earth, like building, and permanently fastened anything to the earth, like windows, doors, lights, fans. Once you fix it to the earth, or things attached to the earth, that's it, they also comes under the definition of immovable property. But two things you need to remember. One is, timber is not an immovable property, as it is not attached to the land. Now we are cutting the trees, we are converting the wood into the timber. Timber is nothing but a wood, which is which we separated it from land, so it is not at all an immovable property. And right to drain of water is also not an immovable property. Remember these 2 points, very very important. So machinery fixed to the soil, it will also become immovable property. Now while fixing machinery, we use it screws, screw nuts. So yes, all these are movable property, but once you fix them, once you fix to the machines, and once you fix that machinery to the land, it becomes immovable property. Next, imprisonment. Under Companies Act also we are having a word imprisonment. If any director is committing a fraud, then he will be sent to the jail, minimum period of 6 months, maximum period of 10 years. So now what is meant by imprisonment? So imprisonment, simply we are not having a definition under Companies Act, but here, under General Laws Act, imprisonment is of two types, either rigorous imprisonment or simple imprisonment. Rigorous imprisonment means, imprisonment with hard labor. So where, you'll see these prisoners will be sent to hilly areas. They need to cut these stones, they need to do a lot of work, they need to exercise their labor, hard labor. Simple imprisonment, just, you'll be sent to a room where you will live in that room for some period, so no need to work at all. So simple imprisonment, it is completely, discretionary powers of the judge of the court. He will decide whether the imprisonment should be rigorous or simple. Next one, month, it's a British calendar month. Mobile property, mobile property means property every description excluding immovable property. Okay, so dates, shares, electricity, all comes under immovable, all comes under movable property. Next one. Next one, offense, both, you can read them: official gazette, person, registered, rule, schedule, swear, writing year, all these definitions you can read them. Next one. I'm going to cover only important areas. So general rules of construction. Next point, general rules of construction, coming into operation of enactment, section 4. Section 5, sorry, section 5. Just see the point. So a date from, when they're said to be in force, from when or from which date onwards they're coming into the force. That is all about section 5 ma. So date of commencement, simply date of commencement. If date is specified in the act, yes, specified, then from specified date onwards, the act comes into the force. Now Companies Act, a Negotiable Instruments Act, for example, Negotiable Instruments Act came into force on notified date, that is 1st March 1882. If the date is not specified, no specified date, so the act is not having any specified date ma. In that case, the date when it received the consent, date of assent of President of India in case of post constitutional laws, post constitution, and in case of pre constitutional laws, Governor General in Council, pre constitution. So when this act received the consent of president, when this act received the consent of Governor General, from that date onwards, this act will be in force. And the time is, midnight of the day. Suppose if you take GST Act, the specified date is 1st July 2017, and I'm having the knowledge of the day. So on the day, when time strikes 12, exactly when the time is 12 o'clock, from that date, from that time onwards, sellers started issuing GST bills to their customers. Understood? Next one. And one more point, ma. All acts will have all acts are applicable prospectively, so there is no retrospectivity effect. But if any act, if any provision, if government want to apply them, retrospectively, then it should be provided expressly. There is an example, ma. Companies Amendment Act 2019. You just open Companies Amendment Act 2019. Some of the provisions of Companies Amendment Act 2019 are in force with effect from 2nd November 2018. So for suppose, charges, commencement of business, section 10A, registration, due date for registration of the charges, all these are in force with effect from 2nd November 2018. But this Companies Act 2013, this Companies Amendment Act 2019 came into the picture on 31st July 2019 actually. But certain provisions are having retrospective effect. They were expressly provided, ma. They were expressly provided. Next one, section 6, very, very important and very confusion area, very confused area. Repeal. Repeal means revoke or cancel or annulment or obliteration of the statute. So simply repeal is nothing but a removal of the statute, permanent removal of the act. So a statute ceases to be operative for all purposes on repeal. So the word repeal is different, change is different, deletion is different. Amendment simply something modification to the statute. Repeal means complete removal of the statute. Deletion means the effect of repeal is different, the effect of deletion is different. Suppose if particular provision is deleted, that means the provision is in existence up to this date, and from that date onwards the provision is not there. Okay, that means you can see the provision, existence of the provision. But coming to the repeal, so once you repeal any statute or any provision in the Indian history, you can't find that word or you can't see that provisions at all. Simply the provisions are no more. In fact, that law doesn't exist even from beginning onwards. Now you can see Companies Act 1913 is there. It got repealed and it was reenacted in the year 1956. Indian Companies Act 1956. So the moment Indian Companies Act 1956 came into the picture, 1913 Act, it stopped its operations. The provisions with respect to 1913 Companies Act 1913 is no more effective. And moreover, 1913 Act doesn't exist at all. And we need to see the effect of the repeal. The repeal shall not revive anything not enforced, shall not affect the previous operation of enactment so repealed or anything duly done or suffered thereunder. Suppose 1913 Act, Companies Act 1913 is there. Companies Act 1956 came into the picture. So Companies Act 1913 was repealed and 1956 Act came into the picture. Now 1956 Act also got repealed. Companies Act 2013 came into picture. Now the moment 1956 Companies Act got repealed, don't think that Companies Act 1913 will survive. So it will not revive anything which was not enforced, not prevailing during that period. When 1956 Companies Act came into the picture, Companies Act 1913 will stop its operation. Now the moment if you repeal 1956 Act, don't think that old acts will prevail. And the repeal shall not affect any right, privilege, obligation, liability acquired or accrued or incurred under any enactment so repeal. Suppose in the year 2010, Mr. V was appointed as a managing director of a C Limited company. I'm appointed as a managing director of C Limited with a remuneration of monthly 2 lakhs, and I'm having some powers and I'm having some duties. Now in the year 2013 what happened? 1956 Companies Act got repealed. Companies Act 1956 got repealed. Do you think repeal of 1956 Companies Act, do you think all my rights as a director, all my powers and my remuneration, my position, managing director position, do you think all will come to an end? No. The rights, privileges, obligations which you are having under repealed act shall continue. There will be no effect on the ongoing rights, privileges. Next one, repeal shall not affect any penalty, forfeiture, punishment incurred in respect of any offense committed against any enactment so repealed. Suppose under Companies Act 1956 I committed some mistakes, I violated my duties. I manipulated shareholder funds. I enjoyed with shareholder funds. As a result, under 1956 Act, under Companies Act 1956, I got some penalties. I was sent to the jail. I was sent to the jail for 10 years in the year 2010. Suddenly, after 3 years, what happened? 1956 Act, 1956 Companies Act got repealed. Now, do you think after completion of 3 years, do you think will I come out and can I claim all the penalties which I paid under repealed act? No. Balance tenure, balance 7 years of imprisonment. Yes, I should enjoy. I should bear that balance period also. and whatever the penalties levied on me, whatever fines levied on me, I should pay. There is no effect on ongoing operations. And repeal shall not affect any inquiry, litigation, remedy with regard to such claim, privilege, debt, responsibility, or any inquiry, litigation, or remedy may be initiated, continued, and insisted. Suppose if you see Sahara Group of Industries, they committed a fraud with respect to deposits, public deposits in the year 2010. And legal proceedings were initiated. The legal proceedings are going on, inquiries going on, litigations, cases were filing on. But suddenly, 1956 Companies Act got repealed. Do you think that company is free from all litigations, free from all inquiries? No. Ongoing legal proceedings will not stop. The effect of repeal is not going to affect them. You are getting my point. So ongoing things will continue. Clear? So this is the effect of repeal, ma. And section 6a, a repeal of act, making textual amendment in act or regulation. See, where any central act or regulation made after commencement of this General Clauses Act, 1897, repeals any enactment, then such repeal, unless a different intention appears, the repeal shall not affect the continuance of any amendment made by the enactment so repealed and in operation of the time of such repeal. That means, any provision got amended. For example, in Companies Act 2013, section 185, particularly section 185 got amended in the year 2015. So section 185 was amended in the year 2015. Later, in 2019, I think, what happened, sir? Entire section 185 was repealed and reenactment of new section 185 was done, ma. So what happened, sir? So once, amendment came to section 185, later the old provision got amended. Sorry, the old provision got repealed, and in that place, new provision was reenacted. Now the point is, if there is no different intention, if there is no express provision, then what happens, due to the reenactment of the repealed provision, the ongoing amendments, the ongoing textual amendments will not get affected. So there is no effect on the amendments portion. That's what, section 6a objective. Understood? So in the year 2017, this section 185 was repealed and, new provision was inserted. So section 185, loans to the directors. Initially in the year 2015, yes, the lawmaker granted exemption to private companies. In 2017, unless a different intention appears, the amendment with respect to repealed act will continue in existence. It will be in existence only. So that is what section 6a. Next one, section 7, revival of repealed enactments. Sir, what if Companies Act 2013 was not reenacted? And suddenly, government of India, in parliament and president, they repealed Indian Companies Act 1956. Later, they came to know that some of the provisions should be in existence only. So, present situation requires those provisions. In that case, what parliament or president can do? So they can bring back the repealed provisions. Yes, by making an express notification, they can bring back the repealed portions. But for doing that, they need to disclose the reason. What purpose? What is the purpose? Why they are bringing back the repealed provisions? They should state the purpose. Next one, consequences of references to the repeal. So where this act or any central act or regulation made after commencement of this act repeals and reenacts with or without modification any provision of former enactment, then any references to the provision so repealed in any other enactment or in instrument shall be construed as reference to the provision so reenacted. Suppose section 25 of Companies Act 1956 is a company with charitable objects. Company with charitable objects. In Income Tax Act, companies, certain trust or companies which accept donations from the public. The public, whoever deposit money with this kind of entities, they can claim deduction under Chapter 6A deductions like that. The provision is there. Now, in Income Tax Act, if there is a reference with, if there is any point with reference, giving reference of section 25 of Companies Act 1956, And suddenly 1956 Companies Act got repealed, and in that place, we got Companies Act 2013, and the similar provision was there under Section 8. Now the point is, other acts which are having old act references. Now this old act got repealed, new act came into the picture. Now, while studying these other acts, you should not give reference to the repealed acts. You should give reference to the newly enacted acts. That's what, the simple example, MAT calculations, 115 JB. Under Income Tax Act, just go through it, MAT calculations, minimum alternate tax calculations. There you'll find the word Companies Act 1956. But Companies Act 1956 already repealed. Now, you should take interpretation like this. You should not refer to 1956 Companies Act. You should refer it to the Companies Act 2013. That's what, Section 8. Next one, Section 9, commencement and termination of time. Commencement and termination of time. Only two things here we need to discuss. One is from, the next one is to. So from date you need to exclude. To date you need to include. Understood? From you need to exclude, to you need to include. Suppose under Section 48 of the Companies Act 2013, where there is any variation to the certain class of shares, variation of rights of class holders, certain class holders, or the aggrieved party, or simply the shareholders who casted vote against to the resolution, simply dissenting shareholders, they can file an appeal in NCLT within 21 days. Within 21 days. Now this resolution was passed on 1st April 2023. Now while calculating 21 days, 1st April 2023, at 21 days you'll get 22 April 2023. So now here just observe, from date, that is starting date 1st April, we are excluding the date from counting. We're excluding the date, and we are including 22nd April. So from date should be excluded, to date should be included. Even while calculating time limit for payment of dividends, even you calculate the commencement of general meeting within 6 months from date of closure of financial year, from date should be excluded, to date should be included. So that is section number 9 section number 9. And next one, section 10. So once again I'm telling you, all practical questions, all examples, very very important. You need to study them. There is no alternative. You can, don't expect direct theory questions, ma. Only examples will be asked in the form of practical questions. Next, computation of time. Computation of time, where an act provides that an action or proceeding is taken in any court or office within a prescribed period, and the last date of the prescribed period, if court is closed, then last date of the prescribed period is, the proceeding can be taken on the next day when court or office is open. Continuing the previous example, I told you under Section 48 of Companies Act 2013, the dissenting shareholders can take an action, can file an appeal with NCLT. What is the time period, ma? 21 days. So taking a previous example, the date, 1st April resolution date. Add 21 days. You'll get 22nd April 2020, 22nd April 2023. Suppose, 22nd April 2023, because of, COVID 4th wave or 5th wave, whatever it might be, pandemic, all the courts, offices, NCLT, all were shut down, all were in shutdown mode. Now, what is the remedy, sir? Don't worry. The next day, when the court opens, or when the office opens, or when the NCLT gets open, you can go and you can file appeal. But to this general rule, we had an exception. That exception is, time bar debt. Indian Limitation Act. So the last day, if it is a last day, if it is not a working day, then you need to file an appeal before day. Before means preceding business day. Limitation Act, it is an exception. Next one, Section 11, measurement of the distance. Suppose I'm at Jubilee Hills, Hyderabad. I need to travel to Chennai. Now when you want to calculate the distance between these 2 points, you should not take road map. So suppose road is like this, so you should not calculate distance in this mode. You should calculate distance horizontal line. This definition is very much required when you look into the when you look into the chapter capital gains of Income Tax Act. In Income Tax Act, we had a concept of uh, urban rural classification, urban lands, rural agriculture lands. From municipality, if the population is this much, up to 2 kilometers, up to 6 kilometers, up to 8 kilometers, like this, you had a distance concept: 2 kilometers, 6 kilometers, 8 kilometers. Now how we should calculate the distance, how we need to measure distance, sir. So road wise, sir, suppose like this road is like this, sir. Now can I take this complete measurement? No, 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 no. From this point onwards, this point, you should not measure distance like this. You should measure distance in this manner: horizontal or straight line. So that is section 11. Next, section 12, duty to be taken pro rata in enactment, section 12. So pro rata, proportionate basis. While you're importing some goods, you need to pay custom duty. Suppose if you are importing 100 goods, then you need to pay a custom duty of 2100. This is the rule, ma. One time, you imported only 50 goods. Now, proportionately, that means, you need to pay 1050 only. 1050 rupees is sufficient. Paying 1050 rupees is sufficient. No, sir, 150 goods, sir. In that case, okay, 3150. So, pro rata, proportionate to the, the main rule. If you're importing less quantity or, greater quantity, then you need to pay duty on proportionate basis. That is section number 12. Understood? Next one, section 13, gender and number. So gender, he includes the she. So simply, male includes female, and singular includes plural. General rule in any act, ma. Suppose if you see that he is liable for imprisonment, or he will get this reward in that particular area. Don't interpret it as just he only. He includes she. He includes she. His father and mother covers her father and her mother. Understood? So he includes a she, and singular always includes a plural. So officer in default is subjected to imprisonment of 2 years, like that a point is there. Suppose in a company, 2 directors made a fraud. Now when you look into the provision officer in default, there is a word just officer in default. So it is a singular form only, no sir. So you can't punish 2 of us. You just punish 1 of us only. So select the person and give punishment to that person. It's not like that. Singular includes plural. Of course, if controversy is there, suppose we had a case study, male descents. One case study is there, in under Chota Nagpur Tenancy Act, the word male descents was used. So here you can't include it a female descents. When a particular gender is specified, that particular gender you need to follow. For example, under contract of in contract of agency, we had a concept: wife is an agent to husband. Wife is an agent to husband. No, you can't write reverse. Husband is an agent to wife. No, he includes she includes he, like that. Wife is an agent to husband. That's it. You should not interpret like this. Husband is an agent to wife. It is not correct interpretation. Understood? And previous year, under Income Tax Act, we had a concept called previous year. That point you should interpret it as previous year only. So it won't come under previous years. So previous year in Companies Act will not mean previous years, only single year. So general forms, general cases, he includes she, singular includes plural. Next, last but one aspect of the General Clause Act, powers and functionaries. Section 14. Powers conferred to be exercised from time to time. So if any power is conferred, if any power is given to any authority to do a particular act, such power can be exercised from time to time as occasion requires, unless different intention appears. Unless different intention appears. Suppose if you look the example of change of name. Change of name. In section 12 of Companies Act, for changing the name, application should be filed with central government. However, under rules, central government delegated that power to ROC. Now, who will exercise that power? ROC will exercise that power on behalf of central government. Now, central government delegated the authority to ROC. At any point of time, central government can take back the authority from ROC. So that is the point, ma. Any power delegated, they can exercise those powers from time to time. Next one, section 15, power to appoint to include power to appoint ex officio. Ex officio means, it's a Latin word, by virtue of one's position or office. It's a Latin word, first of all. So ex officio means many of people thinking that, ex office, past office, previous office. It's not like that. I'll give you example. Today, if you take Rajya Sabha, who is the chairman of the Rajya Sabha? Don't tell me the name. Chairman of the Rajya Sabha is, Mr. Vice President of India. So now if you get the post of Vice President of India, you will automatically become chairman of the Rajya Sabha. Understood? And take an example of IEPF, section 125, Investor Education Protection Fund. So Investor Education Protection Fund is having a committee, that committee is headed by chairman. One of the rule is, who is the chairman of IEPF? He is nothing but secretary of Ministry of Corporate Affairs. Now, power to appoint Secretary of Ministry of Corporate Affairs, it includes power to appoint chairman. Now, just listen carefully. Who is the chairman of IEPF, sir? So the Secretary of MCA will automatically become chairman of the IEPF. Secretary of MCA will automatically become chairman of the IEPF. So now this person will be named with a name, he will be called with name, or automatically we call him as the Secretary of MCA. So because of his designation of Secretary of MCA, now he is becoming a member of the chairman. Now power to appoint chairman of IEPF, it includes power to appoint the ex officio. Understood, ma? Everyone. Appointment of person to fill any office or execute any function. Appointment may be made either by name or by virtue of his office. Suppose suddenly, central government modified the norms and they told that Mr. A will take the position of IEPF chairman. That's it. Okay, he will be the chairman of IEPF. Or central government may give a notification like this: Secretary of MCA will be the chairman of the IEPF. Now, whoever sitting in the position of Secretary of MCA, they will become chairman of the IEPF. So, power to appoint includes power to appoint ex officio. Next one, power to appoint to include power to suspend, dismiss. Yes, ma'am. So, to shorten the length of the act, we simply write to power to appoint. That doesn't mean that, you had no power to suspend, you had no power to dismiss. So, power to appoint includes power to suspend, power to dismiss. Unless different intention appears, power to appoint includes power to suspend you and power to dismiss you. Next one, substitution of functionaries. Section 17. Substitution of functionaries. See, a natural person will not have a perpetual succession concept, right? Natural person at one point of time he will die. At one point of time he will die. Exactly, yes or no? So that's why if you look into the word, managing director of the company or ROC, registrar of companies. So in Companies Act, you will find the word like this, responsibility of maintenance of books of accounts lies with, managing director, CFO, whole team director, finance, company secretary, like that, you will find words. So you may ask me, sir, why can't we write the names? Why can't we write the names? Because, the people may die at one point of time. Again, changing the provisions, it's not possible, right? And moreover, India is having, some 23. In our country, we are having approximately 23 ROCs are there. So instead of writing all the names, simply, you just write the title of the people. So simply ROC, Registrar of Companies, Regional Director. Now, whoever take the position will have all those powers and duties which was specified in the Companies Act 2013. So it is sufficient. Simply, give the functionary title. That's it. No need to write the name of the person. Now, today I'm the ROC. Now I'm having powers and duties. So by the end of the day, I resigned from the job. Next day, some other person was appointed as ROC. Now, same powers, same duties which I'm having shall be shifted to that person. So instead of writing the names, simply give the functions name, name of the functionaries. Simply. Next one, successors. Section 18. Successors, predecessors. Successors, predecessors. Successor means simply, the next person. Predecessor, a left person. Outgoing person, simply. Successor, incoming. Predecessor, outgoing. So as I already told you, company is having a perpetual succession. Body corporate is having a perpetual succession. Corporations are having perpetual succession. But not natural persons. The persons managing these artificial persons, they won't have any perpetual succession concept. At one point of time, they may resign or they may die. They may get deceased. Now, whoever comes into the position, they are required to carry out the same duties, same obligations, and same rights. Understood? Next one, official chiefs and subordinates. Official chiefs and subordinates. You can see here, chairman of the company, managing director of the company. They will have, superior powers compared to all other directors. But in the absence of the chairman of the company or, managing director, their subordinates, the vice chairman or, other, other directors will get the power to sign the documents. So powers vested with the chief or superior persons, if they are absent for a long period, then the subordinates, that means persons next to that level, will get the power to execute superior duties. Understood? So chief or superior of an office shall be equally applicable to the deputy subordinates who is performing the duties of that office in the place of superior. Next one, section 20, construction of orders, etc. under enactments. You can see, ma'am, Companies Act was enacted in the year 2013. And later, in 2015, 2017, 2019, Amendments Act came. Companies Amendment Act 2015, Companies Amendment Act 2017, Companies Amendment Act 2019 is there. And recently we are having Companies Amendment Act 2022. Now in these amendment acts, amendment acts are circulars or notifications. If you read them, we can't find the definition to the word company. We can't find the definition to the private company. Now in that case, what we should do, sir? Very simple. Take the original act. If the word is defined in original act, you'll get same meaning in amendment act also. Suppose if you take a Companies Amendment Act 2015, there you can't find the word company definition. You can't define. There is no definition to the company under Companies Amendment Act 2015. In that case, the word which was defined under Companies Act 2013 shall have same effect. So the expression which is used in notification, order, scheme, rules or forms shall have same respective meanings as in act or regulation, unless contrary is expressed. Understood? Next one, power to issue to include power to add, amend, vary, rescind notifications, orders, rules and bylaws. Yes. So government is having a power to issue notifications, rules, bylaws. The same power also includes, power to change the rules, amend the rules, power to cancel the rules. That's what, today Parliament is having power to enact the laws, and Parliament is also having power to repeal the acts. That's what, repeal is happening. Next one, making of rules or bylaws and issuing orders between passing and commencement of the enactment. Yeah, this thing you need to listen carefully, ma. Suppose, Companies Act was introduced in the year 2013. Companies Act 2013 was they came. Companies Act came into the picture in the year 2013. But the problem is certain provisions with respect to NFRA, they were notified subsequent to the enactment of Act. Originally, they were not part of the Companies Act, or they are part of the Companies Act only, but the date of commencement it's like 2016, 2018. Certain provisions came in the year 2016, 2018. Simply, the point is entire Companies Act 2013 didn't came into the picture on single day. The Companies Act was implemented in a phased manner. Few provisions got notified on 12th September 2013, and 188 provisions were notified on 1st April 2014. Now the point is between these time limits, any laws, any rules, any regulations were notified. All these rules and regulations which were notified with respect to future provision will come into force from the future date only, not from a retrospective date. You're getting my point? Suppose NCLT was notified in the year 2016. In December 2016, NCLT got notified. Now the point is, rules, bylaws, orders issued before December 2016, but after 2013, all these rules, bylaws, orders will come into force with effect from December 2016 only. The simply notification date is not important, commencement date is important. Next one, section 23 ma, this is previous publications. Explain various provisions applicable to the rules, bylaws being made after previous publications as enumerated. So you all know the law making procedure. Initially, the parliament, the person, minister or a member of the parliament will read a draft bill, will read a bill, it's a draft. So actually draft will be published, and it will be circulated among the persons who got who are having interest in that particular area, particular aspect. Suppose we want to repeal 2013 act, we want to introduce new companies act, new companies act 2023, for example. I'm telling you, for example. Now the point is, this is going to affect all the companies. Now we'll circulate this document among all the companies. We'll ask them, if you have any objection, come on, raise your objections. Now the government will look after all those recommendations from the affected persons. So government of India is having a freedom whether to consider them or reject them. So after considering them or rejecting the proposals, they will finalize the bill and they will approve the bill. Once the bill is approved, it will be sent to the President of India for his consent. Once President gives approval, it becomes act. Now once again, publication will happen. So this publication we need to follow. And with respect to the draft bill, which was already published, we call it as previous publications. So previous publications will not have any effect. There is no mandatory obligation on you to follow them. It's just a recommendatory, and moreover, you can express your opinion on it. So government of India is going to consider them or going to object them. But the ultimate point is once it receives the assent from the President of India, it will be notified in the official gazette. Now that publication you need to follow. The publication in official gazette, it's a conclusive proof. Yes, the previous procedures have been followed correctly, and this publication, it will be applicable. Previous publications, no need to worry about it. So making a draft, the next one publishing the draft given to the affected persons, and interested persons will make objections, and government of India may incorporate or consider the suggestions, and finally they will publish the final copy in the official gazette. That is all about section 23. The next one, continuation of orders etc. issued under the enactments repealed and reenacted. So continuation of the orders issued under enactments repealed and reenacted. If any statute is repealed or reenacted, the same or substantially same terms. Just look at the point, ma. In case any central act or regulation is repealed and reenacted with or without modification, any appointment, notification, order, scheme, rule, form or bylaw made or issued under repealed act continue to be in force. They will be in force. For example, in Companies Act 2013, when Companies Act 2013 came into the picture, we had a concept of national NFRA, National Financial Reporting Authority, and NCLT, but these were not at all notified yet. When Companies Act 2013 got notified in the year 2013, these concepts are there, but are they an implementations phase? No. NCLT, it came in the year 2016. And if you take NFRA, so very recently it was introduced. But the point is, until NFRA or NCLT gets constituted, no need to worry. In the place of NCLT, Company Law Board. In the place of NFRA, National Advisory Committee on Accounting Standards, they will continue their operations. They will have the same powers under the repealed acts. Sir, old act got repealed, no sir. So this will come to an end, no sir. Correct. But new act is silent with respect to NFRA, new act is silent with respect to NCLT. That's why until the new committees, until the new new things comes into the picture, the old things shall be continued. They are continued to be in force. Understood, ma? Next one, a recovery of fines. In Companies Act, you can see recovery of fines. So fine, For every violation, you can see there is a fine. But how we are going to recover them? So Companies Act is silent. Now come to the general clauses act. So how recovery happens? Just follow section 63 to section 70 of Indian Penal Code. There you'll find how the penalties or how the fines will be recovered. In the same manner, the fines under Companies Act will also be recovered. Next one, provision as to the offense punishable under two or more enactments. Suppose I'm the chartered accountant. Now I'm holding certificate of practice. I did a default while doing an audit. I did a default. I was very negligent. I gave a wrong opinion on the financial statements. Now I made a mistake under Companies Act, and being a member of Institute of Chartered Accountants of India, I need to comply Chartered Accountants Act 1949. There also I made a mistake. Now I made a mistake under two acts: Chartered Accountants Act 1949, Companies Act 2013. So FIR will definitely be filed against me regarding I committed offenses under two acts. So they will write all the points. So yes, violation of Companies Act, violation of Chartered Accountants Act, everything they will write. And two acts are giving punishments, ma. Oh, am I liable to bear two punishments? No, not at all. So judge will give you one punishment. Only one punishment is applicable. See, at the time of filing FIR, okay, whatever violations you did, whatever offenses you committed under respect to acts, all those will form part of FIR. But the ultimate punishment, you'll get only under one act. Suppose one act told me 10 years imprisonment, other act told me 10 years imprisonment. Do you think I should bear, I should be imprisoned for 20 years? No, either of these act punishment will be applied. So I'm not going to get punishment twice for the same offense. I'll be punished only once. But if I commit two or more offenses which are covered under two or more acts, then separate punishment will be applicable. Same offense covered under two statutes, then only one punishment I am going to get. Sir, I committed two offenses. They are covered under two statutes separately. Now the point is, will I get punishment under two acts separately? The answer is yes. Next one, meaning of service by the post. It's simply service by post. It's not service by registered post acknowledgement due. Register service by post. So here you will find two parties: sender, receiver. So sender, so if he is required to serve any document by post, then if he satisfy these three conditions, properly addressing, prepaying the stamps, posting by registered post, that's it. He is said to be, the notice is deemed to be served. It is immaterial whether receiver took the notice or whether receiver rejected the notice. It is irrelevant. Sender, while satisfying these three conditions, if he send any document by post, that's it. The duty on the sender comes to an end. But some provisions you will find, registered post acknowledgement due. In that case, sender should send notice only through under registered post acknowledgement due only. For that acknowledgement, receiver will pay the amount. The point is, if nothing is specified, just you need to serve documents by post, then your duty comes to an end by properly addressing, by prepaying, by registered post. That's it. The receiver is not there, so that's why he didn't receive the notice, or receiver rejected the notice, that's why he didn't receive the notice, sir. All these are immaterial. Whether sender duty fulfilled or not, it is not in the hands of receiver, it is in the hands of sender only. So sender can fulfill his obligation by performing these three duties. Next one, so almost completed. Ma last point, citation of enactments. Simply references. You can give direct reference. You can tell that Companies Act 2013, like that you can directly give reference, or you can give reference like this, 18 of 2013, act number 18 of 2013. What it means? It is nothing but Companies Act. Or suppose section 2 clause 68, you can directly tell private company, or you can indirectly you can quote the section numbers. You can directly tell about a company, or you can give a reference of section 2 clause 20. So citation of enactment, simply giving the references. Provision can be quoted by reference. Understood, ma? Whatever the effects, whatever the powers an act is having, the same powers ordinance is also having. But the point, act is approved by both parliament as well as president. But coming to the ordinance, even without getting parliament approval, you can take president approval. President approval. So, but this ordinance will have a validity period. General validity period is the general validity period of ordinance is 6 months from the commencement or 6 weeks from the commencement of parliament sessions, whichever is earlier. So generally ordinance is having a limited period validity, whereas act will have an unlimited validity period. But both, ordinance and act will have same effect. Is it clear? So with this, general clauses act I completed. The next topic of marathon is interpretation of statutes, which is having a weightage of 6 to 8 marks, including multiple choice questions. So in this marathon, we are going to cover rules of interpretation and aids to interpretation. I'm telling you one more time, this is a marathon class. This is not a detailed regular class, right? So I'm going to cover only important areas. So interpretation of statute, this chapter gained importance. Why? Because in our Indian constitution, we are having three departments or three wings: a legislative, executive, judiciary. The role of legislative is, law. It is a lawmaking body. So all the laws today we are having, it is prepared by or it is framed by a legislative wing. And executive wing will implement the laws framed by legislative from time to time. So during implementation phase, if any provision, if there is any ambiguity in implementation of a particular provision, that ambiguity will be eliminated by the judiciary. So legislative is a law making body, judiciary is a law interpretator body. Now, law is made by one person and it will be read and interpreted by other person. So now the basic objective of this chapter is to bringing the minds of both, lawmaker and law reader. So meeting the minds of lawmaker and law reader. So when you look into the chapter name, interpretation of statutes, interpretation is nothing but understanding. Statute, it is nothing but law. So it's a written will of legislature. The statute has been defined as a written will of the legislature. So this chapter aims at understanding various laws. Are you all getting my point, students? So here, laws are of two types, central acts, state acts. Central acts, Parliament of India and President of India will give consent to the central act. Coming to the state acts, state government, it's not state government, legislative assembly, legislative council and governor will give consent to the bill. Now they become state acts. Is it clear, my dear students? Now, famous persons. Definition of the document I already explained in General Clauses Act chapter. Please refer to that. So matter, record, substance means everything I covered. One famous person, Mr. Jolovis, he gave a definition to the interpretation. So he classified interpretation into two branches, legal, doctrinal. Again, he classified, legal branch into two sub branches, authentic, usual. So what he is trying to tell, authentic, whatever there in the law, read it and follow it. Don't go beyond the law. Whatever, provision you find in this section, just read it and implement it. Next one, usual. If law is not giving you, if law is not clear, or if a particular word used in the provision is not defined, then, you just come to the usual branch. So check whether, what is there in the customs, what is there in the trade practices, which practice is prevalent with respect to that area, or is there any judiciary case studies. So follow those case studies or follow the practices. It's what usual. So coming to the doctrinal branch, it is divided into two sub branches: grammatical, logical. Grammatical, you should interpret and or as or. So end, conjunctive or disjunctive. Just next one, shall. Shall means, it's a mandatory provision. Whereas coming to may, it's a enabling provision, directory provision. It's just optional. So grammatical interpretation. And next one, logical interpretation. Logical interpretation. So sometimes, a provision may give you two interpretations. One may be lawful, one may be unlawful. Now find out the logic why the provision was written like that. So using the logic, come to the correct interpretation. So that's what, classification done by Mr. Jolovis, but this is incomplete. So many of the people are opposing Jolovis. Is it clear? So finally, we are having, we classified rules of interpretation into two types: primary, secondary. When primary rules of interpretation are giving you solution, then follow primary rules of interpretation. If primary rules of interpretation are not providing the solution, then go with secondary rules. Is it clear, ma? So primary rules of interpretation begins with first one, rule of literal or grammatical interpretation. But before I discuss rule of literal interpretation, we are having a difference between interpretation and construction. Both are different, ma. Practically, we use these two terms, in terms of similarity. So we may use interpretation or we may use construction, but both are different. How? Interpretation is simply understanding. Whatever you are reading it, whatever you understand, it's nothing but interpretation. But construction is different from interpretation. So where interpretation does not work, we will come to the construction. Suppose if you take Income Tax Act, when you read chapter 6A deductions, so whatever you understand, it's an interpretation. And suddenly a client approached you with respect to, he made a medical insurance payment of some 30,000 rupees. He is not a senior citizen, he is having an age of just 30 years. Now he comes to you, he approached you and he is asking you, sir, I paid 30,000 rupees medical insurance premium. Am I allowed to claim entire 30,000 rupees deduction? Now, when you read this statute, the restriction, there is a restriction of 25,000 rupees only. You can claim deduction up to 25,000 rupees, but that person, he made investment of 30,000. He made insurance premium payment of, he made a payment of insurance premium, sorry. He paid insurance premium of 30,000. Now, will he get 100% deduction or not? So now, whatever you understand, chapter 6 deductions, simply applying these provisions to the particular situation, drawing the conclusion, and coming to the conclusion, it is nothing but construction. So when interpretation does not work, what we will do? We'll simply apply the provisions what you read in the practical situation, and you will derive the conclusions and you will come to the opinion. So this is entire process is nothing but construction. This entire process is nothing but construction. Next one, rules of literal interpretation. I'll start with primary rules. First one, rule of literal interpretation. Now this is a primary rule of interpretation. First and foremost, you need to apply this rule. Sir, when can I apply this rule? When the words used in the statute are clear, when the language used is plain, clear and unambiguous. So sir, there is no ambiguity. It is very clear, sir. Now follow whatever you read in this statute. Follow whatever you read in this statute. For example, agreement in restraint of marriage is void. A simple line. It is not having any exceptions. Whatever you read, just follow it. Next, company means company incorporated under Companies Act 2013 or previous company law. Now, the definition is very clear. So whatever you read, just implement it. Are you all getting my point, students? So when the words used in the statute are clear, you just follow the rule of literal interpretation. No, sir. Words used in the statute are not clear. Some ambiguity is there. Then don't apply this rule. Apply some other rules. I'll tell you which rule is suitable to the situation. I will definitely explain you. So first, follow the grammar rules. First, follow the grammar rules. First follow the definitions given under respective acts. If there is no definition to that word, then apply General Clauses Act. If there is no definition in the General Clauses Act, then follow dictionary meaning. So simply give importance to the natural and grammatical meanings, exact meaning, whatever you are getting. And sometimes technical meanings. I'll tell you one example. Word chip. So chip is having two meanings. One is a snacks chips, potato chips. The other one is chips from IT point of view, information technology point of view. Chips means smart cards. Depending upon the situation, the word will derive its meaning. So first apply grammatical meanings or technical meanings. If these words are clear, unambiguous, then rule of literal interpretation is suitable. And you need to remember these Latin Latin words, and you need to reproduce those words in examination. You're getting my point? For suppose absoluta senatia expositor non indigent. If plain words are capable of giving only one interpretation, no further explanation required. Understood? So you need to quote these kind of sentences, then only you'll get better marks. Next one, suppose if the words used in the statute are not clear, some vagueness is there, ambiguity is there, inconsistency is there. I'll tell you a small example. An agreement with minor is void. An agreement with minor is void. But there is one more provision, a contract for the benefit of minor is valid. Sir, now there is an inconsistency, sir. There is ambiguity. Which thing I should follow? So now here don't apply literal interpretation. Why? Because if you are applying literal interpretation, the interpretation is giving not correct meaning. So agreement with minor is void, correct? Agreement in restraint, next one, agreement, contract for the benefit of minor is valid. So which thing I should apply? Literal interpretation. If I apply literal interpretation in this case, it is giving different meanings. Now come to the logical interpretation, a reasonable construction. So depending upon the situation, depending on the facts of the case, you need to take one provision. You need to apply that provision. Not only minor but also if you take another example, a case study was quoted in the material, that is, any person cast some other person vote in the elections, he will be sent to jail, he will be punished. That means fake voting should be prohibited. Now one person, he came to election poll, election booth, and he casted the vote of another person, but that another person is not in existence, that another person already died. Now the point is, when election commission, EC people, trace this person, and when they arrested this person is making a statement like this: sir, if I cast some other vote, I'll be punished. But I'm casting the vote, and casting the vote of a person who is not in existence, sir, so I should not be punished. So here, the law is not clear, the law is incomplete. The law is incomplete with respect to deceased persons. So if someone casts the vote of deceased person, they should also be punished. This point is not there in law. So that means law is incomplete. Now don't apply rule of literal interpretation. Come to reasonable construction. Understood, ma? So when can I apply rule of reasonable construction? When law is not clear, when there is some incompleteness, when there is some ambiguity, then rule of literal reasonable construction you can apply. So non-applicability, of course, reasonable construction is not applicable when literal interpretation is allowed. Understood? Next one, ma. Next one, rule of harmonious construction. Sir, when we are going to apply rule of harmonious construction? Literal interpretation, when law is clear, literal. When law is not clear, incomplete, inconsistency, then reasonable construction. But coming to harmonious construction, within a statute, there may be inconsistency between two provisions of a same section, or there may be inconsistency between two sections of a same statute, or there may be, conflictory point, conflict. There may be a conflict between two statutes, inconsistency between the two or more sections of different statutes. Just see the point. Inconsistency within a section, inconsistency between two or more sections of a same statute, and inconsistency between two or more sections of different statute. Then you should apply rule of harmonious construction. So here, we can't decide, we can't tell that, this provision should be applied, this provision should not be applied. Here we are not going to tell this point straight away, but we are creating some harmony between these two provisions. I'll tell you example. Issue of shares at discount is void. However, a company can issue sweat equity shares. Negotiable Instruments Act. Promissory note can be bearer or order, but Reserve Bank of India Act, only RBI and Government of India can issue bearer promissory notes. No person other than RBI and Reserve Bank of India can issue bearer promissory notes. That point is there. So when there is a conflict between two provisions of a same statute or same section or different statutes, then you should not apply literal interpretation, you should apply harmonious construction. So we will provide harmony between these two provisions. Sir, how? Very simple. read the law as a whole. In the provision you may find a few words like this: notwithstanding any other law for the time being in force. That means, notwithstanding, if any provision starts with notwithstanding, then this provision should be given a weightage and all other conflicting provisions will remain silent. Notwithstanding. Next one, subject to. There is a word called subject to. Now whenever you find subject to in a provision, that means this provision will lose its weightage when there is a conflict with another provision. So that next provision will override this provision. And when these provisions were enacted, suppose one provision enacted 1 year back, recently one more provision enacted. Now there is inconsistency between former provision and later provision. Then just apply later provision. Sir, notwithstanding word is not there, subject to word is not there, and former later distinction. So former later difference we can't identify. In that case, it's better to amend the law. There is no other solution, simply amend the law. We can't provide harmony to these two conflicting provisions. Understood? So that's what rule of harmonious construction. Next one, rule of beneficial construction, a mischief rule, hidden rule. So simply beneficial construction. The law is not clear. There is some ambiguity. But there is a previous law, sir. Now previous law got repealed and new law got reenacted. Now the point is, when the language used in the statute is capable of more than one interpretation, the most firmly established rule for construction is principle laid down in hidden rule. Just listen me carefully. So the rule, which is also known as purposive construction, mischief rule, enables consideration of 4 matters in construing an act. So what the law before making the act? What was the mischief or defeat for which law did not provide? What is the remedy that act was provided? And what is the reason for remedy? So simply, a reasonable construction versus beneficial rule. Reasonable construction is applicable in all cases, but hidden case or beneficial construction, it is applicable when there is a loophole in existing law. And to cover this loophole, yes, we brought a new act or a new law or a new provision. Understood? So there is a loophole. And to cover this loophole, a new law was enacted. Now, how should we interpret this new law? So that thing was explained by hidden mischief rule or rule of beneficial construction. I'll tell you one small example with respect to director appointment. This concept you'll know only when you read CA final directors chapter, or when you had a knowledge of directors chapter. This you can understand. Of course, we are having a case study with respect to hidden rule. I'll tell you that case study as well as director concept. Generally, a company can have an additional director who will be appointed in board meeting. So this additional director, his tenure will come to an end by the upcoming annual general meeting. So by the upcoming annual general meeting, his tenure will come to an end. So old Companies Act is very silent. Board is having power to appoint additional director, like that they told. But in New Companies Act, they provided one more point. So any person who failed to get appointed in general meeting, in general meeting, is disqualified to act as an additional director. So why this point was written, sir? What is the reason why this point was written? The reason is, suppose a person will make a nomination to become a director in the general meeting. Suppose if members reject him, now he will go to the directors. So please appoint me as a director in this company. I'll pay you some amount. Now what directors will do, with the interest on the money is providing, so they will appoint him as a manager. They will appoint him as a director. Ultimately, members' interest is getting affected. Public interest is getting affected in case of public company. So this should be eliminated. That's why in new law they brought up with a new amendment. They brought up with a new change. That is, any person who got failed to appoint in general meeting, is disqualified to act as an additional director. Now board of directors can't appoint a person who got rejected by members to act as an additional director in the company. And next thing, coming to the case study with respect to hidden rule, there is a law to regarding prohibition on soliciting with respect to sexual affairs. So any person, male or female, should not seduce any person in public areas. So prosecution, simply prostitution should be prohibited. Prostitutes should be prohibited. So no person can seduce the opposite gender person in public places. Like that, there is a provision. So one day, one lady standing in a balcony of her home. So she's in her home only. So standing in balcony. So she's trying to attract some persons for prostitution. So now this, this matter, that person, he filed case on lady. Matter went to the court. The lady is telling that, sir, balcony is my private area. This won't come under public area, sir. So I should not be punished. But when you apply rule of literal interpretation, whatever the lady is telling, it is correct. But ultimately, the purpose of a statute is getting misleading. Yes or no? So this should be avoided. Now, we should bring up a new law. So what was the law before making the act? What was the mischief or defect in the old law? And what remedy was provided in the new law? And what is the reason for such remedy? So these all areas we are going to read under hidden case, under rule of beneficial construction. Next one. Rule of exceptional construction. Here we need to read the words and, or, may, shall, must. So and is a conjunctive. So you need to read both the words, or either of the words. May, it's just enabling provision. Shall, mandatory provision. Now Seema, sometimes we should interpret and as or as and, may as shall as may. So what are the situations? I'll tell you. In Companies Act, we are having penalty sections, right? If you take prospectus chapter, for any misstatement in the prospectus, promoters, directors, proposed directors, and expert are going to get punished under section 447. Like this, there is a provision. Imagine there is a provision. Now, if you look at the provision, proposed director and expert. The word proposed director and expert is there. Suppose, expert is a very good person, ma. He don't know about this fraud. He's a honest person. He's an innocent person. And these proposed directors, the persons who are going to get appointed as a director, these people committed fraud. Now, simply looking at the word and, do you think that all the proposed directors and expert will get punishment? No. In this case, you should interpret and as or. Are you getting my point? Suppose, financial statements, books of accounts. It's the responsibility of, managing director, CFO, whole-time director, finance, to maintain proper books of accounts. If company fails to maintain proper books of accounts, managing director, CFO, and whole-time director finance is going to get punishment under section 128. Like this, provision is there. See, this whole-time director finance is a very good person, innocent person, honest person. He don't know about the irregularities. Now, simply you see, looking at the word and, do you think, innocent person will also get punishment? No, it's not like that. So here and should be interpreted as or. And similar example, suppose, MD, CFO, or whole-time director finance is going to get punishment under section 128. Like this, the provision is there. Imagine. Both CFO and whole-time directors are the persons responsible for such fraud. Now, simply looking at this provision, so do you think that only CFO or only whole-time director are going to get punishment, not both? Is it correct interpretation? No. So in these cases, or should be interpreted as and. So and under exceptional circumstances, and shall be interpreted as or shall be interpreted as and. Similarly, may can be interpreted as shall may be interpreted as may. Are you getting my point, students? Everyone, in your government company audits, audit and auditor chapter also, we had a point that, C and AG, controller and auditor general, He's having a power to appoint auditors to government companies, first thing. And next thing, after completion of the audit, CNDG is also having a power. He's also having a right to call for test audit or to call for supplementary audit. Now, when you see the word shall, CNDG shall conduct a test audit. Do you think that CNDG, it is a mandatory thing that CNDG should conduct a test audit? No, 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 no. So if a shall is attached with a right, then it becomes a may. It depends upon the situation. That's what I'm telling you. Read the section as a whole. May should be interpreted as may. Shall should be interpreted as shall. But under exceptional cases, may will derive meaning from shall and shall will derive the meaning of may. So that's what exceptional construction. Next one, we are having examples. You just go through the examples. Once again, I'm telling you, examples plays crucial role in your examination. Next one, you just them generous. So when there is a combination of words, specific words and general words, specific words and general words. Now, rule of them generous, what it is telling you, the general words will derive color from specific words. Example, a Shrestha for CA and CMA. They're providing classes for a CA, CMA, and etc. They're providing classes for CA, CMA, and etc. Now, this general word, etc. Simply, other courses. For example, other courses like that, we made a statement or we made a publication. So, Shrestha for CA and CMA is providing classes for CA, CMA, and other courses. Now, if you look at this statement, CA, CMA are specific words. Other courses comes under general words. Yes or no? Yes, sir. Now, just I'm asking you, what do you think about other courses? Other courses means, BTech, a civil engineer, doctor. Next, come on, tell me. So, do you think other courses, IIT, do you think other courses means all these things? No, 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 no. Other courses means, courses similar to CSCMA, like, CS, BCom, MCom, MBA, Finance, BBA, etc., CPA, etc. So, when you read a statement, and the statement is having both specific words and general words. Now, general words always derive its color from specific words. Are you getting my point, students? Everyone. But this rule you can't apply when there is no general word. When the list is exhaustive, suppose etc. or other courses, if it is not there, suppose Shrestha for CA and CMA, it is providing classes only for CA and CMA. Now you can't apply them generous. You should apply rule of interpretation, rule of literal interpretation, grammatical interpretation. That's it. So this rule is applicable only when there is a combination of specific words and general words. And I'm telling you, remember the order. Specific comes first, general comes next. Specific comes first, general comes next. So then only rule of them generous is applicable. And we are having one more rule, that is nociter associis. So here, general word comes first, and next you will find specific word. Under rule of them generous, you will find a specific word first, next general word. Whereas here, general word comes first, specific word comes next. Like, plant and machinery. Plant and machinery. Plant and trees. So here, plant is having two meanings. Plant and machinery. Plant and machinery, here plant refers to equipments. Plant and trees, here plants refers to normal, natural plants, environment. Are you getting my point? So looking at the association of words. So what is the word next to this word? Looking at this, you should interpret the word. Are you getting my point, students? So plant and machinery, plant and trees, both are different. So plant and machinery, their plant means equipment. Plant and trees, their plant means, environmental plants. Are you getting my point, students? So that's what, nociter associis. Nociter associis is applicable only when there is a combination of general word and specific word. And there is ambiguity. Are you getting my point? Next point. So with this, we completed primary rules and we started secondary rules. The last rule of secondary rules is contemporanea expositia est optima et fortissima in legi. So here, in order to understand the law, you need to go to the time when the law was made. and what is the purpose, what is the reason the law was enacted. So you need to study the simply historical setting of the law. So for what reason this law was enacted, then only you will arrive at correct conclusion. Is it clear? Simply old laws ma. This rule will apply with respect to old laws, old statutes like Indian Contract Act, Negotiable Instrument Act, General Clauses Act. So all these acts belongs to 19th century. So what is the time period? 19th century. What is the environment during 19th century? Business environment. What is the reason why these provisions were enacted? As of now, majority of the provisions are useless. They are not practically not implemented. So they lost practicability. Now, for knowing the essence of the provision, simply go back to the 19th century and what was the situation at that point of time. Simply study it. Now come to the conclusion. That's what this rule states. So with these rules of interpretation we completed, and next thing we are having aids to the interpretation. Here aids means simply nothing but help. Aids means simply help. So we are taking following things, we are taking the help from following things in order to understand the law, in order to construe the law. So these aids are classified into two types: internal aids, external aids. Internal aids simply, here we are going to take help from the points within the law. So here we are taking the help of factors that were forming part of law. External aids, not internal, simply, outside the law. Let's see internal aids. The following points are covered. Title. Title is a part of the act. Companies Act. That means this act is applicable only to the company. Title. One interpretation. Preamble. Preamble. Negotiable Instruments Act preamble. An act to consolidate and amend laws related to promissory notes, bill of exchange, checks. Means this act is applicable only to the promissory notes, bill of exchange, checks. So preamble explains the scope of the act, areas it cover. Next one, heading and chapters. So in Companies Act we are having total 29 chapters. Each and every chapter will have a heading, and each and every section you will find a heading. Section 10A, commencement of business. Section 3, formation of the company. Section 4, memorandum of association. Heading at the beginning of the section and at the beginning of the chapter. So you can take assistance from this chapter also, from these factors also. So for example, registration of charges. Any provision you violate with respect to this chapter, you are going to get this punishment which was given under section 86. So now this chapter means what? Registration of charges. So that is the heading of the charges chapter. Next one, marginal notes. So which you will find left side or bottom of the page. Simply, my dear students, whenever you are reading a question, whenever you're reading a topic, you'll try to summarize the topic, right? And you will write that summary, left side margin or right side margin. Suppose after reading this paragraph, you came to know that two words are important. So entire crux of the paragraph is just in two words. Now you'll write just two words on the left side of the paper. So that is nothing but marginal notes. Are you getting my point? Next one, definitional sections. Yes, every act will contain definition sections. In Companies Act section 2, majority of the acts will have definitions under section 2, but General Clauses Act we are having definitions under section 3, section 4, section 3 actually, right? So definitions, and we already discussed about definitions. Definitions will have a word called means or includes. Means, if definitions start with means, it is exhaustive in nature. It's a complete in all aspects. It is defining the word. Next, if a definition contains the word includes, that means it is inclusive in nature. So here we are not defining the word. Here we are giving the list of the items covered by the word. So definitional sections. Next, illustrations. For better understanding of the provision, you can have illustrations. You can refer to the illustrations. In Companies Act also we are having an illustration. We are having illustrations, ma'am, with respect to name clause, selection of the name. So your name should not be undesirable. So with respect to undesirable names, we are having illustrations, variety of illustrations. So you need to take help of illustrations for understanding the law. Proviso, important point. Proviso, you will find proviso in law. In each and every section, you will find the word proviso. It begins with provided that. So qualifying in nature. It's simply an exception. So general rule, beginning of the section you can see, general rule. And proviso means, this rule is not applicable in the below mentioned cases. So it's exceptional in nature, or it's a qualified in nature. So you need to read proviso also. You need to uh, apply the meaning of proviso also while reading the statute, provided that. It begins with provided that. Now you should read section as a whole, and you should apply proviso to the situations where general rule is not applicable. Next, explanations. Yeah, in Companies Act, when you read the definition of associate company, significant influence. So we had an explanation to the significant influence. What is meant by significant influence? So for understanding significant influence, refer to the explanation. Next, schedules. Schedules. You all know in Companies Act we are having 7 schedules. So all common items, common formats will be placed under schedules. So you need to take help of schedules for interpretation of statute also. Next one, read the statute as a whole. If the provisions are conflicting in nature, so to give harmony between conflicting provisions, one should be selected, one should be, or we should eliminate the other provision. How will give, how will select the provision with respect to the situation? So read the statute as a whole, then you'll get a clarity. Next one, coming to the external aids. So these are not forming part of the law, these are completely external. They are completely external to the law. So they are, historical setting. I will see. So historical setting. So background, while framing the law. So what lawmaker thought, what kind of situations he want to regulate, what kind of situations he want to control. Simply historic setting. Simply, go through the parliamentary discussions. Go through the parliamentary discussions. You'll get to know why the law was framed and what is the objective of the law. Next, consolidated statutes and previous laws, Companies Act, as well as General Clauses Act. I forgot just now, previous chapter is General Clauses Act. General Clauses Act, an act to consolidate and amend previous General Clauses Act. That means, you need to refer General Clauses Act 1868, 1887, whenever, wherever required. Next one, usage. Simply, practice. This is the best feature for understanding the law. Usage. Many people think that the provision is there in law, that's why we follow it. It's not like that. Since we follow all these good practices, what we are following will form part of law. In my opinion, law is not the first thing. Usage is the first thing. So the trade practices, the practices, customary practices. In the practices, lawmaker will identify good things and bad things. All good things will form part of law, bad things will also form part of law, but under penalty sections, punishment provisions. Clear? Next one, earlier and later acts and analogous acts. So Companies Act 1956 got repealed, Companies Act 2013 was introduced. So to cover the loopholes under 1956, new act was introduced. So now, in order to cover the loopholes, what new provisions, how the new provisions were framed? You're getting my point. Now here, for understanding the new provision, you are taking the support of earlier acts, external aid. Next one, if you had a definition in the respective acts, follow the definition. Or no definition, then come to the General Clauses Act. If General Clauses Act is also silent with respect to the word, then go to the dictionary definitions. So external aid. Next one, use of foreign decisions. So foreign case law decisions, like doctrine of ultra vires, Ashbury Railway Company versus Ritchie. So when you are not having a particular definition to the word ultra vires, so beyond the powers of the company, we had it. But how we got the word ultra vires? Sir, we got the word from foreign case study. So now you can apply those decisions in interpreting the statute also. Understood, ma? So I covered rules of interpretation and I covered aids to the interpretation. With this, I conclude interpretation of statutes.